So let's begin the chart revision. Okay, CA Inter Audit chart revision. See, in this chart revision is only a complementary to the already uploaded revision on the YouTube, which is GOAT revision based. GOAT notes based revision is already uploaded. In that revision, you will find conceptual explanation as well, like where we give you a decent explanation of all the concepts. Whereas chart revision is only for a quick recap. There won't be much of any conceptual explanation. It's all about recapping. It's all about whatever we already watched in the GOAT revision. The same will be brushing up again here in the chart revision. For example, if you see GOAT revision, I have already uploaded one video on the YouTube itself. 80% of the syllabus is covered. 80 to 90 marks weightage of the syllabus is covered together. The primary objective is just whenever you already finished revision, whenever you are reading the book, and after you finish a particular chapter, if you want to have a quick recap, for that only chart notes. And even in the chart notes, I gave a big disclaimer at the beginning itself that this is only for a revision purpose, not a substitute for GOAT notes. For me, if you ask which is best material, ICA book is best material, safest material. The safest material is ICA material. But often psychologically student feels since it is lengthy, so the GOAT notes is a best alternative to it, where it is 260 pages, 100% of ICA material is covered. Every concept you can compare line by line, you can compare concept by concept. Same structure is followed intact in our GOAT notes also. And on the same lines, this particular chart notes is also developed. And those of you watching online, you can download this particular file from our website, sresthaforcacma.com. PDF is free. You can download the file and you can take a print also if you want. Or if you want to have a hard copy, you can order it on our same website, sresthaforcacma.com. Go to book section. You will find this chart notes. Okay, you can order there. Now, I specifically mentioned that this is purely for retention, recall, and presentation of descriptive answers, especially during revision phases. Okay, just a minute. So, yeah, okay. So, this is purely for revision purpose. And see, in exam, no, the main problem that we face is while we are answering descriptive questions, we do not recall all the points. Suppose if a question comes, for example, write about assurance engagement. What are characteristics of an assurance engagement? If they ask a question like that, every student knows the concept a little bit, at least 50-60% clearly he knows that. Characteristics also 1 or 2 points he will be knowing. Suppose if there are 4 or 5 points, so 1 or 2 points he'll be able to write, but all the 5 he is unable to write. So that is the reason why they are not scoring full marks. So in order to ensure that you recall the points quickly, you revise the points quickly multiple times, this chart notes will help you. Now some students ask me, sir, can I write the matter what is there in chart notes as it is in exam and can I get full marks? Not at all, you won't. This is only purely for memory purpose. If at all somebody says you that chart notes is enough for exams, don't believe it. So no chart notes will be. In fact, I can clearly tell you this particular chart notes is best in the market because this is more comprehensive. This particular chart notes is comprehensive. Literally every key term has been covered in this chart notes in just 130 pages. So quality wise, this notes is better than any other material that is available in the market. But can I get full score by writing this particular chart notes matter? It is 50-50, we don't know. So it is always advisable to write the answer in the same manner as given in the GOAT notes. So this revision, please use it only as a complementary to the already uploaded audit marathon, which is of 12 hours, GOAT notes revision, for example. Okay, so this chart notes revision is not a substitute. Earlier I used to tell many times chart notes concept is a blender concept. That is not at all. I never recommend chart notes. Getting it? Like how many students do, you know, they think this particular notes is the only note sufficient. If this notes alone if you read, that is sufficient. No, that is absolutely wrong. This is only complementary in nature. So chart notes can never be substitute for any other material. So first point you should remember that, and then accordingly use this notes as required. That's it. It's only for recall purpose, only for brush up. For example, you see the first chapter, nature, objective and scope of audit. It is just covered in 6 pages. Page number 1 it starts NOS, then immediately on 7th page ethics and terms. So entire chapter is covered in just 6 pages. So you can revise many concepts within less than very few pages. Suppose you see audit report, almost 12 pages, only 12 pages. Audit report, CARO, so many standards, 700 series, so many were there. but we will be able to cover within 12 pages. So it's only for revision purpose. Okay, that's it. Now, and definitely day before exam especially, this particular revision will be highly useful. This notes will be highly useful. Like you read once from the GOAT notes, immediately quick recap from the chart notes, so that the same points will be revised by you twice, day before exam also. So for that reason, this will be a powerful companion in your preparation. So now, without any delay, let's begin the first chapter, nature, scope and objective. At every chapter introduction, it's my duty to alert every student, please refer GOAT notes revision, then only come to chart notes revision. So this is a common standard alert at every chapter beginning I have to give. Fundamentals, actually if you see the GOAT notes, there is another chapter called fundamentals of auditing, which already given there, already fundamentals is there in the GOAT revision, please watch that. And then finish GOAT notes NOS revision. If at all those of you who are watching only my revision class, finish GOAT notes NOS, nature, objective and scope, there I already revised, then come and revise here quickly. So what we already learned in nature, objective and scope of audit, what we already learned in nature, objective and scope of audit. So first of all, there is something about origin of auditing, history of auditing. We know that auditing is something ancient, it is not something modern, it is there from the ancient times itself, where the periodical checking concept exists, verification and all existed early days itself. Now audit comes from the Latin word called audier. Audier means what? To hear. Where in earlier days accounts are read out and people listen and accordingly do ask questions. Next, and in India, ICA is the statutory body to regulate chartered accountancy profession in India, which is the supreme body for conducting audits. Next, now what is meaning of audit? Audit definition we already saw. Audit is an independent examination of financial information of any entity, whether or not profit oriented, irrespective of size or legal form, when such an examination is conducted with a view to express an opinion thereon. So an audit, an independent examination of financial information of an entity to express an opinion in a simplest way. This is audit definition. Now here original wordings are what? Irrespective of, I mean whether or not profit oriented, irrespective of size or legal form. So that and all doesn't matter. Our ultimate objective is what? We independently examine financial data of some entity and express opinion on the financial statements. Correct? Now nature of auditing, the definition is broken into multiple parts. In audit, auditor will be independence, because auditor's verification, he is unbiased, he don't have any influence, so he verify the financial data unbiasedly. And you know, the financial information like audit we do for profit oriented as well as non-profit oriented of any size or legal form. The ultimate objective is to give opinion. If someone asks you what is the purpose of audit, the purpose is simple. There is a company, there are financial statements, and people invested in that company, and they want to know what happened with their money. For that reason, directors of the company has given something called balance sheet, P&L, financial statements. Now whether these financial statements are trustworthy or not, the auditors will come and tell that. So if the auditor gives an opinion, yes, they are trustworthy, people will believe it. So indirectly audit gives confidence to the users. Audit enhances confidence of users in the users of the financial statements by giving opinion on whether the financial statements are prepared in accordance with applicable financial reporting framework, whether financial statements are in compliance with, in accordance with applicable financial reporting framework. Now what are various aspects that we cover in audit? We confirm, you know, whether financial statements are in conformity with books of accounts. We confirm whether all the books of accounts are supported by sufficient appropriate evidence. We verify there should be no omissions, no duplications, no fictitious entries. Financial statements must be unambiguous, yes or no, compliance with relevant accounting standard. Ultimately the financial statements must be true and fair view about the results of the company, assets and liabilities of the company. So these are various aspects to be covered in audit. In exam, this aspects itself will be asked as a 4 marks question. Write about meaning of audit and various aspects to be covered in audit. This itself can be asked as a 4 marks question. Next, and see, obviously in order to do audit, you know, properly, in order to do audit properly, there are various other subjects knowledge which auditor requires. So what are the various subjects knowledge which auditor require? Accounting, law, economics, behavioral science, statistics, data processing, financial management, production. So as an auditor, you will be reviewing production records to know scrap value, scrap generation, all that. And financial management knowledge also auditors should have in order to identify, perform analytical procedures, especially like ratio analysis, all that. Okay. Auditor must have a knowledge of behavioral science, like he must know how humans behave. Yes or no? Like to identify fraud risk factors, error risk factors, all that. Auditor obviously should have an in-depth knowledge of accounting, in-depth knowledge of law, in-depth knowledge of economics. Why economics knowledge is required for the auditor? In order to know whether the company is performing well in the industry, to do a comparison with the industry. So this all will help in analytical procedures. So auditor must have various subjects knowledge. Okay. In exam, they may ask you 3 marks question. What is the need for diverse knowledge? Like this, they can ask you. But till date, they never asked this. But there is no guarantee that they will never ask also. Anything they can ask. Next, objective of auditor. What is the objective of audit? 2 objectives. 1, obtain reasonable assurance whether financial statements are free from material misstatements. Okay, once you got reasonable assurance, report on the financial statements and communicate findings as per various standards on auditing. 700 series talks about reporting. So as per 700 series, we'll be reporting. So first we should get reasonable assurance, then we should be reporting. Then, so the same objective is detailedly explained. What is reasonable? Reasonable is a high level of assurance, but not absolute. Yes or no? Auditor will conduct audit using skills by following standards on auditing. Ultimately, he will gather evidence so that he will have a reasonable assurance. Remember, we can only get reasonable assurance. We cannot get absolute assurance. There is a clear reason why audit suffers from various inherent limitations. What inherent limitations the audit suffers from? For example, inherent limitations, audit has inbuilt limitations. Audit has inbuilt limitations. And we cannot give absolute assurance that financial statements are free from MMS. The reasons are broadly classified into mainly 3. 1, financial reporting nature is like that. Like, what is it? Financial statements involve subject to decisions and judgments by management, okay, which are uncertain, which are obviously uncertain. Accounting estimates, they're not 100% accurate, they're estimates. So financial statements itself is not 100% accurate. So we cannot give 100% accurate opinion. Yes or no? And internal control limitations, even controls are effective, collusion and all will be there. Internal controls itself suffers from limitation. Nature of audit procedure, we have certain practical limitations and legal limitations. Suppose if management is not giving information, management is withholding, nothing but not giving information, we can't compel them. So that's a legal limitation, we can't force them. Practical limitation, we conduct audit based on samples, we don't do audit 100% exhaustively. Yes or no? So that is a practical limitation. 100% coverage is impossible, so that's a practical limitation. So nature of audit procedures itself suffers. Nature of audit procedures, the way audit we perform, that itself is one limitation, right? And of course, dishonesty, management may not be honest with you, they might be showing you fraudulent data, they might not reveal you important data. Yes or no? Next, see, when we are doing audit, even in 580 standard, we saw there is a standard 580 in audit evidence topic, there also we saw management cooperation is utmost important. Only with the management support you can do a proper audit, otherwise it is impossible for us to do a proper audit. So most of the information that we want in audit is given by the company only. So we have to take the data from the company, evaluate the company books of accounts, evaluate the financial statements prepared by the company, and give opinion on the same financial statements. Next, related party, some transactions may be fictitious, so auditor may not be aware of some related party relationships. So there are so many limitations. Then remember, audit is not an investigation. To give absolute assurance, audit is not an investigation. So audit is not a legal investigation. So we cannot guarantee that financials are free from fraud and error. Next, and timeliness and relevance of information. Remember, we do audit of past financial data. We don't do audit of the latest data. Yes or no? We don't do the audit of ongoing transaction. Already transaction is completed. So much of information is already lost its time. Yes or no? Information loses relevance over time. Auditors cannot verify everything in detail. So there must be some trade-off, some balance between reliability versus cost of information. Past data may become irrelevant if conditions have changed. Future events. One more limitation in audit why we cannot give absolute assurances. Remember, financial statements are prepared using going concern assumption. Going concern means future oriented assumption. But these future events are highly uncertain. Sudden market shifts might happen. New business models, unforeseen changes could arise, but we don't know. So the financial statements are prepared using going concern assumption, where the assumption itself is future oriented. Of course, they take a reasonable, they do a reasonable evaluation and then take a going concern assumption, but still suddenly overnight anything can happen. Able to understand? That's it. These are all various limitations due to which we cannot give absolute assurance. We can only give reasonable assurance. Clear? Easy? Next, scope of audit. So what do you mean by scope of audit? Scope means what? What exactly audit covers. Scope means what audit covers, what audit do not cover. So understanding what it covers, what it do not cover, that itself is enough. Scope. Now first we need to understand what audit do not cover, what audit do not include. You know, auditor don't assess physical condition of the asset. For example, see, any activity beyond auditor's competence you don't have to do. Some verification is there which is beyond your knowledge and domain, you don't have to do. You can ask expert there. So auditor is not expected to have 100% knowledge of everything. Next, document authentication. Remember, auditors are not experts in verifying genuineness of documents. You know, suppose if a client is giving fabricated forged documents, we don't know, we rely upon them, we rely upon that whether a document is original or duplicate. For that experts will be there, so you can call them. And audit is not an official investigation, and audit is different from investigation. Investigations are detailed and focused. So indirectly what are they saying? Audit is not an investigation. You don't have to behave like an investigator. Yes or no? See, your ultimate objective is to give reasonable assurance whether financial statements are free from MMS. That's it. So what scope includes indirectly? You should cover all aspects. All aspects means what? All items of P&L, all items of balance sheet, everything you should cover. And so, and you must also ensure that financial information is reliable and sufficient. Auditor ensures accounting records are trustworthy. So you need to evaluate, you need to review accounting system, internal controls and all that. Next, further, the one more thing that audit has to cover is proper disclosure of financial information, whether financial information is properly disclosed or not. Disclosure means what? Auditor has to check whether relevant information is disclosed as per legal and statutory requirement. And financial statements must accurately summarize transactions. Financial statements must include accounting policies, everything, disclosure of accounting policies. Auditor has to review whether these policies are suitable and consistently applied. So whether these policies are appropriate and are they consistently applied. And financial statements are based on past economic events. Remember that. So audit covers all this. Clear? You're able to recollect quickly. So those who read that GOAT notes or ICA book, for example, and you see this, quick recap. Next. And now see, whatever we do, whatever work that we do, we simply call it as engagement in our profession. In business it is called as a contract. In our profession we call it as engagement. So what is an engagement and what are the benefits of external audit engagement? But before I talk about that, there are two types of audits. Audits are two types: mandatory statutory audit, voluntary nothing but non-statutory audit. Remember, audit is not compulsory for every organization. Yes or no? Sole proprietor, normal partnership firm other than LLB, okay, and AOPs, BOIs, they may not have any mandate requirement for audit. So not always legally mandatory. Audit is not always mandatory. It is only mandatory for certain entities. For non-corporate entities, no, it may be mandatory under tax law. Under income tax also audit requirement might be there. Then only for non-corporates it might become mandatory. Next, sometimes audit might be important in order to get a government grant, or audit may be a condition, one of the condition when a government is giving a grant. And voluntary audit. So generally people choose audit voluntarily also, even though it is not compulsory, because of so many benefits it has. Like, what are the benefits of audit? Benefits of audit: it benefits shareholders who rely upon auditors. It acts as a moral check on the employees. It helps government to identify tax defaults, tax evasions, all that. It helps bankers to take a credit decision whether to give a loan or not. It helps detection of mistakes. It also makes sure whether control systems in the company are effective. These are the benefits of audit. Now, as we discussed now, there are two types of audits: statutory and non-statutory. Generally in statutory, the auditor is an external party. When auditor is an external party, we call it as external audit engagement. We call it as external audit engagement. First of all, engagement means what? Engagement means it's an agreement between two people. Here we are talking from auditor context. Who are the two people? Auditor and client. Next, it outlines audit services and documented in a letter format. So engagement is generally between two parties, and what are all terms and conditions, they will be in an engagement letter. What is external audit engagement? What is why this external audit engagement? It is primarily to increase confidence of the user that financial statements are free from MMS. Yes or no? Mandatory for some entities, voluntary for others. Are you clear? See, whether you are going for voluntary audit or statutory audit, it is always better the auditor from outsider is best. Only then that auditor's report will have some trust. Yes or no? We already saw all these points, right? Next, fine. Like, is this explanation sufficient from chat point of view? Right? Sufficient, right? Yes. Huh? Yes, you're able to, like, it's helpful, right? Yes. Now, who appoints the auditor? You have in company law, you have in CA intercompany law, appointment of auditors topic. In a company, the auditors, non-government company, the auditors are appointed by shareholder. Government company, the auditors are appointed by C&AG. LLPs, the auditors are appointed by designated partners. In partnership firm, auditors are appointed by partners as per the partnership deed. In case of proprietary concern, proprietor himself. In case of societies, all that as per the governing bodies. That's it. So, private companies appointed by members. Government companies appointed by C&AG. See, here private means private sector, not non-government company. That's what here the meaning. Private means not private limited company. Okay. Next, partnerships appointed by partners. Governmental authorities like municipal corporations, all that as per respective law. And ultimately, to whom the report is to be submitted by the auditor? To the appointing authority. Whoever makes an appointment, to them we have to submit the report. Next. Now, you see, like I told, right, whatever the work we do, we call it as engagement. What are the various types of services which an auditor performs? That too as per CA, as per ICA, what are the various types of services we perform? Whatever service you provide, they're broadly divided into two types. Assurance services, non-assurance services. Assurance services and non-assurance. Assurance means where we give some confidence, like we give a report, there will be two different parties and one party is believing another party. So they're asking us whether the preparer, nothing but whether the responsible party, okay, whether the responsible party, whatever subject matter they prepared, is the subject matter reliable or not? Users are asking. So between users and responsible party, auditor will give a report. So that report will be used and users will take a decision based on information provided by responsible party. Fine. What is responsible party? Who is user? Who is auditor? We'll discuss that. Now, so engagements are broadly two types. Whatever engagements that we provide, broadly two types. Assurance engagement, non-assurance engagement. Assurance is again two types. On historical financial information other than historical financial information. On historical financial information, we can give two levels of assurance. Reasonable assurance, limited assurance. We can also give assurance on other than historical financial information. Other than historical means what? Not past, something like future. Prospective financial information, non-financial information. We can give assurance on other than historical financial information. We can give assurance on prospective, or we can give assurance on non-financial, like controls. We can give assurance on controls. For example, there is something called SOC audit. I have told this in 501 explanation, service auditor concept. There in 501, when inventory is lying with third party, get a service auditor report. Like that one point is there in our 501 discussion in audit evidence topic. Okay, there I told you service auditor, SOC audit, little discussion in our original class. Okay, fine. So non-financial. So we can give assurance on PFI, prospective financial information, or non-financial information. That is also an assurance. We can give assurance on historical. Which level of assurance? Reasonable. Reasonable assurance is a high level of assurance, but not absolute. Yes or no? Limited assurance. Another type of assurance is limited assurance. In reasonable assurance, no, we tell specifically whether it is good or bad. In a limited assurance, no, we tell in a way not bad. We don't say it is good. We say it is not bad. The level of assurance is totally different. Now, reasonable assurance we call it as audit, limited assurance is called as review, and whereas normal other than historical financial information we simply call as assurance engagement. And apart from these three, we can also provide some non-assurance services, filing IT return, filing ROC returns, okay, performing some agreed upon procedures, like that. Some non-audit services also, non-assurance services, they are called as related services. They are called as related services. Now for all of this we have standards. We have SRS, standards on related service, standards on assurance engagement, standards on review engagement, standards on auditing. So for standards on auditing is signified as SA, whereas standards on assurance is signified as SAE, standards on assurance engagement. So like this we have 4 different types of. Now what is an assurance engagement? Assurance engagement means what? Assurance engagement is also an engagement where practitioner, he gives a conclusion to enhance confidence of the users. Yes or no? On what he will give conclusion? On subject matter, okay, where that subject matter will be compared with criteria. For example, let us put audit related logics here. Auditor gives opinion to enhance confidence of users on subject matter called financial statements, whether the financial statements are matching as per applicable financial reporting framework. Are you getting it? Suppose if it is a review, accordingly review wordings will come. If it is an assurance, just prospective financial, then prospective wordings will come. That's it. So ultimately, whether it is auditor, reviewer, normal assurance services, other than audit and review, any other assurance service, in all these 3 cases, some practitioner will be there, like a CA, who will give some conclusion. He will express his conclusion on some subject matter, which is prepared by some responsible party. Whether this subject matter, is it as per so and so criteria? That is what happens in assurance engagement. Correct? Next. So what is the purpose? What is the purpose of this entire assurance engagement? To reduce the chance of incorrect information, so that users will take a confident decision. Okay. Next, what are the elements of assurance engagement? There are totally 5 elements. There are totally 5 elements in assurance engagement. First one, 3 people will involve. 1, practitioner, obviously he is the one who is giving conclusion. In audit we call it as opinion, in review it is conclusion, in assurance also we call it as conclusion. And responsible party, who actually prepares the subject matter, and users, who actually uses the report given by the practitioner. Next, so subject matter, so obviously responsible party prepares subject matter, right? So that subject matter is one of the important element in assurance engagement, because that subject matter only we verify. In audit, subject matter is financial statements. Yes or no? And criteria, these are the benchmarks used to evaluate subject matter, whether the subject matter is prepared correctly or not. Some benchmarks will be there. Those benchmarks are called as criteria. In audit, applicable financial reporting framework, that is the criteria. Next, we need to obtain evidence, whether it is audit, whether it is review, whether it is assurance. In all assurance engagements we need evidence. Sufficient appropriate evidence is important. Yes or no? And finally, we express our conclusion or opinion through a written report. So these are the elements of an assurance engagement. So what is an assurance engagement? What are the elements thereof? Easy. Next. Now we have seen all there are 4 types of engagements: audit, review, assurance, and related services. Now what is a review? In audit, we provide reasonable assurance, which is a high level. In a review we provide limited assurance, where it is lower level of assurance. In audit we perform extensive procedures like inquiry, inspection, recalculation, analytical, external confirmation, physical verification, so many we do. But in review, limited procedures. Only we perform inquiry and analytical procedure. We only perform limited procedures. Only 2 types of procedures we perform. We don't perform recalculation, reperformance, analytical we perform, physical verification, inspection, yes or no, ledger review, we don't perform all that. Next, by the way, whether it is audit or review, both are related to historical financial information only. Correct? Next, what are other types of assurance engagements? Okay, other types of assurance engagement are what? There are assurance engagements which are existing for subject matter other than historical. You can also provide assurance on some matter which is not historical financial. What is that? Other than that, prospective financial information or internal controls. You can also give assurance on company's internal control, prospective financial information. Now, what is a PFI? Financial data based on assumptions about future events and actions. Actually, in the printed copy, here like this 2 word is there, events word is missing in the physical copy. Those of you watching from the physical copy, just a minor correction like this, So, financial data based on assumptions about future events and actions. Like this particular PFI can be a forecast, can be a projection, or it can be a combined. Remember, we have something called 3000 series standards, which are there in CA final. We have a full-fledged chapter on prospective financial information, entire 3000 series. There are 3 standards, 3000, 3402, 3420. 3 standards were there. Now, the level of assurance in assurance engagements other than historical financial is moderate assurance. Generally, practitioner ensures that management assumptions are not unreasonable. Remember, prospective, by the way, okay, first to know, it's okay, we'll see. So what is the focus of such engagement? Generally, PFI, they do not examine historical. Historical information is about past, whereas prospective is always about future, which is based on assumption. The future data we will give based on assumptions only, right? Now, in these engagements, we don't give opinion on the financial statement. We give opinion on the assumptions. We give conclusion on the assumptions. And that we don't give reasonable conclusion. We give a limited conclusion. Limited assurance only will give you. Moderate assurance only we give. That's why we say the assumptions are not wrong. We don't say assumptions are right. To best of our knowledge, the assumptions are not wrong. Are you getting it? So practitioner ensures management assumptions are not unreasonable. So information is prepared based on assumptions, and the prospective financial information, all material assumptions it has to disclose, and we can only provide a moderate level of assurance. Next, remember what are limitations in these kinds of engagements? Because the information is future, complete evidence is future oriented. Practitioner cannot confirm actually whether the result can be achieved or not. That's why in the real report, we give report, right? Ultimately, in that report we mention all these facts. Whether really the results can be achieved or not, we don't know. We have not verified accuracy of the same. We verified assumptions. Assumption seems logical. That's it. I am not giving opinion on the financial information. I'm giving opinion only on the assumptions. That to what level of assurance? Moderate assurance. Now somebody will ask me, sir, what is the difference between moderate assurance and limited? Both are same. Both are same. Limited assurance is a low level of assurance. Moderate assurance is also a low level of assurance. Just a change of wordings. That's it. Next, ultimately, practitioner gives a report where he will give an assurance that nothing suggests, nothing, no assumptions, nothing suggests, assumptions don't provide a reasonable basis for projection. Assumptions are what used for PFI preparation, right? We are indirectly saying we don't have anything to say that assumptions are not reasonable. Are assumptions not reasonable? We don't have anything to say like that. We are not saying they are reasonable. We are not saying they are unreasonable. To say they are unreasonable, we don't have any information. So indirectly, a lower level of assurance. Clear? Next, what are the qualities? Personal qualities of the auditor. See, every point is covered. You observe, every point is covered in this chart book. Almost whatever you read from ICA book or whatever you read from Goat Notes, every point is clearly covered. Personal qualities. All the traits of a good businessman must be there for the auditor. Like firmness, tact, good tempo, judgment, patience, all that. Integrity, independence, all that. Professional, he must be expert in knowledge of accounting, law, various things. Yes or no? Next, finally, engagement and quality control standards. Engagement and quality control standards. So, we have four types of standards. I already told. Yes or no? Standards on auditing, standards on review, all that. What is standards on auditing? They apply to audit of financials. Okay, so standards on auditing covers various things. For example, objectives of audit 200, documentation 230, planning 300, risk assessment 315, opinion 700. Various examples of standards on auditing. Recently in May 25, they have asked this, I think, one of similar question. Give few examples of standards. One of the question they have asked. Straight question, simple question. Standards on review engagement. They apply to review. They provide only limited assurance. Both standards on auditing SR is applied to historical. Like, standards on auditing, standards on review. They both are dealing with historical. Next. Other than that, there is another standard called standards on assurance engagement. What are they? They apply to subject matter other than historical. Examples: prospective and non-financial matters like internal control. There is a fourth set of standards called standards on related services. They apply to agreed upon procedure and agreed upon procedures on financial information. Compilation: there is another type of related service, we call it as compilation. For related services, 4000 series we have. See, we totally have, engagement and quality control standards, we totally have 46 mainly. One is quality control standard, remaining 45 are various engagement standards. Out of this 45, 35 were standards on auditing, 3 were standards on assurance engagement, 2 were standards on review engagement. Related services, standards on related services, apart from 3, there is something called 800 series, that is also standards on auditing. There are 3. Okay, so totally 3 6 plus 2 and related services 2, 4, total 10 standards apart from the 35 auditing standards which we know. Out of, we in our syllabus in CA Inter, we have only this 35 standards on auditing, not all 35 again. In this, some 6 or 7 standards we don't have. Okay, we totally have 28 or 29 standards in our CA Inter syllabus totally, plus 1 SQC we have syllabus. That's it. We typically have 30 standards as a whole out of 46, whereas in CA final you have all 46 standards in our syllabus. Clear? Next. So standards on quality control, there is another set of standard called standards. So totally 5 types of standards: standards on audit, standards on review, standards on assurance, standards on related service, and standards on quality control. So purpose: it is for firms quality control. SQC1, there is a standard where it want firms, it is applicable for audit firms, to ensure that firm is complying with all the standards, law and regulation. Every service that you are providing must be qualitative. So for the firm, this standard is applicable, quality control standard. Quality control standard is always talking about policies and procedures. We'll discuss that in upcoming chapters. Okay, next. What is the need for the standards? What is the need for standards? Very simple. Ensure audit follows established benchmark. Uniformity, yes or no? Improves financial reporting quality. Here, need for standards only this book. They did not talk about need for audit standards alone. Okay, next. They promote uniformity in audits. They make sure the accountants are equipped with knowledge. They ensure audit is qualitative. Yes or no? And duties in relation. What is our duty? As a CA, what is our duty? We must follow standards in all engagements. Whatever the work we are doing, we must follow standards. Document alternative procedure if a standard procedure is ineffective. In standards, they tell so many processes to do. If at all that process is not followed, why you did not follow, what alternative you followed, so that standard objective is achieved. You need to document. Document reasons for departures. Disclosure alone does not excuse non-compliance. See, generally all the standard says, if whenever you did not follow some standard, disclose it. They say, just because you are disclosing, that doesn't mean you're exempted from standard. You should clearly tell why you could not follow the standard. You should somehow meet the objective of the standard. Clear? That's it. The first chapter, nature, objective and scope of audit, is completed. That to be discussed with a decent explanation. Okay, 35 minutes, that's it, over. Confident? Yes. Yeah, let's begin the second chapter, chapter revision, ethics and terms of engagement. In this chapter, we totally have 3 parts. Part 1, ethics; part 2, terms of engagement; part 3, quality control. Quality control, I will revise at last. So in the same way, what we discussed in our class, okay, in the whatever the original class that we discussed, exam oriented batch. So in the same order, we'll be discussing chapter revision also. And even in the YouTube marathon, which is based on GOAT notes, that is also done in the same line, on the same lines. So those of you watching this particular revision, first you finish this particular chapter related revision from the GOAT revision marathon, then come back and then say this. So part 1, ethics. So what is the meaning of ethics? What do you mean by ethics, and what is the need for professional ethics? Ethics means what? Moral principles of behavior, acceptable behavior. It is a different branch of knowledge. It's a branch of knowledge dealing with moral principles. Nature. Ethics comes from within. It's not something imposed by society, or it should come from within. Ethics. It is inculcated into habit. In the ethics primary motive is beyond selfishness. So no, it should not be for your own purpose. It should be for as a whole welfare. Next. Aligns actions with moral principle, imposes obligations, signs of morals in human conduct. This is what the meaning of ethics, typically speaking. What is the need for professional ethics? See, we give assurance. The The primary work that we do as a chartered accountant is we provide assurance, which enhances confidence of users. So users has to trust the professionals. When they can trust the professionals? Only when they know that we are bound by certain ethical principles. Only when they know that we are having certain ethical principles, and if we violate that, we are punishable. So if people know that, they naturally believe our opinions. So what is the basis for professional ethics? Obviously it is rooted in morality. Public interest above personal gain. Yes or no? So ultimately, because of this ethics, what happens? We earn respect and honor. Next, professional bodies must interpret public interest broadly before framing ethical principles. Next, third one. So what auditors has to do? We need to adhere. We have to simply follow the ethics. Okay. So because the better we follow ethical principle, the likely impact on the confidence of the users, and of course confidence on our profession. So strict adherence through self-discipline, and ultimate objective is commitment to act in the public interest. Then we have the fifth point. So what is the role of chartered accountant? We have to follow ethical behaviors and fundamental principles. No, the users must feel secure. Like after you give a report, they must take a decision and they should feel secure and confident. Then, so ICA has given various ethical standards. There is a board also, something called Ethical Standards Board. ICA has an ethical standards board. So ICA requires, it is mandatory to comply with professional principles, I mean ethical principles. So so entire this ethics has been codified. So the codified ethics we will discuss in CA final. The codified actual rule of ethics and all, what are all various rules were there, what are all various schedules, clauses, punishments, misconducts, all that we'll be discussing in CA final. So in CA final, advanced auditing, assurance and professional ethics, right, the subject name. So we have in-depth discussion of professional ethics. In fact, in CA final the weightage is close to 20 marks. Professional ethics weightage is close to 20 marks, 15 to 20 marks. Next, so CS must follow code of ethics. CS must follow code of ethics. And if a member is not following ethics, disciplinary action will be taken. So there is a disciplinary mechanism, fines, a suspension, removal of membership of chartered accountants. Okay. So in exam they might ask you, what is the need for professional ethics? 4 marks. You know, here we have totally 8 points, right? Any 4 points you can write. Okay, any 4 points you can write. Next, now remember, ethics, no, there are 2 approaches to implement ethics: principle based approach, rule based approach. Rule based approach is very tough because we can't list out. For example, you take company law. I would have given this example. Disqualifications is there. In disqualification, relative cannot be appointed. Relative definition does not include grandfather. Relative definition does not include grandchildren. Now, suppose my grandfather is a director in a company. He wanted me to appoint as an auditor. He told me, hey, you are not covered in relative. You can be appointed as an auditor. But my ethics says we both are not. You know, we both are close to each other. Familiarity is there, lot of familiarity. So rules permit me. Rules does not prohibit me. Only based on rules, literally you can't interpret. Ethics has to be interpreted based on spirit. You need to exercise professional judgment. Able to understand? So rules, no, they will be narrow. They sometimes overlook spirit. Rules will be rigid, does not cover every possible situation. So always observe the spirit of the code, not just the letter of the law. Are you clear? So principle based approach versus rule based approach, 4 marks question. This entire matter you have to. Easy. Next, now there are various fundamental principles. Remember, these fundamental principles are something common in every profession: doctors, lawyers, CES, for everybody. What are the fundamental principles? Integrity. The chartered accountant must be straightforward and honest. He must deal fairly and truthful. He must not be associated with false reports or information which is provided negligently. You should not report. If at all you are reporting on that, highlight them, point out them, give a modified opinion in such a case. Objectivity. Objectivity means bias should not be there. Conflict of interest should not be there. I know my grandfather is a director in a company. Obviously there is a conflict. Naturally he will be controlling me, he will be influencing me. I can't do audit justified. Even the Companies Act does not prohibit me to become an auditor, but spiritually, yes or no, contextually, conflict will be there. Next, so objectivity means not compromising your professional judgment. Your decision making should not be compromised due to bias, due to conflict, whatever. Next, professional competence. it is a moral responsibility for you to be heavily competent. It is your moral responsibility. Maintain required knowledge and skill, and that is competence. It's all about skill and knowledge. Due care. Due care means be careful when you're working. Don't carelessly work. Okay, diligently, act diligently, thoroughly, and timely. You must give timely delivery of the services. You promised a client that you will give timely delivery. You're not delivering on time. Due care violation. Getting it? MCQs might come. Next, confidentiality. You know, obviously, being a CA, you will be getting to know about the client financial data, affairs, all that. You respect confidentiality. Yes or no? Disclose only when it is required in the law or permitted by the law and permitted by the client. Without consent of the client, without consent, you cannot share client information to third party. Exception only one case. Law 100, I mean, it is mandatory in law to disclose. Then you can disclose even if the client do not permit. Next, professional behavior. You must ultimately comply with laws and regulations, you know, and avoid actions which will disrepute, which will bring disrepute to our profession. So avoid activities which will harm integrity, objectivity, reputation, all that. Bribery activities, corruption, all these cases you should not involve. That's it. These are 5 fundamental principles of professional ethics. These are also called as ethical principles which a chartered accountant has to follow. Clear, all of you? Any one or any 2 points they will be asking in exam. Write about integrity and confidentiality, write about objectivity and professional competence, like that they'll be asking. Clear? Next, now, independence of auditor. Obviously, one of the most important, the only reason why public has confidence on audit reports is because auditor is not related to anybody in the company. Auditor is an independent person. He is an external party. Yes or no? Independence. What do you mean by independence? There are 2 perspectives of independence. One is independence of mind, another one independence of appearance. The most important is independence of mind. That's ultimately important. You must act objectively, unbiasedly. If something is wrong, you must say that is wrong, irrespective of the fact whether you are getting a very good amount of fee. No. Your personal interest should be lesser. Your personal interest should be remote. It should be lowest. Public interest should be your ultimate priority. So independence of mind. When I'm independent of mind means what? I'm not bothered about what, who are you, what are you, all that. Factually it is wrong. So it allows unbiased decision making, unbiased judgment. It ensures integrity, objectivity, and skepticism are not compromised. Independence of appearance means what? You must avoid situation where a third party would conclude your integrity is compromised. Suppose if a third party, no, I'm a grandson of the director, he naturally thinks that I am not independent. I will be doing audit as per their favor. So avoid audits, avoid engagements where a third party who has a reasonable knowledge can conclude that your integrity, your independence is compromised. Able to understand? Next. So this independence, integrity, independence, they are crucial for all profession, that too especially for accountancy. Judgment should not be influenced by others' directions. Independence definition means what? Your judgments should not be influenced by directions and wishes of the other persons. Now, this is even most important for listed companies. Yes or no? Because audits of listed companies lose usefulness if faith in their integrity is lost. If at all people lost faith on the auditor, there is no point. That entire audit becomes useless. Next, auditor must be objective, fearless, capable of giving a honest and right and suitable opinion. Yes or no? Next. So, rules of professional conduct. Ultimately, the professional conduct means what? It aims to promote independence. Rules alone cannot ensure independence. Independence is a state of mind and personal character. Don't confuse with legal standards. Law is there. Disqualifications are given in company law. They are only minimum. You should apply the spirit of the law. Next. What is the role of chartered accountant? Independence must exist, both in fact and in appearance. Relationship between auditor and client must satisfy auditor's independence and appear independent to unbiased persons. Third party should feel that you are very independent. Next. Independence is a subjective. What feels independent to one person might not be same to another person. So ultimately, who should decide ultimately whether the CA is independent or not? He himself. He is the one better, who has a better knowledge. So he must know, he knows whether he is independent in that situation or not. Accordingly, he will accept the audit. CS must decide whether they can act independently in the given circumstance and avoid positions where you can wherever they affect your independence. If your grandfather is coming and asking you become the auditor, you know very well that you can't perform audit genuinely. You know very well if some mistake is there, you can't reveal it. Yes or no? Don't accept that audit. That's it. So independence of auditors, sometimes they can ask you like this, write about independence of auditors, 4 marks question, or there are 2 perspectives of independence, that itself 4 marks question. Like they'll ask you independence, definition of independence, what are the 2 perspectives of independence, like that also they can ask you. Or they can ask you 3 marks question, what are rules of professional conduct in the context of independence, what are rules of professional conduct in the context of independence, like that also they'll ask you. Clear? Next, now this independence is influenced by various threats. Why a CA compromise independence generally? And when CAs lose independence, because of various reasons. All those reasons are categorized into 5 parts. Self-interest threat, self-review threat, advocacy threat, familiarity threat, intimidation threat. Self-interest, auditor or firm benefiting from financial interest in a client. Actually, there are many examples. Okay, for all the examples, please refer directly to the GOAT notes. I'm not reading that again. I'm not explaining that. Okay. Self-review, your own judgment you are reviewing. Earlier you only worked. Now you are only reviewing it. Advocacy, you are promoting client opinion where third party feels that your objectivity is compromised. You are promoting just blindly the client opinion. Familiarity, auditor is too close or sympathetic to client interest. Intimidation, auditors deterred means prevented from acting objectively. Like auditors are like prevented means coercion, blackmailing or bribing also. These are 5 types of threats to independence. Now what auditor has to do? You need to put safeguards. Yes or no? Auditor must always be independent and you should also appear independent. You must be independent, you should appear also independent. Assess threats before accepting work. Suppose if a new client is coming and asking you, sir, can you do this work? Immediately check whether independence is required or not. See, in all assurance engagements, independence is most important. If it's a non-assurance work, independence not required. In an assurance engagement where you have to give a report, where you have to give a conclusion, where you have to give an opinion, independence is utmost important. If threats exist, withdraw or take precautions to eliminate them. Suppose if safeguards cannot be applied, don't accept, decline the work. Safeguards to independence, this itself can be asked as a 4 marks question. Right. Next, concept of professional skepticism. What is professional skepticism? Professional skepticism means it's a questioning mind where you critically assess the evidence. You will be alert to unusual situation. Skepticism means what? Questioning. I'll be questioning everything. Yes or no? I will not accept anything blindly. So whatever information shown to me, I will assess it critically. Yes or no? And something is unusual, I will react immediately. Professional skepticism involves being alert to, these are examples, typically speaking, these are examples. Okay, professional skepticism means alert to contradictory evidences, unreliable information, fraud indicators, and because you are skeptical, you will sometimes perform extra works. You will feel need for extra procedures. Next, benefits. Because of skepticism, what is the benefit? You can reduce the risk of unusual circumstances. You can reduce over generalizing. You can reduce making poor decisions. You can take a good decision. You will be generalizing correctly. Yes or no? These are all the benefits of skepticism. You can reduce the risk of generalizations, over generalizations, overlooking, taking a wrong decision. These 3 kinds of risk you can reduce if you are skeptical. Next. Now remember, generally we treat documents, accepting documents and records as genuine. We generally treat documents are not genuine unless doubted. Always evaluate reliability. If doubt or fraud, investigate first. Remember, in this entire chart notes, the headings are also equally important, not just matter, because most of the times through heading also we convey the concept. Next, of course, remember past experience, like you're working with a particular company from past 5 years, they're very honest. Okay, don't just disregard. Okay, be skeptical always. So don't disregard prior good interaction, but always maintain skepticism. Okay, you need not ignore that, you can consider that, but at the same time maintain skepticism. Last 4 years are very honest. This year, can I switch off my skeptical and blindly believe them? Never. That's it. Next, easy. Ethics segment is completed. Next, part number 2. SA 210, agreeing terms of audit engagement in any contract, sale of goods, provision of services, whether you are providing services or contract, whether you're selling the goods. you need to have some terms and conditions. And the terms and conditions are always given by sellers or service providers. In audit, the service providers are auditors. So we have to give terms and conditions to the client, because client is not aware of all the consequences. In audit, what are all the issues will be there, what consequences will be there, client is not aware of. Therefore, we have to make the client aware of what are the terms of audit. Client might think you will be doing books of accounts also. Client might think you will be preparing financial statements. Client might think you will only file IT return. No. You should tell the client, and if it is audit work, I will not prepare books of accounts. I will not prepare financials. You should prepare financials. You should prepare books of accounts. You should maintain their true and fair. My objective is to give opinion. Yes or no? My objective is to give opinion, and I should tell him that I will give only opinion. That too, this opinion can be modified. If at all I find something wrong, I should tell everything at the beginning itself to reduce misunderstanding. So auditors responsibility in agreeing terms with management. Whose responsibility to agree terms? Obviously auditor, service provider responsibility. Yes or no? So these must be included in the preconditions. So what is the objective? Auditor has to accept an engagement or continue an engagement only when preconditions are present and clear mutual understanding of terms with management or those charged with governance. Only after preconditions are there and management accepted the responsibility, only then you will accept the engagement. Yes or no? Audit. By the way, 210 standard heading, agreeing the terms of audit engagement, agreeing the terms of audit engagement. Next, what do you mean by preconditions? Preconditions are very simple. Management has to use acceptable financial reporting framework. It is their primary responsibility. They must use applicable financial reporting framework for preparation of financial. They should accept that. Only then I will start doing the audit. Management agrees on the premise of audit. Premise is nothing but again preconditions. Audit responsibility, what? You should determine whether financial reporting framework is acceptable. Company told, sir, we follow schedule 3 part 2, sir. For this company, schedule 3 part 2 suitable? Okay, suitable. Then only will accept. Next, if preconditions does not present, first ask management, why are they not following the basic requirements? Reject the audit unless mandatory by law. Suppose if at all framework is unacceptable and management is disagreeing about the responsibility, you will directly reject. Next, and you should obtain agreement of management responsibility. What are management responsibilities? Preparing financial statements as per applicable financial reporting framework, fair presentation, compliance, whatever. And necessary internal controls. Management is responsible to implement necessary internal control to prevent misstatement. Management is responsible to provide the auditor all the information, additional information, unrestricted access to persons. These are all management responsibilities. Only if management accepted all these responsibilities, I will start audit. Otherwise, I will not start audit. These are all preconditions. Management should prepare financials as per applicable financial reporting framework. They should accept that responsibility. See, when we were appointed as an auditor, financials are not yet prepared. So I don't know how they will be prepared. So management should give an acknowledgement that I will prepare as per so and so. So only if they agree to that, I will accept the audit. So now tell me, by the way, of course, do not accept the audit if a management imposes limitation where you may end up giving disclaimer of opinion. Suppose if management is trying to put certain restrictions on you where you cannot do the audit properly, don't accept that unless required by law or regulation. Clear? Easy? That's it. So this is regarding preconditions for an audit. The preconditions itself can be asked as a straight question. 4 marks question this can be asked. Next, what is an audit engagement letter? Just now I told, engagement letter is sent by auditor to client. Why we will be sending? To reduce misunderstanding. So auditor will agree on terms with management or those charged with governance. For non-statutory audits, it is a matter of contract. It is crucial to avoid conflicts. So engagement letter is most important in non-statutory audit because law is also not there here. Next, terms must be in writing for clarity. Next, what are the contents of engagement letter? Engagement letter will have, actually title will be there, addressee will be there, objective and scope, auditor's responsibility, management responsibility, identification of financial reporting framework. We will also tell in the engagement letter what is the applicable framework, reference to expected form and content of the audit report. Actually, in question bank, one question is there. Audit engagement letter will refer about the opinion, will refer about the audit opinion, but it's not about which opinion we will give. We will say that we will give opinion as per standards on auditing, and if required, we will modify the opinion also. That we will mention. See, in engagement letter, we will tell them, sir, this is the objective of the audit. This is my responsibility. This is your responsibility. This is how you need to prepare financial statements. This is how I will give opinion. I will tell the fact that this is how I will give opinion. I will not tell which opinion I'll give. This is how I will. Expected form and content of the report. I will tell how you will get a report from me. In this format you will get. In this manner you will get. If you want, go 700 standard, read 705 standard, all that. So if at all any of those situations present, I will follow all that. So I will tell them that I will give a report in this format. So engagement letter talks about audit report format only. It won't talk about which opinion auditor ultimately giving, because auditor also don't know that. Clear, all of you? Next up. There are some circumstances where engagement letter is not required. It's not that engagement letter is not required. Actual concept here is there are some contents. You know, engagement letter must have all these contents, right? Some of them may not be included. If terms are prescribed in detailed by law, if the law itself talks about, suppose you're doing statutory audit, in the law itself clearly they said auditor's duty, management duty, everything. Now you can give engagement letter excluding auditor's responsibility, excluding management responsibility. So, you know, circumstances where certain terms are not required to be included in engagement letter. That's what actual context of this discussion. Clear? Auditor only needs to state that law regulation is applicable and management is acknowledging their responsibilities. Are you clear? So this itself can be asked, under what circumstances certain terms need not be included, or under what circumstances engagement letter may not be required. Like that anyway they can ask you. Able to understand, all of you? This itself can be asked as a 4 marks question, totally, this topic. Next. Now suppose management is asking you to change in terms. You know, before agreeing to change of terms, there are some matters which you should consider. Before you agree for changes in terms and conditions, you should agree for certain matters. Suppose management is asking you to change the level of assurance to lower level. Suppose it's a statutory audit and they're asking you not to give reasonable, just to give limited, sir. It's not possible. If they're asking you to change to a lower level of assurance, see reasonable justification. Reasonable justification is required. Yes or no? Yes as legal impact. Yes as contractual impact. Why there is a change for changing to a review engagement or changing to some other service? Originally you are appointed as an auditor under SA 210. Now they are asking you to change it to review, means 210 standard will not apply. Or they are asking you to change the service nature to some other services. Yes or no? See legally is it possible or not? Contractually is it possible or not? Look at. Next. And remember, suppose you legally everything you saw, you felt justified. Okay, fine, I will agree. You agreed for change. Now previously you worked some amount, right? Some amount of work you did, right? If at all justified, previous work may be relevant. However, subsequent work and final report must be as per the new terms. Ultimately, see, once you accepted the change of work from pre-audit to review or audit to some other service, now you will be doing work as per the new service. In the previous work, whatever you did, if at all something is useful, use it. But ultimate report will be given as per the new terms and conditions. Easy. Next. By the way, I'm doing work, now the work is revised. Earlier, first initial I was appointed as an auditor. Now I'm doing only review. Now I'm giving review report. Should I talk about audit related appointment details, all that? No need. Yeah, the new report shall not mention original engagement, all that, to avoid confusion, and record new terms. New terms must be agreed upon and recorded in a new written agreement. So new terms and conditions must be again agreed upon, recorded in a new letter. Clear, all of you? Next. Reasons for change. So generally, before you see, these are the matters that you should consider before agreeing to change. This itself can be asked as a 4 marks question. Here there is a high possibility. Change of terms of engagement, this answer is different. Matters to be considered before change, that is different. Matters to be considered before change means what? Is it reasonable? Is it permitted in law or not? Yes or no? And finally, avoid reporting about the previous works and agree in a new letter. These are all various matters which I should consider. Primarily, first point, second point. These are the matters which I should consider before I agree to change. Now, so changes. First, to look at the reasons. Change in circumstance, misunderstanding, scope restriction. Generally, why management asks the auditor to change terms? There might be changes in circumstances, or there might be some misunderstanding. Yes or no? Now, auditor will accept if reasonable justification is there, and new terms will be agreed and recorded on a new letter. Remember, new report shall not refer to old engagement, original works. Next, if at all there is no reasonable justification, or management does not allow original engagement to continue, auditor must withdraw. And SS obligation to report. You see, withdraw means what? Resigning. Whenever you're resigning, check whether you have to report to any authority. For example, in a statutory audit in a company, you have to file a form with ROC ADT 3, resignation of auditor. Yes or no? And whenever management is asking you to change from reasonable assurance to a lower level of assurance, determine justification, assess contractual implications. Previous work may be relevant, but report will be as per the new report will not mention the original. This is nothing but summary of second point only. This whatever here we discuss, no, here once again we gave it as a, able to understand. That's it. Next, finally, the last topic in this particular chapter, because quality control topic I'll be discussing at last. Next, finally you have to send the engagement letter, correct? So in an initial audit, engagement letter must be issued. Yes or no? The moment you are newly appointed. Next 4 years also I am only the auditor. This year I will give. What about the second, third, fourth, fifth year? If it is recurring audit, no need to give. When previous auditor is reappointed or the same auditor is continued for multiple years, a new letter is issued based on circumstances and professional judgment. Generally not required. It is your professional judgment. You know, there are some circumstances where reissuance triggers. Means where reissuance is required. So there are some circumstances where engagement letter has to be issued not only in the first year, at some other year also. When? If at all you think management misunderstood the terms, so tell them once again by giving a new engagement letter with a detailed breakup and revise the terms. Terms have been changed. Change in law and regulatory framework, financial reporting framework, or change in top management, or significant change in business. In all these circumstances, it is advisable for you to once again issue an engagement. So ethics and terms of engagement topic is also over. You know what, technically first chapter almost 6 to 10 marks weightage completed. This chapter 6 to 10 marks we completed, almost minimum 6 to 10 marks will come. So easily 15 to 20 marks weightage we completed. 30 minutes first chapter, this is 30 minutes almost. Okay, 20 marks weightage covered in 1 hour almost. Easy or not? You're able to recap. Yes, is useful. Okay, like if at all those of you who are watching online, if you feel fast, have a speed adjustment in YouTube, so adjust it. Yes, let's begin the audit report topic revision. So again, here I will not give detailed conceptual explanation. I already gave one revision, GOAT notes based revision for audit report. Inside that I also showed drafting, how opinions will be drafted in case of different types of opinions, how I took real audit reports and then showed examples, all that, okay, in the revision class itself. Here it's purely about theory oriented, just for recap, remembering purpose, for a quick revision purpose. Okay, so please first watch that revision and then come back and watch this particular chart revision. That will give you an advantage. If you already watched it, fine, not an issue. Now, so audit report, the ultimate objective of the auditor is to give opinion. The opinion is expressed through a report, correct? So here we have given something called comprehensive format of audit report. We have given something called comprehensive format of audit report. You see, whatever I have highlighted in, you know, orange color here, getting it? So they will not be there in the real audit report. I mean 700 format report. First of all, audit report chapter, no, it is divided into two types, two parts. Okay, we have two parts. Part 1, reporting standards. Part 2, reporting requirements under law. Again, these reporting standards are two types, for unmodified report and modified report. Remember, I am not using the word opinion, I am using the word report. Unmodified report, modified report. Yes or no? Unmodified report means very simple. These points will not be there. The audit matter might be there, not an issue. These points will not be there in unmodified report. I'm not talking about opinion. I already told in the EO batch itself, unmodified opinion is different, unmodified report is different, modified opinion is different, modified report is different. Suppose I give unqualified opinion and I am giving emphasis of matter paragraph in that. The report is modified. Opinion is unmodified only, but the report is modified. Unmodified report means if an audit report is given as per 700 format as it is, no additions in that. 705, no additions. 706 edition is not there. If an audit report is given as per 700 format with unqualified opinion, without emphasis of matter, without other matter para, without other information para, then without material uncertainty related to going concern para, just normal audit report we give with unqualified opinion, then that report is called as unmodified opinion. Sorry, unmodified report. Modified report means what? In modified report, my opinion can be unmodified, but I'm including emphasis of matter 706. I'm including some issues as per 705. Then the report gets modified. 700 report we are modifying now. That's why you see 705 standard heading, modifications to the report in independent auditor's report. So when I modify the report, getting it, not just 705 modifications to the opinion, 706 modifying the report actually. Able to understand? That's it. So even if emphasis of matter paragraph is there, other matter paragraph is there, the report is modified. Opinion is not modified, report is modified. Clear all of you? Now, so these are the, now right now this is a comprehensive format. Like whatever I highlighted, no, these might be there, might not be there in every audit report. Depends upon the circumstances, these items which I highlighted might come. But as a standard audit report will have all these contents. Standard audit report will have all these contents. Every audit report by default. If at all audit report is having only whatever I highlighted with yellow, no, only this it has, that's an unmodified report. If at all it is having, if at all you're modifying the opinion, then it's a modified report. Or you are including emphasis, other matter paragraph, all this also, then also it is a modified. Easy? Yeah. Now, audit report will have all this. Now, first one, title. What is the title? Report must be named as Independent Auditor's Report. Addressee to the shareholders or those charged with governance, it decided by terms of the engagement or the law. In case of stat audit, law will decide to whom you have to address. In case of non-stat audit, terms of engagement will decide. And auditor's opinion. Remember, opinion point I told. Opinions are multiple types: unqualified opinion, qualified opinion, adverse opinion, disclaimer of opinion. Yes or no? Generally in a opinion section, what points will be there? Introduction para will be there. Identify the entity. We have audited the financial statements of XYZ Limited. Identification of the entity. And state that financials were audited. We have audited. And states means nothing but it's a statement. Statement that financial statements were audited. And list the title, balance sheet, P&L, cash flow, refers to notes and policies, specifies the financial statement date and period. This is what opinion section will contain. Yes or no? Introduction. This is intro para. Then we actually give opinion. In our opinion, to the best of our information, according to the explanation. Remember that. So these are the contents of the opinion section. In exam straight away they may ask you, what are the contents of the opinion section? What are the points to be included by the auditor in opinion section? Straight question like this can come. Then after opinion, the next para is what? Basis for opinion. In basis for opinion, we generally have one para only. Yes or no? Whenever we are giving a qualified opinion, adverse opinion, disclaimer, then another para might come. So generally one para. What para? We have audited. We have audited the financial statements as per standards on auditing. As per those standards, we are independent of the company. Yes or no? Our responsibilities and those standards are further described in auditor responsibility section of our report. We are independent of the company. We complied with code of ethics. We believe that the evidence obtained by us is sufficient and appropriate. Like that, so much of matter we write. Now, theoretically, they can ask, what are the points the auditor will include in basis for opinion section? Now, state that these are the statements. State that audit is conducted as per standards. State that refers to auditor responsibility section. State that auditor is independent and he complied. State that auditor obtained sufficient appropriate evidence. State that auditor has obtained sufficient and appropriate audit evidence. These are the statements which you must include in basis for opinion section. And remember, if at all you are modifying, apart from these statements, you should also add another para. First, in the basis for opinion, first it will come. Why you are modifying the opinion? Basis for qualified opinion, basis for adverse opinion, basis for disclaimer. What is the exact reason you should mention? Correct? Next. Further, in the audit report, going concern para also might come. This para will come when material uncertainty is there. This going concern para income, MURGC para, we call it as MURGC, material uncertainty related to going concern. MURGC para we call. So material uncertainty related to going concern para will come as per 570. When we are discussing 570, I will cover there. Next, key audit matter para also will come. When? In the following three cases it will come. For listed entities, it is mandatory. Or if there is a requirement in law or regulation. In India, there is no law, there is no regulation where it says key audit matter is mandatory. If auditor feels, then also he can include key audit matter at public interest. That's auditor's choice. Then other information. We do not have in CA Inter 720 standard. At CA final, we have 720 standard. Next, you see, now what are the points that we completed? What are the contents that we completed right now? So we completed title, addressee, opinion, basis for opinion, responsibilities. Uh, remaining I will come to respect to standards, then I will write. Okay, fine. Then apart from that, so apart from that, so responsibilities for financials, nothing but management responsibilities. Management is responsible for financial statements preparation. Management is responsible for internal control. So no, management is responsible for assessment of appropriateness of going concern basis. Yes or no. This section identifies those responsible for oversight of financial reporting. Who are responsible for financial reporting? That also we need to highlight. And then we will get auditor responsibility section. Then we will come to auditor responsibility section. What auditor responsibility section will be there? If you remember, the order in which I am revising here is different from the normal GOAT notes revision marathon. GOAT notes revision marathon conceptual order is different, where I first discuss title, addressee, then opinion, different types of opinions. Drafting I will discuss basis for opinion, drafting of basis for opinion in different circumstances. Then I will discuss emphasis of matter, key audit matter, other matter para, 219 and standard. Then I will come to remaining elements of audit report. But this is for learning. Okay, yes or no, at least for getting a clarity. But after you got the clarity, any order you can follow for revision. Now, auditor responsibility section. Auditor responsibility section will have totally 3 parts. Primary responsibility, additional responsibility, communication responsibilities. Auditor responsibility section is divided broadly into 3 parts. Primary, additional responsibilities as per standards, and communication. Primary responsibility, we know, reasonable assurance, which is a high level of assurance but not a guarantee. Yes or no? And ultimately issue an audit report with opinion. That is primary responsibility of the auditor. Now, what are the additional responsibilities? Professional judgment and skepticism, identifying and assessing risk of MMS, understanding internal control, evaluating accounting policies, assessing going concern, evaluating presentation structure disclosures in case of fair presentation framework, describing division of responsibility in case of joint audit. Yes or no, group audit. Generally, this description we will give in other matter paragraph. We don't give it in audit responsibility section. Then apart from that, auditor responsibility section shall also talk about communication responsibilities. What are the communication responsibilities? Those of you who are watching the chart revision directly and watching this segment, if you are unable to understand, remember that in GOAT notes revision, okay, audit marathon, if you type, some 12 hours revision will be there. Inside that audit report topic, I detailedly explain each and every point. The learning order, conceptual learning order is different from revision learning order. That's it. Now, communication. We need to communicate to top management. What you need to communicate? Scope, timing, findings. We need to communicate regarding independence in case of listed entries. We should also communicate regarding key audit matters in case of listed entries. These are the various communication responsibilities auditor has. All these responsibilities auditor shall describe in auditor responsibility section in the audit report. Auditor responsibility section is also completed. Auditor responsibility section, responsibilities of management, audit responsibilities for audit of financial statements, both the sections are completed. So in audit report, under this what matter should come, that only we are discussing now. Okay, next, other information also we completed because it is not there in our syllabus. Okay, next, other reporting responsibilities. This is nothing but report on other legal and regulatory requirements. Report on other legal and regulatory requirements means what? CARO 2020, all that will come. Correct? Then finally, once reporting responsibilities are over, you need to sign. Engagement partner in personal name, he should sign. If a firm is appointed, personal name plus audit firm name shall also be included. Membership number should be indicated, firm registration number shall also be indicated. This is signature of auditor. Then place, city where the city sign, city where it is. Date of the audit report, you can mention the date not earlier than the date on which you obtain evidence. Your audit report should always be on or after you obtain entire evidence. So it cannot be earlier, and not earlier than financial statements approval by respective authority. So audit report date cannot be earlier than the evidence date. It cannot be earlier than the approval date. So it can be on or after that date only. Yes or no? Next, UDIN. All certificates and reports must have a UDIN, right? And sometimes law will give a specific layout. Suppose if at all audit report format is given in law, right now in India there is no law which gives audit report format. If at all there in future, can I talk about SA 700 in the audit report which is given as per the law? You can talk if all the above elements are there in the law format also. Are you getting it? That is what prescribed layout regarding law point. Not that required from exam point of view. Easy. So now if you see contents of the audit report once again, report on other legal regulatory requirement, we need to discuss CARO, all that, then only we can highlight that. Signature of auditor we understood, place of signature we understood, date of audit report we understood, UDIN also we understood. So predominantly audit report content is discovered. 700 format related content is covered. Now we need to discuss different types of opinion. Yes or no? Different types of opinion, and emphasis of matter paragraph, other matter paragraph, key audit matter, material uncertainty related to going concern. Correct? All this if we discuss, audit report topic will be predominantly over. Now, we all know that the opinions are multiple types. Yes or no? Unmodified opinion and modified opinion. Modified opinion is again three types: qualified opinion, adverse opinion, disclaimer of opinion. Now, unmodified opinion if you are expressing, by the way, remember again, modified report is different, unmodified report is different. Unmodified report, you see, reports, audit reports types. SA 700 talks about unmodified report. Unmodified report means what? You will give unmodified opinion and no emphasis of matter paragraph, no other matter paragraph, no material uncertainty related to going concern paragraph, no other information paragraph. All this must not be there and unmodified. Then only that report is called as unmodified. What is a modified report? Sir, I am giving unmodified opinion, sir, but I am also including emphasis of matter paragraph or other matter paragraph or other information paragraph or material uncertainty related to going concern paragraph. If any of this is included or all of this is included along with unmodified, you are not giving unmodified report. Therefore, it's a modified report. Not only that, sir, I'm not giving unmodified, I'm directly giving modified opinion. Also, the report is called as modified report. Now, modified opinion is three types. Directly we'll go to the definitions of modified opinion. Okay. So first of all, auditor will give which opinion? Forms of opinion, two types. Unmodified opinion. What is unmodified? It is issued when financials are prepared in all material respects as per applicable financial reporting framework. When modified opinion is given, two circumstances: financial statements are materially misstated. How do you know? Evidence is there. Or unable to obtain sufficient appropriate evidence to conclude that financial statements are free from material misstatements. Whenever you are giving unmodified opinion, no, you can use the word present fairly or you can use the word true and fair view. Both these phrases are treated as equivalent. Clear? Now, modified opinion we issue in two circumstances, right? We understood. Now let us understand, let us directly go to 705. Modifications to the independent auditor's report. Modifications to the opinion in independent auditor's report. What is this? 705. Scope and objective. I hope I'm not repeating it. Okay. Circumstances. Just now we saw two circumstances. Financials are not free from MMS, are unable to obtain sufficient appropriate to conclude that they are free from MMS. In these two cases we give. Now we have three types of modified opinion: qualified opinion, disclaimer, adverse. You see, disclaimer is given in only one circumstance. Adverse is also given in only one circumstance. But qualified opinion is given in two circumstances. One, material misstatement is there but not pervasive. Okay. Unable to obtain sufficient and possible effect of undetected MMS or material but not pervasive. Actually here it is MS only we should use the word. Misstatement is material but not pervasive. The possible effect of undetected misstatement or material but not pervasive. But when we are using shortcut, we use the word MMS. It's okay, not an issue. Okay, next, now first line, no, if I remove that and keep end pervasive, that's automatically adverse opinion. The second point is there, right? Inside that, not pervasive is there, right? If I just keep end pervasive, automatically it will come disclaimer. Easy or not? Now tell me, disclaimer opinion comes in rare cases where multiple uncertainties are there. Yes or no? Disclaimer is in a rare case. Now tell me, sir, modified opinion three types are there, na? Qualified, adverse, disclaimer. Which type of modified opinion? Which type of modified opinion is appropriate? Determining type of modified opinion, it depends on nature of the matter. Why are you modifying? Two reasons. Financials are misstated here. That is one reason. Or I am unable to obtain evidence. That is another reason. Any of these two reasons. Two, pervasiveness of the effect. So first one, nature of the matter. Either financials are misstated, that is the reason I want to modify, or I am unable to get evidence. Because of these two reasons, I decided to modify. Fine, you decided to modify. Which opinion you should give, qualified, adverse? It finally depends upon pervasiveness. So determining, so this itself can be asked as a 4 marks question. What are the factors that determine which type of modified opinion is appropriate? I already told in the class itself. Next, now what is meant by pervasive? Pervasive means what? Pervasive, okay, describes the impact of MMS. Pervasive means it is not confined to specific element, or if confined, okay, it is specific item only. Pervasive is only a specific item only, but it is substantial portion, or it is relating to disclosures which are fundamental. So pervasive is something that is not related to single item, or if it is single item, it is substantial, or it might be related to fundamental disclosures. Easy. Next, sometimes management might impose limitations on the auditor. Generally, whenever management impose a limitation, we request management to remove limitation if at all that limitation is leading to a modified opinion. Management, they refused. You communicate to top management and see, alternatively try to obtain evidence. Suppose you are unable to obtain evidence even through alternatives, and if possible effect is material but not pervasive, I will qualify the opinion. Okay, but if the possible effect is going to be pervasive and I'm not getting evidences, management impose limitations, I will withdraw if permitted by law. If withdrawal is not possible, then disclaimer of opinion. Correct? This is what we discussed. Next, communicate MMS before withdrawal. Before you withdraw, when you decided to withdraw, before you resign, just communicate what are all mistakes you found, because some few days you did audit, you might have found out some mistakes, right? Communicate to the management and then withdraw. This itself can be asked as a 4 marks question. Next, whenever we give a modified opinion, in audit report, modified opinion wordings has to be changed. Remember in that revision also I told how modified opinion, in the EVA batch and revision I showed audit reports, qualified opinion, adverse opinion, how side headings and all will change. So headings of opinion, basis for opinion sections will be reflecting type of opinion. So basis for like qualified opinion, basis for qualified opinion, adverse opinion, basis for adverse opinion, disclaimer of opinion, basis for disclaimer of opinion. Correct? Now again, whenever we are modifying opinion, we should modify basis for opinion section clearly. Generally, basis for opinion section will have one para only. What para will be there? We have audited financial statements as per standards on auditing. Our responsibilities under those standards are described in audit responsibility section. We are independent of the company. We comply with the code of ethics. We believe that the evidence obtained is sufficient and appropriate. Like that we discussed one drafting I showed. Yes or no? In the original revision, in the main revision, if you see, you will understand. That standard para will be there. Suppose if I am giving qualified opinion, this para will be there, the standard para will be there, and additional para also will come. Basis for qualified opinion, why you gave qualified, you should give reason. Basis for adverse opinion, why you gave adverse, you should give reason. Again, if you are giving disclaimer, in basis for disclaimer only one para will come again. The standard para will not come there. I told all this. Basis for that question is asked in Jan 25 exam. Jan 25 also this question has been asked. Okay, if auditor has expressed a disclaimer of opinion, what should be the content of basis for disclaimer of opinions? How basis for opinion para will change? Whenever you are giving disclaimer of opinion, auditor responsibility section also will change. That also will be discussing. Auditor responsibility section in disclaimer. Generally, auditor responsibilities means we talk about primary responsibility, additional responsibility, communication, so much we give. But when you are giving disclaimer of opinion, no. Auditor responsibility section will include only the following statements. Statement that auditor is responsible to conduct audit as per standards and issue report. Statement that due to matters in basis for disclaimer, auditor could not obtain sufficient appropriate evidence, and a statement on independence. And remember, whenever you are giving disclaimer, key audit matter shall never be included. If you are giving disclaimer of opinion, key audit matter communication is prohibited. Here. Now, basis for opinion. Suppose you are modifying opinion because of an MMS in financial statement, that to a specific amount is misstated. How you should modify, describe the mistake, quantify the financial effect. I showed qualified opinion, basis for qualified, inventory is misstated, the amount of inventory, quantification. State if quantification is not practicable. If at all quantification is not practicable, we should state that it is not practicable. Sometimes misstatement will be in the form of a narrative disclosure. Explain how the disclosure is misstated. Sometimes MMS is by non-disclosure. First I will ask management, discuss with the management, ask them what exactly they omitted. I will ask them to include. If they don't include, if possible, whatever their disclosure omitted in balance sheet P&L notes, I will disclose in audit report if practically possible. Next, Sir, I am modifying opinion because I'm not getting evidence. Then describe what exactly you did not get. And in case of disclaimer of opinion, basis for opinion shall not include reference to audit responsibility section, statement that evidence is obtained, reference to compliance with ethics, all that. Basis for opinion will have some items, no, some elements, no, just standard that will not be there in basis for disclaimer of opinion section when you are giving disclaimer of opinion. That's it. Any other matter that could have lead to modified opinion and whatever its effect shall also be included in basis for modified opinion. That's it. 705 is completed. And remember, whenever a modified opinion is expected, communicate with top management what circumstances lead to modifications and draft audit report wordings of the modification. Communicate to management. 705 is done. Easy or not? All of you? So typically I covered what are the types of opinion, under what circumstance opinions will be given, how basis for opinion paragraph will change in case of modified opinion, how auditor responsibility section will be modified in case of disclaimer of opinion. All that I have covered. See, this is a chart revision. Once again I'm alerting you. So here I am not giving detailed conceptual explanation. This is only a revision. This is a revision which you have to watch after finishing the previous revision or at least my GOAT notes EVO classes. Yeah. You're able to recollect, because you watched the class. You're able to recollect everything. Next. So with this 705 is also completed. Now let's understand emphasis of matter paragraph, other matter paragraph. Let's understand emphasis of matter paragraph, other matter paragraph. 706. Emphasis. What is emphasis of matter paragraph? It's a paragraph in audit report referring to a matter appropriately presented or disclosed in financial statements, judged as fundamental to the user's understanding. Who will judge this? Auditor. So whatever according to me, whatever matter is fundamental for user's understanding, I will draw that matter in my audit report. Yes or no? Conditions. That matter you can emphasize only when you don't modify on that, and that is not decided as a key audit matter. And how to present it? Emphasis. Present it with a separate section with a heading called emphasis of matter. Clearly express the matter and give reference. State that your opinion is not modified. Emphasis of matter paragraph is not a substitute for modified opinion, not a substitute for disclosure in financials, not a substitute for MURGC para as per 570. See? Then other matter paragraph. What is other matter paragraph? It refers to matters other than those presented or disclosed in financials, but relevant for users' understanding about audit, auditor's responsibilities, auditor's report. Even for this also I spoke. Branch audit, SBA example, 12, all that big example I gave. Yes or no? When other matter paragraph has to be used, not prohibited by law and not decided as a key audit matter, then only other matter paragraph can be used. Presentation. Even other matter paragraph shall be given in a separate section in the audit report with a heading called other matter. And remember, whenever you decided to use EOMP, OMP, you shall communicate with those charged with governance regarding the expected wordings of the paras. Yes or no? Then you see, emphasis of matter paragraph is completed, other matter paragraph is completed. Remember, I told in the main marathon detailed example on SBI, joint audit, branch audit, 6,000 branches. Yes or no? Head office, 12 joint audits. That entire comprehensive example I have taken. Next, in the revision also it is there, na? Audit marathon revision also it is there, na? GOAT notes marathon revision. In class it is there, of course. In class obviously I'll tell. Next. Now, other matter paragraph is also completed. Now let us go to key audit matter. Okay. Key audit matter. Just 1 minute. Yes. 701. Communicating key audit matter in the independent audit report. What is a key audit matter? Matters which are communicated with those charged with governance which require significant attention of the auditor. Yes or no? Key audit matters are those matters which are communicated to those charged with governance. Key audit matters are those matters which are communicated to those charged with governance in professional judgment of the auditor were of most significant in the audit of current period. No, and these are the matters which are selected from the matters communicated with those charged with governance. And remember, we shall not use a key audit matter if a disclaimer of opinion is issued. And it is mandatory for listed entities, or it is mandatory when there is a requirement in law, or if auditor's choice. If auditor want to include a key audit matter, he can include it. Correct? What is the purpose of key audit matter? Enhances value, transparency, for better understanding, users understanding about important areas in the audit. And key audit matter is not a substitute for financial reporting framework disclosures, not a substitute for modified opinion, not a separate opinion on the individual matter, and not a substitute for MURGC para as per 570. Next, how do you determine key audit matter? Of course, it's a matter of professional judgment of the auditor, but you can select it from high risky areas where significant management judgment is involved or significant event or transaction is. How to present a key audit matter? Separate section with the title key audit matter. Introduction you should give. State that key audit matters are most significant in current period audit, and state that in the context of audit as a whole, we are not giving any separate opinion. Description for each. Why it was a key audit matter, how the auditor addressed it. How to describe key audit matter I showed. SBI, various examples. What is key audit matter and why it is key audit matter? How we addressed it in our audit. That's a presentation. Next, communication. The auditor must communicate to top management whatever key audit matters you identified. Suppose if you decided there are no key audit matter, mention them that there are no key audit matters. Clear? All of you? Over 7 after 1. Easy. Quick recap. Next. So typically we completed key audit matters also completed, right? Now we need to cover 570. But before that, I will discuss 299. 299, 710 also will cover. Then we'll go to 570. 710 I'll cover at last. Okay. 299 I'll cover. Joint audit. Yes, you see, joint audit. 299, joint audit of financial statements. Joint audit involves 2 or more individuals or firm auditing the financial statements. Yes or no? More in depth about joint audit with different examples I gave in original class on marathon. It aims to pool resources, expertise, all that. Advantages: shared expertise, lower workload, healthy competition. In the recent May 25, advantages and disadvantages. Some question has been asked. Advantages or disadvantages? Something is asked. Disadvantages: fees is shared, psychological issues, coordination challenges, uncertain about the liability for common areas. What is the responsibility of joint auditor? Individual or separate responsibility. When the work is divided, each auditor is responsible only for the work allocated. Allocation can be in the between assets and liabilities, income and expenditure, areas, units, period. You know, in the printed book, no, this also this side heading also came as a point in the printed one. Like this, minor improvements. At overall, it's less than 5 or 6 only. In the following cases, combined responsibility. Work is undivided, or collectively decision has been taken, or in statutory requirements, whether financial statements are as per applicable framework or not, collective responsibility for verifying presentation and disclosures, and for ensuring audit report is as per appropriate standard. In all these cases, joint auditors will have a combined responsibility. Correct? Now, audit reporting. Generally, joint auditors will give a single report. But remember, a joint auditor is not bound by majority. He can issue a separate report cross-referencing each other in other matter paragraph. Next, coordination. Proper coordination is essential between joint auditors. Matters affecting other works, other auditors' works, this auditor has to communicate before the reported date. Each joint auditor can rely upon the other auditor's work. I don't have to verify his work. I can trust him. And if at all, if I find something important for other joint auditor, I must communicate him. That's my responsibility. Coordination. Next, there are some special consideration. All the engagement partners from each audit firm shall be involved in planning. Overall strategy. All the joint auditors shall develop overall audit strategy. All the joint auditors shall develop a joint audit plan covering allocation of resources, common areas, reporting factors, preliminary engagement activities, all that. All the joint auditors must do risk assessment and communicate with each other. All the joint auditors have to document common areas, specific areas, all that. Joint auditors, common letters, common engagement letter, common management representation letter, work allocation must be documented, signed by all, and communicated to those charged with government. 299 is completed. See how quick we are able to finish. Next, we'll go to 570. Go to 570. Because 570, this material uncertainty para, the discussion will be there. 570 standard is there in this chapter, completion and review chapter, but we will be discussing as a part of audit report. Okay, 570, going concern. Actually, who has to significance of going concern in financial reporting? What is its importance? If entity is a going concern, assets and liabilities are recorded at normal values. historical values in case of fixed assets, normal, cost or NRV, whichever is lower, like that. But if entity is not a going concern, financial statements has to be prepared must and should on liquidation basis. Inventory shall be written down to NRV. Assets will be recorded at expected values. Sometimes company going concern is not there, but company prepared on historical basis only financials, but they gave a disclosure that going concern is missing. Disclosure is not sufficient. If going concern is not there, just a disclosure in financials is not sufficient. Financial statements has to be prepared on liquidation basis. Suppose if going concern is missing, company going concern is not there, and financials are prepared on historical basis, and they gave a disclaimer that they gave a disclosure that going concern is missing, still financial statements are materially misleading, you will give adverse opinion. Are you getting it? Disclosure is there or not doesn't matter. Suppose if financial statements are prepared on liquidation basis, now financials are true and fair, you can give unmodified opinion and highlight an emphasis of matter paragraph regarding the basis for preparation. Financials are prepared on liquidation basis, right? That you can highlight an emphasis of matter paragraph. Like for this, I will go to GOAT notes once. So I will show you in the GOAT notes how to present going concern. See here, I have given a diagram. This I didn't put in chart notes. Okay. See, what exactly we need to do in going concern. First to know whether company is a going concern or not. Management has to do a preliminary assessment. Yes, they did assessment. They identified events on conditions. Yes, some events are suppose events are not identified, I will check whether they did proper assessment or not. Okay, and if going concern is appropriate, then I will give unmodified opinion. Suppose no, they identified some events, I will perform further audit procedures. Okay, after performing further audit procedure, I will decide whether material uncertainty exists or not. Suppose no, material uncertainty not existing, though events are there, some loss is there, but that's not a going concern issue. Then see whether financial reporting framework require disclosure. Yes, it required disclosure. Then did the management disclose or not? I will check. Yes, they disclose. Then I'll give unmodified opinion. Suppose they didn't disclose, material uncertainty is not there, but events and conditions are there. Disclosure requirement is there, but they didn't disclose. Since they didn't disclose which is required to be disclosed, I will give modified opinion. Suppose no, applicable framework does not require any disclosure, and they didn't disclose. No requirement, and they didn't disclose. No material uncertainty, I'll directly give unmodified. Suppose no, material uncertainty exists. Now I will now material uncertainty. If I further investigated, I went for further investigation, I found out that going concern is not appropriate. Then, and the fact is not disclosed. It's not just disclosure, not disclosed and accounted. Accounted must be on liquidation basis. Or no, they didn't disclose and they didn't account on liquidation, directly I will give adverse opinion. Suppose no, they disclosed, going concern is not appropriate, they disclosed plus accounted on liquidation basis, then I will give unmodified opinion. On emphasis of matter paragraph, I will highlight the liquidation basis of accounting. This question was asked in CA final in one of the exam. Okay, it was asked in May 25 or May 24 or November 24. In one of the attempt, this was asked, this particular question. It's not there in CA Inter, it's not there in CA material itself. This situation is not given in the material itself, but I highlighted here. I told this in the class also. Suppose going concern, material uncertainty exists, but going concern is still appropriate, not an issue. Uncertainty is there, but when I went further, it is appropriate. Management can handle the situation. And they disclosed it very clearly. Uncertainty they disclosed. Right now it is appropriate. Air India situation example. Yes or no? Then I will give unmodified opinion and I will highlight the same in the material uncertainty paragraph. Suppose no, material uncertainty exists. Going concern is appropriate still, but uncertainty is not disclosed in financials. Then I will give qualified opinion or adverse. Yes or no? This entire going concern. Suppose no, management itself assessment, they are not doing going concern assessment itself. Management not doing, even I asked them to do, they are not doing at all. Again I will give modified opinion. They did, I will evaluate the assessment. Now come back to the chart. Okay. So what is whose primary responsibility for assessment of going concern? Management. Management must assess their ability to continue as a going concern. This is required even if financial reporting framework is silent on it. Sir, accounting standard does not say, so I didn't do going concern. You can't say that. Now remember, going concern involves making judgments about uncertain future outcomes. Correct? Going concern is nothing but making judgments about future. Now these judgment is affected by various factors, because you are judging about future, that is affected by various factors. Degree of uncertainty, it increases with future date. Entity specific, size, complexity, nature, these are all various factors that will affect management's judgment about going concern. There are various factors which will affect management's judgment about future. Degree of uncertainty, entity specific factors, timing. Judgments generally, when I take any decision on going concern, that is based on information available right now. This might become invalid later. Yes or no? Later these events will give a different outcome also. These are all various factors that will affect management's judgment about going concern. What is the objective of auditor? Very simple. I have to obtain sufficient appropriate evidence on management's use of going concern. Management prepare financials on going concern basis. I have to get evidence that is it a going concern or not. When I am getting evidence, I will conclude whether any events or conditions exist which may cast a doubt on going concern. I will try to check, and I will report findings as per. This is the objective of the auditor. This objective itself can be asked as a 4 marks question. And remember, factors affecting judgment itself can be asked as a 4 marks question. Clear? That's it. Significance of going concern in financial reporting. This itself can be asked as a 4 marks question. Next. Now, okay. So I understood it is management primary responsibility, all that. What auditor has to do? You do risk assessment. What I will do in risk assessment? Auditor shall consider whether events or conditions during the risk assessment. I will do whether are there any events or conditions that cast significant doubt on going concern. Events or conditions means what? There will be financial events, operating events, other events. In the recent exam, some operating event or some question has been asked. So what are the financial event? Company has a net liability, borrowings are maturing, negative operating cash flow, operating losses, inability to pay creditors, non-compliance with loan terms and conditions, we are defaulting. These are all various financial indicators. Operating, company itself want to liquidate, loss of key management, labor difficulties, shortage of supplies, new competitors, strong competitors, emergence of highly successful competitors. Other, non-compliance with regulatory norms, pending legal cases, changes in laws. Remember Paytm example, Paytm payment back example and all I told in class. Yes or no? So these are various events. Now, so auditor, in risk assessment, we try to identify whether these kinds of events and conditions exist that may cast a significant doubt on entity's ability to continue as a going concern. Now, so for this, what auditor has to do? First, I will evaluate management's preliminary assessment. If management already performed, I will discuss the assessment. I will see whether any events are there, and I will also evaluate what management is having future plans. Suppose management did not perform, I will ask them why they did not perform and how they used going concern without checking going concern, and inquire about any events and conditions are identified. So we have to remain alert throughout the audit for identification of events or conditions, nothing but symptom. Now, management performed assessment. Evaluate management's assessment. See whether company can continue as a going concern. Remember, it is not your responsibility to do assessment. Yes or no? No need to rectify lack of assessment by management. If management does not do a detailed assessment, you don't have to sit and do detailed assessment. Yes or no? But auditor may conclude on appropriateness of going concern based on whatever information available. Yes or no? Auditor may need to evaluate management process assumptions, and in some cases, you may have to do a detailed evaluation. Next, period. Whatever management assessment period is there, for the same period you will also assess going concern. Suppose if minimum 12 months you must assess. If management assesses for less than 12 months from balance sheet date, minimum 12 months they must assess. Now, okay, you assessed going concern from the management. What happened? You found out events. You found out events or conditions. Some symptoms are found. What to do? When events and conditions are identified, get an evidence that whether a material uncertainty exists. If auditor identifies any events or conditions, auditor has to obtain sufficient appropriate evidence regarding material uncertainty whether exists or not. For that, auditor has to perform additional procedures. Additional procedure: request first management assessment, evaluate likelihood and feasibility of management plans for future actions, analyze cash flow forecast like reliability of data, support for assumptions. Jan 25 exam, this question was asked. Okay, in Jan 25 exam, this question was asked. So auditor has to analyze cash flow. What are the points auditor has to analyze in this? 3 marks question they asked. Okay, reliability of data, support for assumption. Consider additional information, written representations about the plan's feasibility, all that. Examples: financial analysis, loans and financial terms, legal and regulatory, governance and commitments, all that. These are the various examples of additional procedures which I perform. After performing additional procedures, now you will get an idea, material uncertainty there or not. What is material uncertainty? First of all, what do you mean by material uncertainty? Magnitude of potential impact and likelihood of occurrence is such that appropriate disclosure is required. The uncertainty magnitude, that impact is such that disclosure is required, then it is called as a material uncertainty. So evaluate sufficient appropriate evidence and conclude appropriateness of management use of going concern. Suppose if auditor identified material uncertainty, get sufficient appropriate evidence and see whether going concern is appropriate or not. So conclusion, conclude whether material uncertainty exists. Is there any doubt on going concern ability? Now okay, material uncertainty is there. Then auditor has to check whether financials are adequately disclosing. If material uncertainty exists, determine whether financial statements are adequately disclosing and clearly disclosing that there is an uncertainty and its impact. And management has to specifically make a statement that they cannot realize its assets and liabilities in ordinary course. And if no material uncertainty, see whether financial statements are disclosing about events and conditions, if at all there is a disclosure requirement. Finally, reporting. Suppose going concern basis is inappropriate. Management prepared financial statements using going concern, not on liquidation. Normally they prepared. So, they prepared normally and they didn't talk anything about going concern. Right away, adverse opinion. Use of going concern is appropriate, but a material uncertainty exists. You know what? The financials also clearly disclosing honestly. I will give unmodified opinion and I will also put a separate side heading, material uncertainty related to going concern. Like that, I'll put a separate side heading and draw attention to that point, stating that material uncertainty is there and auditor's opinion is not modified here. Aid in the audit report I showed. Next, inadequate disclosures. Suppose material uncertainty is there, but going concern is appropriate. But uncertainty is there, but that uncertainty they didn't disclose in financials. Misleading, either qualified or adverse depending upon the situation, and basis for qualified or basis for adverse opinion shall state the impact. That I-70 standard is over. Clear all of you? Now again going back to audit report. So typically 570 is over. Now we are left with what are all? 710 and CARO mainly. Two other important areas that we are left with, 710 and CARO. In 700, some introduction discussion is there. That's it. If that also we quickly revise from the chart, it is done. And remember, once again, I'm telling for the online viewers, this is a chart notes quick revision only. Don't expect too much of explanation in this. Here I'm only revising. So if you want explanation in the revision itself, I have 12 hours marathon which is already uploaded, 80% already. So for example, I'll just show you. Audit marathon, if you see, so the first one, you see the green one, this one, so 11.5 hours is there. So that one you need to watch. In this, with examples and all I discussed little conceptually. Okay, all the dots will be connected. After watching that only you should watch this. Okay, we'll continue in the next session the remaining topics. Yes, let's continue the discussion on audit report topic. So we are still left with one more standard in this particular topic, 710. Comparative information. The standard heading is actually comparative information, and there are two things which are involved in comparative information. One is corresponding figures, another one comparative financial statements. There are two things involved in comparative: corresponding figures and comparative financial statements. See, typically the standard is only dealing with comparative information. These are approaches, and we have already discussed in our previous main detailed revision. Corresponding figures means in this approach, the auditor will give opinion only on the current period figures. He will not give opinion on the previous year, prior period figures. Whereas in comparative financial statements, the auditor's opinion covers all the periods mentioned in the financial statements. And you know what? In Jan 25 exam, comparative financial statements question was asked, but the question was framed negatively, wrongly. The question was wrongly framed. The answer they gave is this one. Compared corresponding figures answer only they gave. Because comparative financial statements is not really there. It's a special purpose framework. Technically speaking, there is no framework in India or anywhere in the world where auditor has to give opinion on all the periods reporting the financial statements. It is generally happening in special purpose engagement, in special purpose audits only. So compared to financial statements is not really practical. Anyhow, we'll be solving question bank there. I will show you. Okay, now, so corresponding figures is what mainly predominantly important in exam point of view. So first of all, what is a comparative information? These are the amounts and disclosures of prior period. Amounts and disclosures of one or more prior period included in financial statements of the current period. Now, what is the nature of comparative? Comparative information nature is decided by framework. There are two frameworks: corresponding figures, comparative financial statements. In corresponding figures, opinion refers only to current period. In comparative financial statements, opinion refers to each period. Yes or no? Which approach we have to follow? Generally decided by law. In India, the law says corresponding figures approach. The auditor has to give opinion on the current period only. Therefore, the approach is corresponding figures. Next. Now, audit reporting. Now, important. Like, what is the reporting requirement from auditor's point of view in case of corresponding figures approach? Generally, the prior period figures, what is first of all corresponding figure means? Corresponding figure means where prior period figures are presented, which has to be read only along with current period. What detailed prior period figures are presented, how detailed, it is decided by current year figures. Now, auditor's opinion does not refer to corresponding figures normally. Normally, in our audit report, we don't talk anything about corresponding figures, but there are 4 circumstances, 4 exceptions where we talk about corresponding figures. Exceptions. What are the exceptions? Suppose prior period financial statements were audited by a different auditor, not our audit firm, a different audit firm audited. Then we include in other matter paragraph statement that predecessor auditor audited, opinion he gave, and auditor's report to date. Getting it? If at all prior period financial statements were audited by another auditor, that fact has to be mentioned in audit report in the current period in other matter paragraph. See, generally prior period related information we don't have to talk. But if prior period is audited by another auditor, we refer. Second one, prior period is not at all audited. We state that in other matter paragraph that prior period financial statements were not audited. However, remember, just because you are making this statement, doesn't reduce fight and responsibility. You still have responsibility to obtain evidence for opening balances. And third scenario, material mistake is there in prior period. Suppose if there is a material misstatement is there in prior period and it is still uncorrected in the current period, the same mistake carry forwarded. And if you think it is material and pervasive, accordingly give a qualified or adverse. Suppose in current period it is corrected. It is corrected, then no need to worry. Next, suppose there is a prior period, auditor itself gave a modified opinion. Like prior period mistake is there or something is there, auditor gave a modified opinion, and the reason whatever the reason that is unresolved. What reason the auditor gave modified opinion is still unresolved, then current year also you have to modify the opinion depending upon the severity of the matter. And in the basis for modification, refer both to current and corresponding figures. Getting it? Otherwise, explain impact on comparability. See, if at all it is material in current period, we modify the current period opinion, and in the basis for modification, we tell that prior period unresolved matter is there, all that. Suppose in current period it is not material. In current year there is no impact. Even then we will give modified opinion because comparability is affected. Last year one is a materially misstated. This year one is of course free from MMS. It has an MMS. It has a misstatement but not material. So technically current year there is no modification required, but comparability is affected. For that reason we need to give a modified opinion. That's it. So generally the current period audit report need not talk about prior period figures, all that, but there are 4 exceptions and these are the exceptions. Clear? And for more clarity, just read from the main quote notes. That's it. Then generally, what is the audit procedure for comparative information? Remember, many students in the standard they confuse. Comparative information is the main standard heading. Corresponding figures is one approach. Comparative financial statements is another approach. Technically, all are comparative information only. Audit procedure for comparative information is the right question. There is no audit procedure for corresponding figure, no audit procedure for comparative financial. Audit procedure is same because it's a comparative information. Now, what is the audit procedure? Ensure that prior period amounts and disclosures are included and properly classified, and they are matching with prior period balance sheet. 2. Verify accounting policies consistent or not. Same policies followed in the current period or not. Perform additional procedures if any material misstatements are identified in comparative information. If prior period financials are audited by same auditor and if there is a mistake, first try to resolve prior period financial statements directly by 560 procedure and get a written representation for all the periods which are mentioned in the financial statements. Clear? That's it. And specific prior P&L items. Specific prior P&L means nothing but you need to get a specific written representation for prior period items. Especially for prior period items, the auditor has to get a specific written representation. A general representation you get, whether all the comparative information is correctly classified, presented, all that. For prior period items, you will ask a special representation that all the prior period items were identified and rectified, adjusted accordingly. That's it. This is 710 standard over. Easy. So more in depth I have given, no, I think in the main marathon I have not given any discussion. I think so. 710 I have not covered in the main marathon. I'm not sure. Hey, no, covered. Yes, I covered. That's it. So with this, all the reporting standards were completed. In audit report chapter, if you see, all the reporting standards were completed. Hardly it took 45 minutes. All the standards, 700, 701, 705, 706, 299, 570, 710. No. 700, 701, 705, 706, 710, 5. 299, 570. 7 standards we covered within just 45 minutes. Okay, next. Then, audit of branch office accounts. Now let's begin audit of branch office accounts. Who should do audit of branch accounts? See, first of all, a company need not maintain separate books per branch. Centralized they will maintain. Today almost all the companies maintain centralized. There is no compulsion for maintaining branch accounts. If at all a company is maintaining separate branch accounts, then and that branch also can be audited by same auditor. You need not have a separate auditor for that. The entire head office and branch is all put together. Single person can audit. There is no compulsion that branch has to be audited separately by another auditor. But if a company branch has to be audited by a separate auditor, then they can appoint a branch auditor. That is when the concept of branch audit comes into picture. Clear? Who can do branch audit? Main company auditor himself can do, or another chartered accountant can do. Yes or no? Who will also be appointed in the same manner? 139. Foreign branches, company auditor can do, or a chartered accountant can be appointed, or local qualified person in that country, we can appoint him also. Not an issue. So branch auditor, no, he will report to company auditor. Fraud reporting, everything will also apply to branch auditor. CARO reporting, everything will be applicable to branch auditor. Understood, everyone? Now, whenever there is a concept of branch audit, there is a standard 600 which is applicable. In-depth standard of entire 600 is there in CA final. In CA inter, we only have few procedures. Principal auditor's procedure, only this discussion is there in CA inter. Okay. What principal auditor? Suppose the moment you get to know that there is a branch auditor, first you have to inform branch auditor how his work is going to be used and make coordination at the planning stage itself. At the beginning of the audit itself, communicate him how his report is going to be used, by when he should complete his audit. Communicate special considerations, reporting, timetable. Tell him what are the special areas he should focus on in this company. Tell him, his report is considered. Also tell him by what time he should complete the audit. And review his procedures, other auditors' procedures and findings. He has done some audit procedures, right? He has found some important issues, right? If you want, you can review that. Getting it? Provided he is ready to show working papers. Next, perform additional procedures if necessary based on engagement or competency. Any other additional procedures, all that. And if you want, you can visit also the particular branch and directly communicate with him. These are principal auditor's procedure. Who is a principal auditor? He is an auditor who is reporting on entity financial information. Entity financial information includes what? Components information which is audited by others. Who is other auditor? He is a component auditor who audits component financial information, where that information is included in financial statements audited by principal auditor. What is a component? From normal division and branch standalone financial statements point of view, subsidiary, associate and joint venture consolidated financial statements point of view, they are called as components. See, more in depth about this I already told in other matter paragraph explanation where I took SBI example, all that. Yes or no? Next. So that's it. Using another auditor's work, obviously principal auditor can rely upon other auditor's work. You can absolutely trust his work. If at all something goes wrong in his work, he is only responsible. You don't have to be, because there is a division of responsibility in joint audit and branch audit. Division of responsibility will be there. Clear understanding of roles, like when you're working, when you're using other auditors work, you should clearly understand what is your role, what is his role, all that. That's it. Okay, in this mostly this is what this third point is only important from exam point of view. So with this, all the reporting standards and this basic content is all covered. Now we need to discuss about reporting requirements under Companies Act. We need to discuss about reporting requirements under Companies Act. Like you see, this standard at the beginning I told is divided into two parts. Part 1 reporting standards, part 2 reporting requirements. This is reporting requirements. Now we are going to discuss. So what are the reporting requirements? What are the reporting requirements? Part 1, 143 section talks about reporting requirements. In this we have these sections: subsection 11, subsection 3, subsection 1. There are 6 inquiries, and 143 subsection 3, 16 matters. CARO, 21 matters. Getting it? On all these 3 you have to give a report. 6 matters only if it is negative you have to comment, whereas remaining 16 positive or negative, both you need to comment. CARO, positive or negative, both the opinions you need to give. Whatever it is, you have to comment. Getting it? Totally, approximately we have 21 plus 16, 37, 43 matters we need to comment on. Totally 43 matters we need to comment on. Where this reporting requirements will come in audit report, if you go to SA 700 comprehensive format I gave, inside that one item is the report on legal and regulatory requirement. Under that heading in the audit report you should give. Technically audit report will have part 1 and part 2. Report I'm talking. Audit report will have part 1 and part 2. First one, part 1, report on financial statements. This is report on legal and regulatory requirement. This is also called as other reporting requirements. Under this section, CARO, everything will come. Clear? And I already showed this in the audit report topic also. Now, so there is a section called 143 subsection 2. That is only the section which says that auditor has to give an audit report. This section only says that auditor has to report whether financial statements are giving true and fair view of state of affairs, P&L, cash flow, all that. Auditor has to report to the members. The law itself says to the members you need to report. Getting it? Then there are various matters. 143 subsection 1, reporting requirements, inquiries. Auditor has to inquire into the following items. 6 items were there. Loans and advances. Okay, whether they are properly secured, terms are not prejudicial or not, you need to check. Are they prejudicial or not prejudicial? Check out. 2 points. Book entries, depreciation, provision for bad and doubtful debts, reserves, prepaid expenses, outstanding expenses. These are all book adjustments. Whether these book entries are prejudicial. Prejudicial means favorable or unfavorable, reasonable or unreasonable. Simple. Prejudicial means unreasonable. Not prejudicial, are they fine? That's what. See, this question, one student asked, sir, not prejudicial is there? In some books, prejudicial is there? Terms are prejudicial is there or not? It can be expressed in any way. Is it good or bad? Is it good? Check out. Or is it bad? Check out. Both are same. Yes or no? Next, shares. Suppose if a company is selling shares and securities at less than purchase price, means loss. They purchased at some price and sold at another price. Forget about market value. At market value is how much and what is the selling price? It doesn't matter for you. Less than purchase price, a company is selling the shares and securities. Then observe that. Remember, this point is not applicable for banking companies and investment companies. Then loans and advances. Company gave loans, but they shown as deposits. Check whether they were classified as deposits. See whether personal expenses were charged to revenue. Nothing but P&L account. Personal expenses of whom? Directors, all that. Shares. Verify, shares for cash. If a company has allotted shares for monetary consideration, shares allotted for cash, verify whether cash is received. If not, see the position stated in the balance sheet correct or not. Suppose for positive response, ignore it. For all negative response, you must give a negative answer with explanation. What is the reason? All that. Simple. 6 matters we have completed. Yes or no? 6 inquiries. Then additional reporting requirement 143 subsection 3. Here this we call it as checklist item. We also call it as checklist item. We also call it as affirmations by auditor. So what auditor has to? Very simple. Whether information and explanation, whatever auditor want, did he ask, sought and obtained? If any information you did not get, what information you did not get and what is the effect of it? Then whether proper books of accounts maintained or not, check out. Branch related returns received or not, check out. Yes or no? See, branch audit report. Have you considered it? Have you considered branch audit? Suppose if a company has a separate branch auditor, branch audit report is there. Is it given to you? Have you considered that in overall audit report? That you need to check. Whether balance sheet and P&L agree with books of accounts, whether financial statements comply with accounting standards. Do you have any adverse observation, any comments on the functioning of the company? Are there any transactions? Are there any activities which have adverse effect on the functioning of the company? Check out. And is there any director who is disqualified? And any other matters related to accounting records. Do you have any objection on the accounting records? In our class also I told you this is a repetition point. Yes or no? Are proper books of accounts maintained? Do you have any objection on accounts? Both are same. I told already in the class. Yes or no? Then you need to give a report on IFC. You need to talk about whether internal financial controls are adequate and are they operating effectively. And remember, IFC does not apply to one-person company, small company, private company with a turnover and borrowings. Turnover less than 50 crore, borrowings. So if at all I'm doing an audit of private limited company whose turnover is less than 50 crore, whose borrowings are less than 25 crore, I don't have to report on this I point. Actually ABCD I. Okay, IFC point will not apply to that private limited company. I don't have to comment upon it. For all other companies, IFC point I will comment. Yes or no? And any other matter. Rule number 11 identifies with different varieties of matter. Did the financial statement disclose impact of pending litigation? Did the financial statements recognize all the provisions for foreseeable losses, long-term contracts, derivative contracts? Is there any delay in transferring amounts to IEPF? Actually, these are main points, ma. Okay, then this, auditor has to verify funding party, intermediary, all that. You need to get a representation on specific funding or intermediary transactions, yes or no, and any assurance on that. So regarding this, more in-depth explanation I gave in the main marathon. Like there will be funding party, they'll be giving funds to some intermediary, the intermediary will be giving funds to ultimate beneficiary. So, and most of these transactions will be disclosed in the financial statements itself. Apart from that, are there any transactions? Director said no, get a representation. So this point is asking, get a representation that apart from whatever is disclosed in financial statements, no other transactions were lended or sent or received. Able to understand? And moreover, in schedule 3 under additional regulatory information, wherever your company acted as a funding party or intermediary, or wherever your company acted as a funding party or intermediary, the details has to be shown. Clear? Next, whether the dividends declared by the company, are they in compliance with section 123 of the provisions or not, and whether the company is using audit trail feature or not. It is mandatory, yes or no, and the feature must not be tampered. It must be preserved for statutory requirement. And see here, reporting must be either positive or negative. If it is positive, report positive. If it is negative, report negative. If at all any point is not applicable, ignore. Wherever you are giving negative, give reasons also. That's it. 143 subsection 3 is completed. Then we have another reporting requirement, 143 subsection 12, fraud. If auditor identifies fraud more than or equal to 1 crore, you have to report to central government within 60 days. ADT 4. Suppose if the fraud is less than 1 crore, you need to report to board of directors. Yes or no? Or audit committee, as the case may be. If audit committee is there, you will report them. If audit committee is not there, to board of directors, you will report them. Yes or no? That's it. Next. And remember, the fraud matters you should also report simultaneously in CARO. Getting it? CARO means what? We'll discuss. CARO is one more reporting requirement as per 143 subsection 11. 143 subsection 11 gave power to central government. Okay, where central government can notify any matters on which auditors will report on. Accordingly, central government has notified CARO 2020. Okay, so what is this CARO 2020? It has 21 clauses. Each clause is dealing with different reporting requirements. Clear? Just 2 minutes. Yeah, we'll continue discussion on CARO 2020. We totally have 21 clauses, right? Clause number 1, fixed asset. Fixed assets, it is talking about 5 types of issues. First one, whether fixed asset register maintained or not. Whether the company is maintaining register containing proper details, all particulars, location of fixed assets, everything. Then physical verification aspect, whether physical verification is done at proper intervals, reasonable intervals. Actually, the standard uses the word reasonable intervals. If not, and if any discrepancies were found on physical verification by the management, whether they were rectified in the books of accounts or not. Third issue, title deeds issue. That too with regard to immovable property. Title deeds of immovable property. Whether title deeds are in the name of the company or not. Next. Sometimes companies will go for revaluation of PP intangibles. Whether are they done by registered valuer checkout. Suppose if there is a change is, if the change after and before evaluation, the change is more than or equal to 10% in net carrying value of each class of asset. Yes or no? Specify amount of change if change is more than or equal to 10% of net carrying value of each class of property, plant and equipment and intangibles. And benami transaction, whether any proceedings initiated, are they appropriately disclosed in the financial statements or not. Next, inventories. So 5 issues. By the way, remember, anything can be asked as a question. Okay. Yeah. Next, inventories. There are 2 issues. Physical verification, whether the inventory verification is done at proper intervals. Check out. If there is any discrepancy more than 10% in aggregate of each class of inventory, each class of inventory means what, by the way? Raw material, work in progress, finished goods. Yes or no? So the auditor has to, whether they were properly dealt in books of accounts or not, check out. Working capital loans, whether working capital loan sanctioned in excess of 5 crores. Remember, sanctioned loan only they are asking. They are not asking about outstanding loan, drawing power. No, sanctioned loan, sanctioned limit. And remember, when you are taking working capital loan, funded loans and non-funded loans, both you have to take. Funded means those where you withdraw, where you can withdraw. Guarantee is a non-funded. Yes or no? Guarantee is also to be considered. Any temporary guarantee, letter of credit, for example, letter of credit is it? That's a working capital guarantee. It's a working capital related guarantee. Suppose I want to import goods from outside India, so bank will give a guarantee, letter of credit to the other importer. So he will send the goods to me. Exporter, he will send the goods to me. I am the importer. Exporter want to send the goods to me. So he is doubtful whether I will make a payment or not. So banker gave a LOC. That LOC amount is also to be considered in working capital limit. Able to understand? Like this, a practical question came in CA final recently. Next, and so if at all more than 5 crore worth of working capital limit is sanctioned, then what auditor has to verify? Whether quarterly statements, returns which are filed with the banks, are they matching with books of account? For most of the banks, now they are matching. Earlier, no, when this provision for the first time came, many banks did not, many companies did not have matching numbers. What they file with bankers is different from what they show in the books of accounts. And remember, these 3 points, title deeds point, revaluation points, benami transaction points, these are also to be disclosed in Schedule 3 under regulatory information. In Schedule 3, company has to disclose these 3. And of course, auditor also has to report on these 3. In this also, the second point is there, right? Every company has to disclose on this in their financial statements, notes to accounts under regulatory information. On the same, auditor has to comment in CARO. Clear? Next, loans, advances, investments and guarantees. What is this? Whether company has provided loans or advances in or loans or advances in the nature of loans. Okay, so secured, unsecured, doesn't matter. Getting it to any other entity. If so, breakup between related parties and others. Actually, the standard, the CARO does not use the word related party. They actually use the word subsidiary, joint venture, associate. Okay, that's what they use the word, exactly speaking, subsidiary, associate or joint venture. Subsidiary, associate, joint ventures, we simply call them as related parties. So for the sake of convenience, we use the word related party. Next, okay, so the audit, whether the company has given loans and advances to them, you show breakup. How much amount is given, how much amount is given, how much is outstanding at the end. Next, see the terms and conditions are not prejudicial to the company's interest. See that they are favorable or unfavorable to the company. See that receipts are regular. Like you gave the loan rate, company gave a loan rate. Are they recovering regularly? Check out. If any amount is overdue for more than 90 days, whether the company has taken reasonable steps to recover them or not, check out. Next, sometimes the companies will give renewals or extensions for the same loans. Like they gave loans, right? They are not paying. So for that, company would have given some renewal or extension or fresh loan is given. If at all any fresh loans or renewals is given, how much aggregate amount is renewed, how much amount is renewed, how much amount is extended, how much amount is given as a fresh loan so that old loan will be settled, yes or no? And what is their percentage to the total loans? What is their percentage to the total loans? That also you should give. Specify and demand. Sometimes companies will give demand loans also. Demand means repayment on demand, or there is no repayment period. If at all any such loans is there to promoters and related parties, specify total amount of loan and what is its percentage. In both the cases, percentage also has to be mentioned. What is this? What is its percentage? What is percentage of renewed loans, extended loans as a percentage of total loans given during that year? Second one, what is the percentage of demand loans with the total loans given during that year? Percentage also you should mention. Clear? That's it. Next, clause number 4, not a big deal. Okay, so same, it's actually clause number 3 extension, technically speaking. So the company will give loans, guarantees, advances, security, all that, right? Whether 185, 186 provisions of the Companies Act satisfied or not. If not, provide details thereof. Next, deposits. Verify compliance with Companies Act, RBI directives, company law board, and tribunals. So whether if the company has given any, if the company has accepted any deposits, verify compliance with them. And here one more point is there, I guess so. Whether interest and deposits, I think repayment is proper or not. Just check out once whether repayment point is there once in deposit. Just open the GoToNotes. Sorry, that is not there. Okay, just compliance. You just have to check the compliance with the Companies Act. Whether if the company has accepted public deposits, you just have to check compliance with laws and regulations. That's it, nothing else. Next, cost records. Whether maintaining cost records as per 148(1), company, whether company has maintained cost records as prescribed under 148. Check out whether such accounts and records are maintained or not. You need to check. Statutory dues, they're divided into two types: undisputed, disputed. You know, I already told in-depth meaning in main marathon. Okay, disputed due, auditor simply has to disclose information. What information? How much is disputed, where it is disputed, where the amount is pending, in which forum the dispute is pending. Undisputed, two questions you need to answer: whether the company regularly depositing it every month, periodically, quarterly, monthly, whatever, periodically are they depositing regularly? If not, any outstanding arrears which are more than 6 months on balance sheet date, company has to report. Next, undisclosed income. Transactions not recorded in books of accounts, are they discovered during the year? Is there any income which is discovered in the current year? If so, is the same recorded in books of accounts? Here recording is what the key point. What they're asking: did any income disclosed by the income tax, did any income discovered by the income tax department in current period? Yes. Whether the same, the discovered income, because previously it was not recorded, now it is discovered, is it recorded in the books of accounts? This is the question. You're getting it? Next, defaults in repayment of loans. Lender wise you need to mention defaults. Like if there is any default in repayment of loans to any lenders, lender wise, what is the nature of the loan, who is the lender, how much amount is defaulted, principal or interest, number of days, all that. Especially this breakup is required when the lender is a bank or financial institution. Debenture loans and all, you don't have to. Government, bank, you know, financial or government also. In all these three cases, breakup has to be given. Next, is the company declared as a willful defaulter by any lender? Is the company declared as a willful defaulter by any lender? In just 2 days back, Anil Ambani was treated as fraud in one of the particular company. Getting it? I don't know whether that company is also categorized as willful defaulter. I'm not sure. So whether the company has been treated as willful defaulter by any lender, in civil report you can find this. Okay. Next, you know, diversion. If loans are not applied for the purpose for which it were obtained, mention amount of loan diverted. If the company borrowed some loans for some project purpose, they diverted it for some other purpose, nothing but used it for some other purpose, mention that. If short-term loans were used for long-term purpose, how much amount is used, like that, mention. And sometimes no, company will take loans for subsidiaries, joint ventures, associates needs. How much amount is taken for the purpose of subsidiaries, associate, joint ventures? Sometimes no, company will pledge, the company has shares in another company. Those shares company will pledge with the bank and then they will get a loan. Now the shares which the company pledged, you know, they are shares of the subsidiary, associates and joint ventures. So whether pledge, I mean loan against pledge of shares of subsidiary companies, associate companies, that you need to mention. Okay. If so, report details thereof. Also report if defaulted in them. Is there any default or not? Just check out. Next, 10th one, end use of funds. Sometimes no, we raise money from IPO or FPO. Whether money raised from IPO or FPO, are they utilized for the same purpose? If not, is there any default, like utilized for some other purpose? Delay, not yet utilized. Subsequently we rectified. We temporarily used it for some other purpose and rectified it. So all that has to be mentioned. Next, if preferential allotment or private placement happened, check Companies Act provision. Further, whether the amount raised in preferential placement, all that, right, private placement, preferential allotment, for what purpose it is, right, for what purpose it is utilized, check out that. Then fraud reporting, whether fraud on the company or by the company. So for company, fraud can happen on the company or company Company management would have done fraud on third parties. Whatever it is it noticed or reported during the year? If so, what is the fraud? How much amount involved? Who are the parties involved? Mention that. Whether report under 143.12 has been filed with central government. Suppose if auditor identified any fraud for more than or equal to 1 crore, he will file form with form in ADT 4 with central government. See whether that is filed or not. If so, mention it here. Whether auditor considered whistleblower complaints. Every company will be receiving whistleblower complaints every year. Yes or no? So the auditor has to consider whistleblower complaints as a part of risk assessment process, so that he will know where to focus more, all that. So did auditor consider or not? Check out. Auditor has to report, yeah, I considered. Suppose I'm the auditor, I'm giving this report, so I will say that I considered. Next, Nidhi company. This point is exclusively applicable for Nidhi company. Whether Nidhi company has complied with net owned funds to deposits ratio of 1:20. Whether the Nidhi company maintained 10% unencumbered term deposits. Whether the Nidhi company defaulted in repayment of interest deposits, all that. Check out. Then related party. If the company has entered with any transactions with related party, check compliance with 177, 188 and see that related party information is disclosed in the financial statements as per accounting standard. Here 2 points are there. Yes or no? 1, compliance with Companies Act provision. 2, disclosures as per accounting standard. That's it. Next, internal audit system. Whether company has internal audit system, actually it's not ICS. It's actually internal audit only. Internal audit system commensurate with the size and nature of the business, and whether internal auditor's report is considered by stat auditor. So I should also tell, yeah, I considered his report. Next, whether company entered into any non-cash transactions with directors. If so, 192 provisions have been complied or not. Check out. Next, NBFC. Whether registration is to be obtained or not. Is the company, suppose I'm doing audit of every company, whatever company I'm doing audit, this point I need to check. Is the company liable for registration? NBFC. You know, NBFC registration is compulsory if principal business criteria is satisfied. What is principal business criteria? I already covered in the main marathon. Yes or no? This is just a quick revision. Principal business means very simple. If the NBFC more than 50% is from financial income and more than 50% of the assets are financial assets, then that particular organization is nothing but financial activities they're doing. They must register with RBI. Whether company has conducted any activity without a registration. Yes or no? Just check out. Is it liable for registration, and are they doing any activity without registration? Check out. And core investment. Whether the company is a core investment company. If so, is it fulfilling the criteria? If the company is exempted core investment company or not registered, is it still fulfilling the criteria? Check out. And if the group has more than one core investment company, mention how many core investment companies are there in the group of companies. Next, whether any cash losses are incurred in the current financial year as well as immediately previous year. If so, how much amount is there in each year? Just mention that. Next, is there any auditor resigned from the audit? Yes or no? Is there any resignation of statutory during the year? If so, is the incoming auditor has taken into consideration previous auditors' issues, objections, all that? Check out. Next, based on various informations and your knowledge, if he is of the opinion that no material uncertainty exists at the balance sheet date. Actually, no material uncertainty exists at balance sheet date on date of audit report. You need to verify this point on which date? On date of audit report you should verify this point about the financial position of the company on balance sheet date. The financial position of the company is on balance sheet date. Whether the financial position of the company on balance sheet date, whatever assets and liabilities are there, whenever the company is liable to pay, can the company pay? Check that check that status on the date of audit report. I want latest information. Yes or no? On the date of audit report, you need to check this. Clear? This you need to add it. Okay, in the chart book, printed book, you need to add this point. Next, CSR compliance. In CSR, no, like CSR expenditure, we divide the money into project expense, other than project expense. If at all it is other than project, no, it has to be transferred to special fund, Schedule 7 fund within 6 months from the end of the relevant financial year. Now, suppose if it is project expense related one, no, that amount has to be transferred to a special bank account given under 135. Next, finally, clause number 21, that is applicable only for consolidated financial statements. It is not applicable for standalone financial statements. It is applicable for audit report on CFS. Whether there is a qualification, adverse remarks, all that. If though, details of the companies, all that. Very simple. You know, what are all the companies that are included in consolidated financial statements? Identify. In those companies, in their CARO reports, their auditors would have given some adverse remarks, qualifications, right? All those qualifications at one place you should give. That's it. Now, by the way, this CARO is applicable to what companies? I think here we have not mentioned applicability of CARO because it's not a big deal. Anyhow, I will tell my team to add this, okay, in the next edition. Fine. CARO applicability, only that point got missed, I think. Rest everything is included. Applicability of CARO. What is applicability of CARO? It is applicable for all companies except banks, insurance companies, Section 8 companies, banks, insurance companies, Section 8 companies, and already 1%, yeah, 1% company, small company, private limited company subject to 4 conditions. Private limited company subject to 4 conditions. Paid up capital and reserves and surplus shall be less than or equal to 1 crore on balance sheet date. Turnover of the company shall not exceed 10 crore. Borrowings of the company from banks and FIs at any time during the year shall be always less than or equal to 1 crore, and it should not be a subsidiary or holding of a public limited company. But remember, by today this private company logic is irrelevant. I told you, because most of the private companies, if at all a private company is satisfying definition of small company where paid up capital is less than 4 crore and borrowings is less than 40 crore, or turnover is less than 40 crore, if at all a company becomes a small company, automatically private limited company point you don't have to check, it's a small company, CARO is exempted. And even in the regular class, in our actual class, I showed CARO guidance note. This particular point, I clearly told if a particular company is coming under small company purview, automatically private company point will be irrelevant. And some students ask me, sir, in small company borrowings criteria is not there. Borrowings criteria is not there for small company definition. What if borrowings is more than 1 crore? Still doesn't matter. If a company is a small company, that's it. When a company becomes a small company, capital less than 4 crore. Turnover less than 40 crore. That's it. Borrowings doesn't matter how much ever you have. It doesn't matter. You are a small company. That's it. CARO is exempted. Clear? That's it. With this, entire audit report is completed. Totally, we spent approximately 1 hour 15 minutes on the entire all 7 standards, CARO, everything put together. Yes or no? So in the CARO, in this current edition, what got missed exactly? Actually, till now, whatever we have seen, there's nothing. Even a single point also not missed. Yes or no? Here only, I think. Not even revaluation, not this. I think only at one place it got loans and advances. The percentage point also has to be added because we want to make sure the chart is 100% clear. So this percentage point we have to add. Then what else we need to add? Here the word subsidiary company has to be added. Then is there any other important wordings that is missing? Yes, here audit report date has to be added. That's it. Only three issues. Yes or no? Just to make it even more clear. That's it. With this, audit report is completed. Confident? Yeah. Let's begin the next chapter revision, that is completion and review. At every chapter beginning, I'm giving this disclaimer. Chart note revision is not a substitute for main revision. Please watch the main revision, which is 12 hours in YouTube. Here, Harsha Audit Marathon, or simply type Audit Marathon, you will find 11.5 hours revision is there, which I recently uploaded for September purpose and Jan 26 exam purpose. So please watch that. Then only continue watching this. Directly if you watch this, because here we don't give much of conceptual explanation. It's more of quick revision and brushing up of the content. That's it. Now, in this chapter, we totally have 6 standards. 5 standards were there, and there is another standard called 265 also. And remember, we already completed a 517 audit report discussion itself. So remaining 5 we need to revise. So remaining 5 standards we need to revise. Now, the first one I will revise is 560, subsequent event. Okay, subsequent event. What is subsequent event? Events occurring after the financial statements date. After the financial statements date, but before events happening between the date of financial statements and auditor's report, on or before auditor's report, but the facts came to the knowledge of the auditor after the date of auditor's report. Next, date of financials means what? 31st March. Date of approval of financials means what? The date when ultimately they were asserted, signed by the approving authority. Date of audit report means was the date when the date which auditor mentions in the report. Date of financial statements means what? The date when the financial statements and audit report is made available to third party. Now, so here subsequent events, the main theme is because of this underlined word. You already prepared audit report, and after preparing the audit report, now you got to know some subsequent event information. And when this event happened already between the balance sheet date and audit report date only, the event happened then only, but you got to know after audit report date. How to deal with this situation is what the standard is dealing with. Next, subsequent events types, we know adjusting and non-adjusting. No, I'm not giving more of information on this. So what is the audit procedure for subsequent event? That itself can be asked as a side question. Generally, what we need to do for identifying subsequent, perform procedures to obtain evidence that all events are identified which require adjustment or which require disclosure. No additional procedures if at all any satisfactory response is there. Understanding management procedures, inquire with management and top management, read minutes of the meeting about any unrecorded matters, read the latest interim financials, review accounting records, budgets, all that. Next, verify events requiring adjustments or disclosure, are they appropriately adjusted and disclosed. Get a representation under 580 that all the subsequent events are identified, adjusted and disclosed by the management as per accounting standard. Getting it? Next, this itself can be asked as a side question. Write about subsequent event related audit process. Side question they can ask. Next, now sometimes no event happened between balance sheet and audit report date only, like 31st March and some 10th August, 10th July, 10th June, some date I would have taken in that example. Event happened there only, 14 or 15 events, but management identified 13, rectified them and disclosed it. 2 events they forgot, and those 2 events knowledge we got to know after we issued the audit report. Like facts identified by the auditor before date of financials issued to the public. See, luckily I identified now. I mean, by the time I identified, audit report is already done, but financial statements are not yet issued to the public. Third parties, it was not yet issued. It is very simple to resolve. Like what I will do, if fact become known to the auditor after the date of audit report, but before the financials are issued, I will first discuss with the management. I will see whether financials require amendment, and I will ask how management is going to amend. Suppose no, management is amending, I will verify whether amendment is properly made or not, and I will extend procedures till the new audit report date, because now financials are being amended, automatically approval will be again new date, and audit report will also be again new date. Now remember, since approval date, audit report date has been increased, later postponed. Now some frameworks says, you need to redo subsequent event procedure again up to the due date. Some framework says whatever amendment is there, to that amendment only you verify, that is sufficient. In India we follow only limited amendments. I don't know exactly in the financial reporting context exactly what we follow in India. I'm not sure, because in India there is a different stand on this. Okay, India you will understand in CA final. Okay, so this see very simple. For example, 31st March is the financial statements date. Original approval date is 10th July. Revised approval date is 10th August. Originally subsequent event period we thought this, approximately 70 days. Later subsequent event period increased to 100 days. Now subsequent, later revised financials were approved on 10th August, right? Because of what? Some 2 events happened here, was not considered. 2 events happened before 10th July was not considered. So we amended by 10th August. Now subsequent event period increased up to 10th August, right? Now between 10th July to 10th August, if any other events happen, should I consider or not? That is decided by financial reporting framework. So in our audit, we don't have to worry about this. Clear? Now, so provide a new audit report. Ensure that new audit report is not dated earlier than the approved financials of the new one. That's it. Next. Sometimes, if at all you are doing only limited amendment. Limited amendment means the 2 items only you are rectifying and putting a new date. You don't have to perform subsequent event procedure up to the new date. You don't have to. Old approval date is that up to that date only. Those 2 events you adjusted in financials, just that financials are reapproved again on 10th August. So only those 2 adjustments were made. Limited amendment to the financials. That time in audit report, auditor also can add just a new date. That's it. You don't have to give a separate audit report also. This concept is called as dual dating. Or provide a new audit report completely altogether. So any of this option auditor can follow. But this particular point is not there in India. Limited amendment option, to best of my knowledge, not there. If at all financial statements approval date is revised, then subsequent events up to the new date has to be identified once again. Clear? See, first of all, if at all any of this issue identified, no, what directors will tell, sir, we'll take care of this in the next year as a prior period item. Why do all this? Why to do all this? Clear? Next, suppose if management is not amending, okay, and if report is not yet given to them, I will straight away modify the opinion. If report is already provided, I will ask them, I will notify them, please do not issue the reports and all to third parties. Please give back my audit report. Suppose if management already issued the financials without listening to me, I will take appropriate action. Clear? Suppose financials are already issued to the public and after that I came to know about this fact. Financials are already issued and now I came to know. I will discuss with management. I will see whether financials are requiring amendment. I will inquire how management is trying to address this situation, because already financials are issued to the public. If management is amending, I will perform procedures on the amendment. I will see what steps management is taking to inform the recipients who already got the old version of audit report and financials. I will extend procedures till the new date and provide a new audit report. If management does not amend, I will take appropriate action. 560 is over. Next, 570 we already completed. Yes or no? Then I will discuss 580. Then I will come back to 260, 265, 450. Okay. Yeah, 580. 580. Written representation. What is a written representation? It's a written declaration by management for providing additional information to auditor or for giving some supporting information which auditor already aware of. So written representation is a declaration by management. That is also an audit evidence, or no? So written representations it will be either to confirm the matters or to support some information. By the way, financial statements and books of accounts, they are also in writing. They will not be treated as representation. For financial statements and books of accounts, inside that some matter is there. For that, if you want additional explanation, management is giving additionally the data. That is written representation. Can written representation be used as evidence? Yes, absolutely. This is also an audit evidence. But remember, written representation alone is not sufficient appropriate evidence. Yes or no? It is no doubt a necessary source of evidence. Yes or no? But it is not sufficient appropriate evidence. You need to look at various other documents, supporting bills, external confirmations, all that. Written representation is only supportive in nature. Written representation alone does not provide sufficient appropriate audit evidence. Therefore, and moreover, it does not reduce audit responsibility to obtain evidence from other sources. Written representation is only supportive. It's only corroborative in nature. Next. From whom? From whom you should get representation? From the management who has responsibilities for financial statements and knowledge. Written representations are relating to management responsibilities and they are also for corroborating other audit evidence and all. Next. You need to get various types of representations. 1. Written representation about management responsibilities. 2. Written representation about completeness of information provided to the auditor. 3. Written representation about information provided to the auditor, and written representation about specific assertion. So various assertions. Okay, for that reason also written representation auditor has to obtain. Now, right, first I will see. Yes. Written representation about management responsibilities. Management has to confirm. Remember, written representation will be taken at the end of the audit. In the letter of engagement, management agreed responsibilities. Now in written representation, I will take a representation that they fulfill the responsibility. So confirm about management's fulfillment of the responsibility. Management must represent fulfillment of financial statements as per applicable framework. Management's knowledge. Obviously, whoever is giving this representation, they are expected to have knowledge of financial statement. And auditor may request inclusion of enquiries, confirmations from some other people. Management, no, when we are asking representation from management, no, we may ask them, please include details of the persons from whom you have taken data, from whom you have taken the help, and who are all helped you in preparing financials. Their information also you can include. Like that we can tell the management. Auditors may accept qualifying language. Suppose if management is giving representation with these wordings, to the best of our knowledge and belief, auditor can accept, provided it is given by responsible and knowledgeable individual. Now, written representation about completeness. Management must represent that all information is provided to auditor and all access to data is given to the auditor. Management must represent that all the transactions are recorded and accounted in books of accounts. Why representation is needed on management responsibilities? Remember, audit evidence alone is not sufficient to confirm that management has fulfilled all the responsibilities. Only if they tell specifically that, yeah, we fulfilled all the responsibilities, I will believe it. So auditor cannot judge purely based on audit evidence. That financials are prepared as per applicable framework. Management has fulfilled all the agreed responsibilities. We don't know. Only you need to ask them. They need to specifically tell, yes, we fulfilled all the responsibilities. Yes or no? There are some cases where auditor will ask reconfirmation. Suppose management already gave representation, but there are some cases where same representation I want them to once again reconfirm. Suppose earlier the person who gave this representation, now the person has been changed. Signatories no longer hold responsibilities, like signatories changed. Terms have been changed from previous years. Management misunderstands or circumstances change. In all these cases, auditor may ask for management to reconfirm whatever they already confirmed in earlier representation. Next. That is not required. Yeah, next. Written representation about information provided to the auditor. This is an additional representation. Auditor may request additional representation beyond responsibility for wherever information auditor needed. For example, for communicating, management knows deficiencies in internal control. For that reason, I can ask management, please give me representation about what are all the deficiencies in internal control that you are aware of. Written representation about specific assertion. Auditor may request specific representation to support audit's understanding of management judgment, intentions, or completeness of the assertion. These were also called as other representations. Auditor can ask representations about various other things like complete accounting policies, accounting estimates, litigations and claims, related party transactions. These are all called as other representations. This question has come in the recent May 25 exam. Anyhow, we will be discussing in our class for question bank, right? There you will get it. And what should be the date and period covered by representation? The date of representation must be near the date of audit report, but not after that. Representation shall be for all the periods mentioned in the audit report. Auditor cannot express opinion before receiving the representation, correct? It must be for all periods mentioned in the reports. What if current management is not present? Sometimes they may say, sir, I am not the management from the beginning, sir, I can't give representation. That's wrong. Whoever is the right now CFO, if at all I'm asking representation, he should give. So current management is responsible and must provide representation for all period, even if they were not present previously. This question came in CA final in November 24 or May 24 exam. This question. Next. Now finally conclusions. Suppose management is not providing. Discuss why are they not providing. Reevaluate about their integrity. All these days you thought they're honest. Now they said they're not cooperating you. Means check their integrity. Take appropriate action. Since if they're not providing, you generally give disclaimer of opinion. Suppose written representation is given, but it is not reliable. Perform procedures to resolve. If unresolved, recognize management, reconsider management integrity, assess all its impact, and disclaimer of opinion. Now, sometimes you need to get evidence about judgments and intentions. So for that, how do you get evidence on management intentions? Look at their past history. Why are they choosing a particular course of action? Can they pursue that course of action? And is there any other information which is conflicting with this? So these procedures, if you perform, you will understand whether management intention is proper or not. Generally, evidence available for management intention is limited. How do you know management intentions are correct? How do you know management intentions? They say intention now, so and so intention, but tomorrow they may follow something else. How do you believe this intention? So past history you will see. So this point we have already covered in depth in our class also. So for quick revision purpose, this is sufficient. Clear all of you? Next, 560, 580, both are over. These are only big standards in the topic. 260, 265, 450. Okay, if these three also finished, this completion and review topic revision is finished. Okay, yeah, just 2 minutes. Yeah, we'll continue. 260 standard. Communication with those charged with governance. Okay, this standard talks about certain issues which we need to communicate for sure to those charged with governance. What are the matters that we need to communicate? No, first you need to communicate you need to communicate auditor's responsibility. That auditor is responsible for forming and expressing an opinion, and audit does not relieve management about their responsibilities. You should communicate that. Second, what you should communicate, planned scope and timing of the audit, so that management will make certain arrangements and they will be available for you to answer all the queries, all that. Then you should communicate significant findings in the audit. Like, what is your answer on qualitative aspect of entities accounting practices? Have you encountered any difficulties in the audit? significant matters discussed with management and written representation that you want, and modifications to the audit report. Under what circumstances your opinion, I mean, what are the reasons why are you modifying the report? When you want to include emphasis of matter, other matter para, key audit matter, MURGC para, other information para, modified opinion, whatever the reason you are modifying, you have to communicate it to the management. And any other significant matter which you feel relevant for those charged with governance, who is having oversight with financial statements response. These are the matters that you need to communicate. This is called as significant findings. Further, if at all you are acting as an auditor of listed company, you should communicate your compliance with independence in case of listed company. You should also communicate with those charged with governance what other relationships you have with this company and how much fees you are getting for audit and non-audit services, and what are the safeguards applied for threats. If at all any threats were there, what are the safeguards you apply to reduce the threats to acceptable low level? So this is communication in case of listed companies. This itself can be asked as a 4 marks question. What are the communications required in case of listed company? Significant findings, a 4 marks question. And it is your responsibility to establish the communication process. Correct? So the auditor must communicate the format of communication, timing of communication, all that. All important things you communicate in writing. And you don't have to cover each and everything. You have to cover only significant issues. Yes or no? Evaluate whether a two-way communication process is adequate. If not, see what is the impact of inadequate communication. And document oral communication, what to communicate, when to communicate, whom to communicate, and retain a copy of written communication. At all you communicated something orally, to whom you communicated, when you communicated, what you communicated, maintain a separate document. All other written communications, maintain a copy of the same. Next, now you know, an effective two-way communication is important. Why it is important? Because it is benefiting the auditor. How it is benefiting the auditor? We rely on top management for entire information, audit evidence, all that. So if you communicate with them only, you will get proper evidence all. It also benefits management. Why it is helping the management? It helps the management to see financial reporting process correctly, and whenever they are communicating with auditor, they'll get to know what are the errors and all at early stage, therefore reducing the risk of MMS. And it is important for both of them for having a constructive working relationship while still maintaining independence and objectivity of the auditor. Next, who are those charged with governance? These are the people who are responsible for strategic direction of the company, who are having accountability, including financial reporting responsibility. Correct? These people are called as those charged with governance. Jan 25 exam, I guess this question has been asked. Who are those charged with governance? And in some companies, no, management personnel also, management people itself will be part of top management for small companies and all. And depending on governing structure, those charged with governance is decided by governing structures also. For examples, separate people will be there, or company directors. In company, directors themselves will be those charged with governance. Board of directors or supervisory body, partners, trustees, these might be those charged with governance. In small companies, small entities, the one person himself will be the manager, he himself will be the owner. In some family owned businesses and non-profit concerns, who is those charged with governance, sometimes you can't identify. That's why what the standard says, discuss with the engaging party, whoever is appointed you, they should tell you who should be those charged with governance, yes or no. So for understanding who is those charged with governance, your understanding of the entity and its environment as per 315 is there, that will help you. That's standard over to hardly 4 minutes, 5 minutes. No, how quickly we finished. Every point we covered again. Next, so 260 is completed. Next, 265. This is regarding communicating deficiencies in internal control to those charged with governance and management. Communicating deficiencies in internal control. Now, in this standard, deficiency is divided into two types: normal deficiency and significant deficiency. Okay, significant deficiency means what? First of all, control is ineffective. Control is there but not effective, or control is missing. Why control is? First of all, to prevent, detect, correct misstatements in a timely manner. Control objectives are to prevent misstatement, correct or detect. Yes or no? If at all a control is failure, that's a deficiency. Or control itself is not there, that is also deficiency. When a deficiency is treated as significant deficiency, a deficiency, a DIC is nothing but deficiency in internal control. Okay? A deficiency in internal control or a combination You know, it is so important that it merit top management attention. The combination of deficiencies is such that it merit top management attention. Then that deficiency is called as what? Significant deficiency. How do you determine significance? Likelihood of misstatement and potential magnitude. To what is the possibility of misstatement? What is the likelihoodness? If the high possibility of mistakes and the magnitude is also so heavy, then that's a significant deficiency. Significant deficiencies can exist even if there is no material misstatement is there. See, deficiency is an indicator. There is no guarantee that actual mistake is there, actual fraud is there. Yes or no? All of you. Now, what are the indicators of significant deficiency? Before that, how do you decide whether a deficiency is a significant deficiency or not? What factors? Likelihood of deficiencies leading to MMS, susceptibility to loss or fraud, how much subjectivity is involved, how much amounts exposed to this deficiency, volume occurring in that class of transactions where deficiency is there, and what is the importance of these controls to the financial reporting. Deficiency is there in a control, how far that is important for financial reporting. You know, whether a particular control is relevant to financial reporting or not. There are some examples: general monitoring, fraud prevention, accounting policies, related parties, period end reporting. You know, these are all financial reporting related controls. And what is the frequency of exceptions and interaction with other deficiencies? All these factors collectively decide whether a deficiency is a significant deficiency or not. Now, indicators. Will there be any indicators of significant deficiency? Yes. Ineffective control environment. Control environment is ineffective. That itself shows a big, minus. It's a significant deficiency. Like management transactions are not scrutinized by governance. Management fraud is not prevented. No remedial actions on prior significant deficiencies. Previously you identified significant, nobody has taken any action. That indicates poor control environment. Poor control environment, that's an indicator of significant deficiency. And missing risk assessment process, or risk assessment process is ineffective in the company. Ineffective response to risks, and misstatements are found by auditor. Prior period misstatements still not yet rectified. Management, evidence that management cannot oversee. Management is unable to oversee the financial reporting process. See, indicators means what? Significant deficiency will be there. Some indicators will be there. Top management control environment is ineffective. Auditor found a mistake, that itself shows some deficiency is there. Prior period misstatements, that itself shows some deficiency is there. Management is not able to oversee the financial reporting process, that is also a deficiency. Correct? Next, communicating significant deficiency. Determine first significant deficiency, and you have to communicate significant deficiencies on a timely basis to top management. What about other deficiencies? Other deficiencies you can communicate it to management. Correct? Now, you will communicate, right? How do you communicate? Through letter of weakness. What you should communicate in that, what points you should include, details of deficiencies, and what is the impact of, what is the potential effect of the same, that you mention. Context, so that management will understand exactly what the deficiency is. Specific explanation, that your objective is to give opinion on financials only. Internal control was considered just to plan audit procedures, but not with a view to give opinion on that. And reported matters are limited deficiencies identified. Whatever you're communicating deficiencies, that is only those deficiencies you identify. That is not exhaustive deficiencies in the system. You need to mention all these statements. Correct? That's it. 265 is over. Confident? Then we are left with only one more standard, that is 450. Completion review topic will be over. 450. What is 450? Evaluation of misstatements identified during the audit. Just 2 minutes. Yes, just 5 minutes. 450 standard will be over. Evaluation of misstatements identified during the audit. First of all, there are two definitions. Most important definition: uncorrected misstatement means what? Misstatement which is identified and accumulated by the auditor, which is not yet corrected in the books of accounts. That is called as uncorrected misstatement. Okay. Now, what do you mean by accumulation? This itself is important concept. Write about accumulation of misstatement. Whatever mistakes that you identify in the audit, all that you have to accumulate, except which are trivial in nature. Trivial means what? We already discussed in risk assessment and internal control in our class. Triviality level, insignificant, so negligible. So those negligible mistakes, no need to. Remaining all other mistakes you accumulate. And when we are verifying with overall materiality, total of mistakes only we see, aggregate of mistakes only we compare with the performance materiality level. Yes or no? Next, examples. Inaccurate accounting, omissions of wrong capitalization, these are all various examples. Now, when you identify mistakes, what generally you do, we will revise, if at all nature of misstatements, suppose if we find some mistakes, if they indicate some other potential misstatement, we will revise overall audit strategy and plan. And we will revise audit strategy and plan if aggregate mistakes are approaching performance materiality. This point even we discussed in sampling topic. If the actual mistakes, yes or no, actual mistakes, if they are approaching materiality, we assume that sampling has not provided valid basis. So we revise, we increase the sample size. Increasing the sample size means increasing the testing. Increasing the testing means your timing of the procedure is changed, means plan is changed, strategy is changed. Next. So whenever you find any mistakes, we generally request management to review, identify, make adjustments. We ask them also to do a detailed investigation. And we also perform additional procedure if management, if management corrects the financial statements after doing all this, we will also perform additional procedures to know whether misstatements identified and communicated are correctly rectified or not. That's it. Accumulation of misstatements, you need to read all these points. Then, how do you communicate the mistakes? First, timely you communicate all the accumulated misstatements to appropriate level. Request corrections to make sure records are accurate. Management, if at all refusing to correct, understand why are they refusing. Evaluate whether financials are still free from MMS. Re-evaluate materiality levels. Confirm appropriateness of the materiality based on the results. Determine if material individually in aggregate, considering the size, nature, circumstances and prior period effects. Simple. Materiality of uncorrected misstatements, look at based on the size, total accumulated mistakes, all that. Next, communicate uncorrected misstatements, request correction, discuss prior period effects. Request from management that sometimes management messages are no need to correct the all together is small only, and you also convinced, yeah, it is small only. Get a representation that uncorrected misstatements aggregate total is immaterial. Get a representation there. Finally, document. Triviality level, document all the mistakes that you accumulated, document, and also mention whether they are corrected or uncorrected. Conclusion as to uncorrected misstatements. How did you conclude the materiality of uncorrected mistake? Did you consider them as material or immaterial? If you consider uncorrected misstatements as material and not corrected, you will give a modified opinion. 450 standard is also clear. So with this, completion and review chapter is fully done within just 30 minutes. That revision. Clear. So let's begin the next topic, that is audit documentation, quick revision. A detailed explanation of this you will find it in the main marathon, and this is just a quick revision marathon where I brush up the entire concept. So documentation means what? Obviously documentation is recording the work performed, yes or no? What are you recording? Your audit procedures, the evidence you are collecting, and the conclusions that you are reaching. All these three you are recording. So that process of recording audit evidence, audit procedures, conclusions is called as documentation. Correct? So what is the objective of this particular standard? Here nothing but we are discussing 230 standard. This is nothing but 230. 230 is equal to audit documentation. Now, what is the objective? It is documentation is the basis for the opinion, yes or no, and it's an evidence that you complied with standards on auditing, legal and regulatory requirement. Next up. Nature and purpose of documentation. Obviously, the nature of documentation is its evidence in nature. The nature is evidence. It's an evidence for the purpose of evidence to show that your overall objectives are achieved and to show that your planning and performance is as per law, regulation, standards. Now, what's the purpose of documentation? It will help team members for planning and performing for the upcoming audits. It will help in direction, supervision and review. It ensures accountability among the team members. It retains. It's a record for future audits, and it enables quality control as well as external inspection. So many benefits because of documentation. Actually here purposes they told, then there's nothing but benefits only. Then what should be the manner of documentation? How you should document? You should document in such a way some experienced auditor who did not do this audit, by looking at your documentation, shall understand how you planned and performed, what results you obtain, what significant matters and conclusions and judgments you reach. Everything he should understand just by looking at your documentation. In such a way the audit documentation has to be maintained. An experienced auditor with no prior connection must understand nature, timing, extent of procedures, results and evidence obtained, conclusions and judgment and significant significant matters. Experienced auditor means who has a reasonable knowledge of financial reporting framework, accounting standard, auditing, and client business. Getting it? But he is not part of our team member. He is not part of the engagement team. Next. Now, documentation of nature, timing, and extent. So, record identifying characteristics, whatever you perform, verified, whatever you tested, you recorded. Who performed the work, recorded. Completion date, who reviewed the work, recorded. Discussion of significant matters, recorded. Nature of discussion, when it is discussed, with whom it is discussed, how inconsistencies were addressed, all that you have to document. Nature of documentation of nature, timing, extent. Timing means what? Like what items you tested, who performed it, who reviewed it, date and extent of review, date of performing the work, discussion of matters, all that. These are all documentation of what you're doing. You're documenting all this. Next. Factors affecting form, content, extent of documentation. How much I should document, what to document. See, nowhere statutorily they will say this you have to document, that you have to document. It is completely judgment of the auditor. It depends upon size and complexity of the entity, nature of procedure, identified risk, significance of the document I verified. Yes or no? If it is more significant, I'll document. Then nature and extent of exceptions. The more exceptions, the more documentation. Correct? Need to document a conclusion for a basis which is not readily determinable. Sometimes, no, when we are doing the work, we will not be happy with that work at that moment, but we'll document. Later on, we may get a clarity. Next, audit methodology and tools used. All that you need to document. Yes or no? All these will determine to what extent to document, in what format to document. Suppose if you are using, tools, software, data analytics software tools, so soft copy documentation. Sometimes hard copy documentation, depends. Next. What are the examples of documentation? Audit plan is one example. Analysis, significant issues, key matters, confirmations and representation letters, letter of weakness, checklist items, correspondence made with management. Yes or no? All this is an example of documentation. So, documentation can also include copy of entities records. Don't write directly entity record. Copy of the books of accounts. Yes or no? Like important contracts and agreements. But remember, your documentation is not a replacement for accounting records. Accounting records, they have to maintain for sure, and you can also maintain a copy of the same with you. What audit documentation does not include? Superseded drafts, like working papers, preliminary works, all that, like some rough calculations, you can throw it. Incomplete or preliminary notes, minor corrections, old versions. Yes or no? Duplicate copies, these and all you need not document. So next, what do you mean by audit file? Audit file is a folder or media containing all documentation, whatever, like you gather, right? Soft copy, hard copy, you all keep it in a folder, right? In a hard copy, or you keep it in system, right? That's nothing but audit file. We call it as audit file. Now, audit file has to be prepared on a timely basis. Why? It enhances quality of documentation so that effective review can be done. Yes or no? It ensures accuracy when compared with post-work documentation. When doing the work itself, you document rather than post-work. Correct? Then assembly. Whatever documents you gather, you see so many papers you will gather, so many copies you will gather. System also, soft copies also, so many workings you gather. You have to arrange them in a systematic manner. Yes or no? That process of arranging the files gathered is called as assembly. So assembly has to be completed after audit report date for sure. That's what SQC says. That too, it shall be completed within 60 days after the audit report date. Very simple. Once you give audit report, assemble the documentation neatly and then store it, so that some other experienced auditor may come and verify this. Yes or no? He should understand nature, timing, extent of procedure, significant matters, conclusions, judgment, all that. Next. No, assembly is an administrative process. Purely it's an administrative activity. No procedures, no conclusions. Audit already over. Procedures already performed. This is just a rearrangement of files, all that. Correct? Example, what is assembly process includes? Deleting old documents, sorting means rearranging, cross-referencing, signing offs, documenting evidence before date, whatever the evidence you obtain before the date of audit report, all that you are saving it. Next, documentation of significant matters. What do you mean by documentation of significant matters? First of all, significance of a matter is an objective analysis. Yes or no? It's a depends on case to case. Now, examples: matters relating to significant risk, results indicating potential misstatement, difficulties in applying audit procedures, findings which leads to modified opinion, or inclusion of emphasis of matter para. If these situations are there, we call them as what? Significant matters. Any matter that make me take a modified opinion, that make me to think of emphasis of matter paragraph, any matter where misstatement is identified by me, or any matter relating to significance, these are all called as significant matters. Significance of a matter is an objective analysis. Clear? Next, documentation related to professional judgment. Yes or no? Like documentation, form, content, extent depends upon professional judgment. Okay, so why you need to document professional judgment? Reinforcing the quality. Reinforcing the quality means what? At the time when I take a decision, I know what are the factors, but after 6 months or after 1 year, if they ask me why you take this decision, I don't know, I can't recollect. So it is better to document what are all the thought process I went through. The thought process also you have to document. Correct? Situations. Under what situations you need to document? What is the rationale for your decision? Okay, for significant information, for significant issues, what rationale you applied, what logic you applied that time? Yes or no? And basis for conclusions, especially in case of subjective judgments. For example, at so and so place, for provision for bad and doubtful debts, you agreed this much is sufficient. That time, what factors you considered, what assumptions you considered, documented. Concerns on authenticity, basis for conclusion when further investigation undertaken, when there is a concern about authenticity of the document. Sometimes no auditor would have done some further investigation when written representation is not reliable. Yes or no? Or when he will written representation is insufficient. All that he will document. Getting it? That's it. So this is about documentation related to professional judgment. Then finally there is a concept called audit summary memorandum. This itself can be asked as a separate question. Remember, all these can be asked as independent questions, and every time, many times they have been asked. Audit documentation, pakka question will be there every time. Either an MCQ will be there or a descriptive question will be there. Small chapter, but the weightage is 2 marks to 4 marks weightage. Document a audit summary memorandum. What is the summary memorandum? It mainly talks about significant matters and how these matters were addressed. What is the benefit of summary memorandum? It will help in efficient review and inspection, especially in large and complex audits. It helps the auditor to address all significant matters without missing. Next, what is the objective? He will evaluate whether SE objectives are achieved or not, and it ensures that overall objectives of the audit are met. That's it. Over. Documentation, hardly 9 minutes. Okay. And by the way, I forgot to cover those 2 points. 2 points I missed. Retention. Documentation has to be retained at least for 7 years from the date of audit report or group audit report, whichever is later. Suppose if the company is forming part of a group of companies and consolidated financial statements, there's an audit report. Then from that date, 7 years I should maintain. Getting it? Next, this is mentioned under SQC1. As per the policy, you need to retain it for 7 years. Then ownership. It is auditor's property always. Sharing with the client at discretion. Auditor can share. But remember, there is no compulsion. Provided you can share with company or anybody else, provided that disclosure does not affect confidentiality. That disclosure will not undermine your work. Clear? Able to understand? That's it. So, effectively done 10 minutes. Yes, let's begin the next chapter, audit evidence revision. Okay. Again, a disclaimer at the beginning. This is a quick revision where concepts will not be explained much in detail. Okay, a brief explanation only will be there for all the concepts. If you want a more explanation, there is a main marathon or there is my EO class. So in that you will find in-depth explanation, all that. Fine. So in this chapter, we totally have 8 standards. What are the 8 standards that we have in this chapter? 500, 501, 505, 510, 520, 530, 550, and then 610, right? 1, 2, 3, 4, 5, 6, 7, 8. Yeah. And apart from this, we have another concept called assertions concept and audit trial concept. So totally 8 plus 2, 10 concepts we are having in this particular chapter. So let's discuss one by one. Now, the first standard is audit evidence. And we know already the entire objective of audit is to give opinion, and for that we need to get reasonable assurance. Reasonable assurance means sufficient, appropriate audit evidence. What is an audit evidence? That one we are going to discuss. So audit is completely a logical process where we need to assess the situation, review accounts, and then we give an expert opinion, where we do check actual state of affairs and check true and fair view. If at all you do not check, negligent, then it leads to a loss of reputation and legal consequences. Therefore evidence is required. So audit is an objective evaluation. In order to an objective evaluation, all this you need to follow. Next, audit evidence, what it includes. Definition. First of all, evidence is nothing but information. which is used by auditor to form an opinion. It includes two types. Accounting records is the primary source of evidence, and other information like minutes of the meeting, confirmations, control manuals, agreements with vendors, agreements with customers, loan documents. These are all other records. Accounting records, invoices, contracts, ledgers, supporting bills and vouchers, all that. So both are audit evidence, correct? Next, types of evidence. There are various types. For example, depending upon source, evidence is two types: internal evidence and external evidence. Internal is something that originates within the organization. External is something that originates outside the organization. So no, internal evidence is generally less reliable. External is generally more reliable. Whatever it is, you have to match internal, external, all multiple evidences. You have to make sure they're consistent with each other. So internal evidence should be corroborated, supported with external evidences. Next, depending upon nature, evidence, no, visual evidence, oral evidence and documentary. Visual, through observation you can identify. Oral, discussions with management, inquiring them, they will give responses, that's an oral evidence. Then documentary, in the form of documents. So depending upon nature, these are the three types. Depending upon source, these are the evidences. And evidence can also come from previous audits, and the quality of evidence depends upon its relevance and reliability. For example, for purchases, the best evidence is purchase invoice given by third party, and the next best evidence is e-way bill in case of goods, all that. Clear? Next, now what do you relevance of audit evidence? Why evidence is important? Because logical collection, whatever evidence you are gathering, that must align with the assertion you are testing. For example, I want to test existence of a machinery, I have to go and physically and then check. That's the only way to get evidence. Next, again, relevance of an evidence, appropriateness, relevance of an evidence depends upon direction of testing. Suppose you want to test overstatement, test recorded accounts. You want to test understatement, then test unpaid invoices, all that. Yes or no? Delivery challans, stock records, that and all you check to detect understatement of sales or understatement of purchases, all that. Next, evidence supports specific assertions. So specific assertion, that related evidence also you need to test. Also you need to assess effectiveness of controls in preventing, detecting and correcting misstatements. And you should also perform substantive procedures to detect misstatements by performing test of details and analytical procedures. So relevance of audit evidence has totally 5 parts. I think it's aligning completely with GOAT notes, right? Next, further, reliability of audit evidence. Now what do you mean by relevance? We understood. Now let us understand reliability. Relevance and reliability together is called as appropriateness. Yes or no? Yes. Reliability. So there are few generalizations about reliability. There are certain generalizations. What generalizations? Independent evidences are more reliable. If internally generated evidence is more reliable, if controls are effective. Evidence directly obtained by auditor is more reliable. Evidence in documentary form is more reliable. Evidence which is original is more reliable than a duplicate copy or a Xerox copy. Yes or no? Next. Now what are the factors that affect reliability? Reliability is affected by source, from where you are getting, nature, documentary oral, circumstances under which you are obtaining, surprise check, otherwise. Yes or no? External information may lack reliability if the source is biased. Okay, next. That's about reliability. So in exam they might ask you directly reliability concept for 4 marks, relevance concept for 4 marks. Straight away they can ask you, yes or no, depending upon source, what are the various types of evidences they can ask. What is an audit evidence, what it includes and what it excludes, 3 marks. Every topic I'm telling you, from the very first chapter I'm telling you, now no topic is unimportant. Everything is equally important and anything can be asked. Next. Next, in our question bank discussion also I showed how different corner questions they are testing. Next, what is the need for evidence? Remember, core of your audit work is in obtaining and evaluating evidence, correct? Why evidence is important means without evidence how can I form an opinion, how can I form a conclusion? So evidence collection is cumulative in nature. Evidence can also include information that is coming from previous audits. Sources, entity accounting records is primary source and management expert work is also another source of evidence. Nature, evidences are multiple types. Supportive evidences, like you get evidence, you already know some information. For that you will get supporting information, or you will get contradicting information, or sometimes the information you want might be missing, absence of information. Yes or no? Nature of evidence is three types: supporting in nature, opposing in nature, absent. Yes or no? Next, audit procedure. You will perform so many types of procedures. See, how do I get evidence? By performing procedures. What are the various audit procedures? Inquiry, inspection, observation, confirmation, recalculation, reperformance, analytical procedure. Next, remember, inquiry alone cannot provide sufficient appropriate evidence for absence of mistakes and operating effectiveness. So inquiry alone is not sufficient. You have to do reinspection, recalculation, analytical, physical verification, something in addition to inquiry. Through inquiry you get some data, but that alone is not sufficient for forming conclusions. Correct? Now, what is meant by sufficient and appropriate evidence? How they are interrelated? They both are interrelated. They both are considered together when evaluating evidence. Like sufficiency is a quantity measurement, appropriateness is a measure of quality. Yes or no? Just 1 minute. Yeah, sorry for the interruption once again. So sufficiency means quantity, appropriateness means quality. Sufficiency is determined by, there are various factors. Risk. Higher the risk, more evidence we get. Lower the risk, less evidence. Again, sufficiency is influenced by quality also. Higher the quality, we need less. More. Lower the quality, we need more evidences. Further, there are few more factors. Materiality. Less material, less evidence. More material assertion you are testing, more evidence is required. Risk. Yes or no? Of course, lower the risk, lower the evidence. Higher the risk, higher the evidence. Risk is again two types: inherent risk, control risk. What is inherent risk? What is control risk? We will be discussing in risk assessment topic. Then, size of the population. For smaller homogeneous, less evidence. For heterogeneous population, more evidences. Even in our sampling discussion also, you might have learned, for heterogeneous population, sample size should be bigger. And you should collect sample from all parts of the population. Next. Completeness. Completeness means what? It talks about relevance of the evidence. It talks about reliability. What is relevance? Just above we saw. What is reliability? Just above we saw. Logical relationship to the assertion which is tested. That is called relevance. Reliability. Reliability is influenced by source, nature, circumstances under which it is obtained. Correct? Next. Sources of audit evidence. From where? 1. Accounting records. Yes or no? And external sources. Now, obtaining sources of audit evidence. We will obtain audit evidence by performing procedures on accounting records. Determine internal consistency and agreement with financial statements. So, accounting records, you need to check whether they are consistent with financial statements or not. Then, more assurance is gained when evidence is consistent across different sources. Suppose internal evidence is matching with external confirmation, I will get naturally more confidence, more assurance. Information corroborated by independent sources is more reliable. Next, external. Audit evidence from sources outside the entity, like confirmation from third party, analyst reports, comparable data about competitors, all that. These are all various sources of evidences. One is accounting records, other one is external sources. Everything has to be consistent. That's what the middle point is saying. Clear? Next. Now, how should I obtain this audit evidence? By performing procedures. What are the various procedures you need to perform? Totally 7 types of procedures. In the printed charts, here recalculation word is there. Please remove that and put conclusion. Okay, here in the printed book, chart book, recalculation word might be there. Please remove that and then put this. Conclusion, this is actually conclusion. Okay, now what are the various procedures? Inspection. Examining records which are in paper or electronic form. Reliability is varied by source. All that when you are inspecting, reliability of records depends upon source, from where the record is coming from. Nature, original or duplicate, all that. Examples: authorization records, revenue contracts, tangible assets, all that. Now we have recently added this word inspecting. It's not there. I mean, directly in the printed notes, directly only this thing is there, but it's okay, not an issue. Okay, next. Second method in which we can obtain methods of obtaining audit evidence. This is nothing but methods of obtaining audit evidence. How in different ways I can obtain audit evidence. Second procedure is observation. Observation means what? Looking at a process or procedures which is performed by others. What is the limitation in this? You get evidence only when you are observing. You can't document it. Or no, observing, inventory counting, all that. Another way of getting evidence is external confirmation. External means what? Direct written response from third party to the auditor. Yes or no? It is used for account balances, agreement, absence of conditions, side agreements, for whatever the reason. Okay, confirming a contractual terms, confirming absence of side agreement. For example, loan agreement does not have interest point. When I asked management, there is no interest, they said, I want to confirm really interest is there or not. Are you clear? Confirming absence of terms, that's what the meaning. Next, recalculation, checking arithmetical accuracy, especially recalculation technique we apply for GST, TDS, statutory liabilities, all that, statutory dues, all that, depreciations, they and all, we will do recalculation and see whether the calculation is correct or not. In a bank interest calculations, we use some calculations and then see whether software is correctly calculating or not. Next, then reperformance. Reperformance means executing the control. Okay, auditor independently executing procedures which are originally performed by the company. Okay, next, reperforming BRS, aging analysis, all that. Analytical. Analytical means what? Evaluating financial information based on acceptable relationships between financial and non-financial data. Okay, you will analyze. What you will get? You will find fluctuations. You will find inconsistencies. What you will do? Investigate. Yes or no? Next, inquiry. Most of the auditors' work is inquiry only. Inquiry means what? Seeking information from knowledgeable person. Format, it may be in the right, inquiry can be in the form of writing or inquiry in the form of oral. Yes or no? Generally, you get response. What kind of response you get in inquiry? You get a new information, or you get supporting information, or you get different information. Yes or no? And sometimes the response will give a basis for us to go for additional work. Next step. Evaluate management's intents. Sometimes evidence obtained through inquiry, with regard to management intention, the evidence may not be sufficient. So with regard to management intention, what we need to do? Look at the past history. Look at the reasons for any specific course of action. Look at their ability to pursue a specific course of action. All that. Finally, written confirmations that you want. So all that. These are all various. Ultimately, conclusion is what? Procedures, they are used with inquiry. Yes or no? Inquiry plus all other procedures combination can be used. Previous audit evidence can also be used if at all it has a continuing relevance. Ultimate conclusion. Are you clear? All the points came almost. That's it. Now, timing of audit procedures. When we do this audit, generally, nature and timing of procedures is affected if electronic data is only available electronically or only at a specific point of time. The timing of audit procedures is influenced by the data availability. If the data is in electronic form and that too it is available only for a particular period of time, then timing of audit procedures will also affect. Some electronic information may be non-retrievable later on. And what auditor has to do in this case? Because of these data policies, auditor may request management to retain it for longer period so that until audit completes, they will retain, or perform procedures when the information is available. Any of these two options. Or no? Like they will give you a question like this. Timing of audit procedures is influenced by the fact that some data is available in electronic form. Right. So this concept you need to write. Next. Now, what are various audit procedures? Actually, above also there is a point. What are various audit procedures? They are audit procedures for evidence collection. Audit evidence is collected by performing various procedures. What are they? One. What are broad audit procedures? Whatever we do in audit is an audit procedure. That is broadly divided into two types: risk assessment and further audit procedure. Risk assessment means what? Understanding the entity and its environment, understanding internal control, identifying and assessing risk of material misstatement at two levels: financial statement level, assertion level. What is financial statement level? What is assertion level? You will understand in risk assessment topic. Next, further audit procedure. Test of controls, nothing but compliance procedure, and substantive procedure. Substantive procedures again two types: test of details, substantive analytical procedures. Now, test of controls. Why we test controls? To know operating effectiveness of controls. Controls are there for what? For prevention, detection, correction of misstatements at assertion level. When do we perform test of controls? When there is a requirement in standard or when auditor otherwise chooses. Able to. Next. What is substantive? Why we perform substantive? To detect misstatements at assertion level. It includes test of details and substantive analytical procedure. Correct? Next. Now the concept of assertion. Okay, remember one standard essay 500 is over, technically speaking. I'll come back to the assertion concept later, because let me finish information prepared by management expert. Can auditor use the information prepared by management expert? Yes, we can use it. Yes or no? When using management experts' work, the nature, timing, extent of procedures are affected by various factors: nature and complexity of the matter, risk of MMS involved, expert's work nature, scope, whether he's an employee of the company or outsider, management's control over the expert, adherence to standards, auditor's knowledge of the expert field, auditor's past experience with that expert. Can I use evidence which is prepared by management expert? Yes, you can use. Because you are using this, your audit plan will affect, right? Because when you're using, your plan will affect. So the nature, timing, extent of audit procedures, your overall audit plan strategy will affect. And what factors you will consider before you use his work? The following factors. First, what is the matter? How much risk involved? What is the expert work nature? Who is he? Employee, outsider? Management control is there or not? Auditor's knowledge of the expert's field. Auditor's past experience with the expert. Next. And now, information prepared by management. Most of the evidence that we get is information prepared by management. So, when using information produced by the entity, the auditor evaluates its reliability by obtaining evidence on accuracy and completeness of data, evaluating whether information is sufficiently precise and detailed. Next. Now, suppose if I find inconsistency or if I find doubts, what auditor has to do? Inconsistency means what? First of all, when evidence from one source conflict with other. Suppose external party gave a different information from when compared with books of accounts. Now, if there is a doubts on reliability, when auditor questions reliability, yes or no, determine what additional procedures you need to perform. Suppose if there is an inconsistency or you got a doubt, you have to perform extra. You investigate extra to know what exactly happened. Next, documentation. If inconsistent information related to significant matter is identified and conflict with final conclusion, it must be documented. SA 230 requires documentation of inconsistency specifically. What inconsistency you identified, inconsistency related to significant matter, what conclusion you have taken, all that you should document. Next, can you rely upon management expert? Yes, you can rely upon management expert, provided you evaluate expert's competence, capability, objectivity, how he performed the work, appropriateness of work as audit evidence for the relevant assertion. For the assertion that you are testing, for example, I want to test valuation of inventory. The inventory is nothing but oil well. Yes or no? So, depending how far the expert report is useful here. So, accordingly, you will decide to use it or not. Next, who is an expert? First of all, expert is an individual or organization with non-accounting auditing expertise. Nothing but other than accounting, other than audit. He is expert in some other field. Not in accounts and audit, because in accounts and audit you are already expert. Yes or no? Whose work is used by entity in preparation of financial statements. There is another concept called auditor's expert. 620, there is a standard. That 620 standard is available in CA final. That's it. 500 standard is almost done. Okay. Next, evaluation of evidence. Now we understood what is audit evidence, what is reliable audit evidence, what is relevant audit evidence, what is sufficient appropriate audit evidence, how to obtain audit evidence. Yes or no? Sources of audit evidence, nature of evidence, all that we obtain. Now you obtained evidence, right? You need to evaluate it. What you need to evaluate it? Very simple. What you need to evaluate? You have to conclude whether sufficient appropriate evidence is obtained so that risk will be reduced to acceptable low level and you can take a reasonable conclusion. That's what you need to evaluate. You evaluate evidence to know whether sufficient evidence is gathered, appropriate evidence is gathered. Can you form a conclusion or not? That only you will evaluate, correct? So, what is the role of evidence? Obtaining and evaluating evidence is critical, central for forming the opinion. So, SA 500, all audit evidence obtained, ensure sufficient appropriate. 500 talks about evidence obtaining mechanism and also talks about whether sufficient appropriate evidence is obtained or not. Next. Now we have, how do you select items for test of controls and test of details? This is actually a different concept, but it is given in the 500 discussion only. Okay. You can select 100%. You can do 100% testing or you can apply audit sampling. Sampling means what? You draw conclusions about population based on sampling. What is audit sampling? All that you will understand in sampling revision. Next, specific item testing. Specific item testing means nothing but non-statistical sampling. I will specifically test all high value items. Judgmental selection subject to non-sampling risk includes high value items, key items, risk prone items, all that. This question was asked in Jan 25 exam, I guess. Selecting specific items. Write about selecting specific items. Like this is one question has come in Jan exam. This itself, only this part, 3 or 4 marks question might come. Next, sometimes auditor might select 100%. This is generally common for test of details, unlikely for test of controls. When 100% selection is done, when small number of large value items are there, or when you identify significant risk where other procedures are inefficient and cost effective automated calculations. In automated environment also, you can do 100% testing because it's computerized. That's it. So that's regarding means of selecting items for testing. Clear all of you? With this entire 500 standard is completed. Now we still have assertions topic and audit trial topic. What is an audit trial? Audit trial means documented flow tracing transaction from source data to financial statements, or reverse, from financial statements to source data, tracking back. What is the purpose? Audit evidence. It's an audit evidence to make sure authenticity and integrity. It's a step-by-step record back to source. Audit trail, no, documents and events. I mean, the main importance of audit trail is fraud prevention. Like once an entry is recorded, later on if anything is changed, automatically every change will be recorded. So auditor automatically can question why there is a change. And the main downtime, you know, what is the downside of the audit trail? Costly. It takes so much of data. Storage, it will occupy a lot. And interpreting the audit trail takes lots of time. Of course, today so many tools have come. Next, benefits. You know, enhanced internal control. You can rebuild events. You know, identify reasons and ensure system is operated as intended. Systems with audit trail build confidence in internal control, thereby increases the confidence of auditor. Verify authorizations, enhance data security, audit enhance reliability. These are all various benefits of audit trail. A straight question can come. Clear? Next, what do you mean by assertion? Assertion means what? Assertions are management representations in financial statements. In financial statements, something is given. Building, freehold land, 1 crore. It is asserting something. Land is owned by the company. 1 crore is the value of the land. Land is physically existing. Like that, every item in the financial statement, every line asserts something. It says something. Who are saying that? Actually, management only saying through financial statements. They're all assertions. No, what auditor has to do? Verify these assertions. Correct? So, which are used by auditor to identify potential misstatement. Usage. Assets, management assets various items, measurement, recognition, presentation, all that. Auditor uses these assertions to identify whether anything is wrong. Next, categories of assertion. For transactions and events, these are the common assertions: occurrence, completeness, accuracy, cutoff, classification. Measurement. Yes or no? Account balances, generally for balance sheet items: existence, rights and obligation, completeness, valuation, allocation. For presentation, disclosure: occurrence, rights and completeness, classification, understandability, accuracy and valuation. These are various types of assertions for different. Generally, you know, P&L items, these assertions; balance sheet item, these assertions; and notes to accounts item, these assertions. There is no fixed rule like this. You can use combination. Auditor can combine assertions if at all. See, ultimately you need to cover all the aspects when you are verifying. So you can combine and then use also. Next. Sometimes assertions is also influenced by laws and regulations. Next, nature of assertion. Assertions can be explicit, okay, or assertions can be implied. For example, in balance sheet, for example, asset schedule you take, depreciation schedule. There is no item called building. Building item itself is not there. It's an impliedly saying that we don't have building. Suppose they say building, put 0. They're directly saying that building value is 0. Yes or no? Secured loan. Explicitly they are saying the loan is secured. Are you clear? Next. Now, there are different types of assertions called negative assertions. Negative means what? Negative means these again, negative assertions are again two types: explicit negative assertion, implied negative assertion. For example, I am stating there is no contingent liability. Specifically, I am writing contingent liability heading I put, and below I am writing there are no contingent liabilities. Explicitly, I am saying not there. Suppose if contingent liability itself is not there, it's an implied negative assertion. Suppose there is no building, that's an implied assertion. That too, negative assertion. Negative means what? Not saying. Asserting means saying. Negative assertion means not saying. Clear? Next, ultimately, what is the important thing? Auditor has to form overall representations about financial statements. Correct? Auditor examines all assertions to form overall opinion, combining individual judgment. This is the biggest standard in the audit evidence topic itself. 25 minutes it took. That too, I think here I gave little explanation also. Yes or no? So a decent explanation I gave, minimum explanation only I gave. 25 minutes it took. Remaining all put together, we need to finish in another half an hour. Not half an hour. Already sampling and 520 we already done. Okay, that itself already took some 25 to 30 minutes. I think this chapter, quick revision itself, is taking close to 1.5 hours. Okay, no problem. The lengthy chapter, 8 standards are there, 2 different topics were there. Okay, 5 minutes, we'll continue in the next session. Yes, let's continue the discussion. Let's now discuss 610 standard, SA 610, using the work of internal auditor. There are two ways in which internal auditor work can be used. One, type 1, work which they perform, that workings we will. Type 2, will take direct assistance from them. In the sense, as a part of our team, we will take them direct. Okay. Now, so first of all, what is an internal audit? It's a function in an organization providing assurance consulting services to evaluate and improve the important processes in the company. So internal auditor mainly deal with three issues: governance, risk management, internal control. Governance, they evaluate processes related to ethics, values, performance, accountability, and communication. Yes or no? Risk information, control information, communication among top management, how everything is happening, that and all they evaluate. So one of the role of internal auditors is evaluation of governance processes. 2, risk management, they identify and evaluate significant risks so that they will contribute to improvement of internal control. See, internal control can be designed only when the risk is identified correctly. Next, they assist in fraud detection. And ultimately, internal control, they review and recommend improvements to the control. Already implemented controls, they do review and recommend improvements. They test controls on how they were designed, how they were implemented, and how they are operating effectively. And they provide assurance on internal controls which are relevant to audit. And above all this, they also examine financial and non-operating information, including testing transactions and balance. So these are the main objectives. And remember, further, they also do review operating activities. They also review compliance activities. They check economy, efficiency, effectiveness of operations, resources consumed, all that. Remember, internal audit scope is very wide. Okay. Now, compliance, they also review how the company is adhering to laws, regulations, how the company is adhering to management policies, how internal rules and regulations and directives are followed. So this is the entire internal audit function and their objective. So internal audit function means what? Objectives. 3 objectives: governance, risk management, and internal controls. 2 types of usage of work of internal. One, using IAF's work directly, where first, we use it if it is not prohibited by law. Further, external auditor evaluates the work before use. So it is partially substituting my work, the work which I have to do and gather evidence, right? Instead of me doing and gathering evidence, they already gathered evidence. That evidence we will substitute in our audit. Next, direct assistance. Internal auditor performs specific procedures under external auditor's direction, supervision, and review if permitted by law. Okay, just 1 minute. Yes. So we understood. There are 2 types of works. Okay, type 1, where you will use the work of the internal auditor. Type 2, direct assistance. Now, what is your responsibility as per this standard? See, you can use the work of internal auditor, but you only have ultimate responsibility. Just because you are using the work of internal auditor, you cannot blame him later on. If tomorrow, if something goes wrong, you only have to answer primarily. Next, external auditor is solely responsible for the opinion. This responsibility does not reduce by using the work of internal auditor. Now, external auditor is not required to use internal auditor work. There is no compulsion for you. Okay, if you want, you can use it. Discretion is to decide. It is your discretion whether to use it or not. Now, so if at all you are using, then 610 tells you how to. It provides entire framework, yes or no, so that you can avoid undue dependence on the internal auditor. Next, what is the objective of external auditor? Main objective: determine whether internal auditor or direct assistance can be used. If so, identify area to what extent it can be used. Type 1, yes, internal audit work is adequate. Suppose you are using that work, you took, see whether the work is adequate, sufficient or not. Type 2, adequately supervise, direct, review internal auditors who are performing as part of your team. So this is the objective of the standard. Next, now type 1 work. Suppose I wanted to use internal audit function for type 1. I need to check 3 important things: objectivity, competence, systematic and disciplined approach, are they following or not. Objectivity, yes, internal audit function, organization status, and policies and procedures supporting their independence. Like key factors: what is the organization status? Do they have a direct access to top management? Are they free from bias? Are employment decisions overseen by top management? Internal auditors employment decisions, are there any restrictions on internal auditors to communicate findings? And do internal auditors have any operational duties? These will give you an idea about objectivity of the internal auditor. Competence, evaluate IAF's competence and skills, like what kind of resources, the internal audit system, the internal audit size, resources, are they fully resourced, and how are they being hired, what is their technical skills, what is the financial reporting knowledge of frameworks. Like, what is the knowledge of internal auditors financial reporting framework? I mean, what is the knowledge of internal auditors on financial reporting frameworks? This will decide their skill. Next, do they have a systematic approach? Does internal auditors apply a structured approach along with quality control? Do they have any internal audit procedures, policies, controls, quality control system? Are there any existence of documented policies and procedures? Check out. By checking all these three, you will understand whether internal auditor work is worthy or not to use it. Now, and remember, objectivity and competence, no, they both are interrelated. Okay, both are critical. Stronger objectivity and competence more likely to use the work. Objectivity alone cannot compensate for lack of competence. See, he is not competent, but he is very independent. That does, I mean, work is useless. Or he is not at all objective but competent. We can't believe that work. Able to understand? Next. Now, in the following circumstances, external auditors shall not use the work of internal audit function. They are lacking objectivity, they are lacking competence, they are lacking systematic and disciplined approach. So, what, you know, in exam, no, they might ask you like this only. So, write about objectivity. What are the key factors? 4 marks question. Understood? Or write about competence. What are the key factors? 3 marks question. Or they might ask you, why write about interrelationship of objectivity and competence? 3 marks question. Under what circumstances external auditor shall not use the work of internal audit function? 3 marks question. Any way they can ask. See, at some places I'm telling this. That doesn't mean only they are important. Every question is important, every concept is important, but at certain places I'll be telling. Okay, next. Nature and extent of IIF to be used by. To what extent I can use the work? What kind of works I can use? Very simple. You can use for testing operating effectiveness of controls. You can use their work for performing substantive procedure with limited judgment. You can use them for inventory counting. You can use them for tracing transactions through the systems, audit trail, all that. You can use them for testing with compliance with laws and regulations. Okay, examples. But remember, okay, fine. External auditors decide to use IAF based on nature, scope, and its relevance. So, how far the work is relevant, what nature of work they are performing, what is the scope of work that they have. Based on all this, he will use. Examples of what works we can use here we have given. You see, limited judgment here. If at all there is a more judgment involved, we prefer not to use. Next, circumstances where internal audit function work is used less. External auditor will perform the work directly. When more judgment is involved. So, and when high risk is involved, when the internal audit is lacking objectivity, when internal audit is lacking competence. In these 4 circumstances, we majorly perform the work directly and use of their work less. Easy, straight question can come. Next, suppose no, I decided to use his work. External audit procedure, when he planned to use the work, first discuss planned usage. First you tell the internal auditor that I want to use your work, so that you both will coordinate. So that timing, nature, extent of IAF work. So you will tell him when you will use the work, so that he will also plan his work accordingly, so that it will be useful to the external auditor. Materiality levels, sampling methods, documentation, review and reporting. If I discuss the planned uses at the beginning itself, no, internal auditor when he is working, no, he will keep in mind my requirement, and accordingly he will be working. Next, review internal audit reports. External auditor reads internal audit functions report to understand procedures and finding, and perform. External auditor performs sufficient procedures on the IIF's work. So whatever work he performed, right, take that work. You apply audit procedures on that. You verify whether that work is adequate for your purpose or not. Next. Finally, there must be effective coordination between external auditor and internal auditor. There must be regular discussions. Meetings happens throughout the period, and external auditor informs internal auditor significant matters which will affect their work. Same way, internal auditor also shall inform external auditor any important matters. EA has access to IIF reports and is informed of significant findings from IIF. Easy. Coordination must be there properly. Next. Type 2, external auditor usage of IIF staff for direct assistance. Type 2, first of all, direct assistance means what? Internal auditor performing audit procedure under external auditor direction, supervision and review. What you need to evaluate? Competence you need to evaluate. Yes or no? External auditor must assess competence if not legally prohibited. Must inquire into relationships affecting objectivity. Nothing but objectivity and competence. If both are lacking, don't use it. That's what third point. Significant threats to objectivity, insufficient competence, do not use direct assistance. Fourth one, suppose I decided to use direct assistance, but certain works, few kinds of works, don't allocate them. What are they? Significant judgment works, high risky areas, work which is already performed by them only, and any decisions under 610. Under this standard you need to do certain works, right? Don't delegate to them. This is something you need to do. 610 standard says some works you need to do. that you only have to do. Next, finally, before you take them into direct assistance, get acknowledgement from management, get agreement from internal auditors both. So from management, that they will allow internal auditors to work under the direction of external auditor without any intervention. From internal auditor, they maintain confidentiality and report any issues that they are facing from management, like threats to objectivity, all that. Over 610 standard, over 10 minutes. Neatly covered. Yes or no? That's it. Yes, let's continue. SA 501, audit evidence, specific considerations for selected items. There are 3 selected items. One is inventory, another one litigations and claims, another one segment information. What you need to specifically consider? Existence and condition of inventory you should consider. Completeness of disclosure of litigations and claims you should consider. Disclosure of segment information in accordance with applicable financial reporting is what you need to consider. You need to get evidence for all of this. That is what objective of 501. Now directly let's first discuss litigations and claims. What is the audit procedure for litigations? Yes or no? Litigations and claims can materially impact the financial statements. So what auditor has to do to identify litigations and claims? First, inquire management, in-house lawyers, review top management meetings, consult external legal, look at the correspondence between management and external legal counsel, ELC, shortcut is ELC. Review legal expenses account, use risk assessment procedures and risk assessment performed by management. That insights you look into. Sometimes you have to directly communicate with external legal counsel. When you identify risk of MMS or other material litigations you are suspecting, if you think there is a risk is there, like some litigations might be there which management is not disclosing you, if you think like that, or some other litigations or you are suspecting, you better directly contact the external legal counsel. How can I directly contact? Through general letter of inquiry. Request direct communication. If prohibited, perform alternative. Suppose sometimes lawyers they may not respond to a general letter. That time you send them specific inquiry. Specific inquiry is what? You provide a list of litigations and claims. You tell what management told you regarding the same and request them to confirm whether management's point is correct or not. Able to understand? That is specific letter of inquiry. I told you in the class also very in depth. What is specific inquiry? What is general inquiry? All that. And sometimes you might be meeting ELC. When you will meet external legal counsel directly, under what circumstances you will meet? Remember this direct communication, 3 marks direct question. Meeting LLC, 3 marks direct question might come. When you will meet, significant or complex risk exists, or there is a disagreement between management and external legal counsel. If there is a disagreement going on between management and third party lawyer, external legal counsel, what exactly happening? For that reason you can meet them. By the way, in order to directly communicate or in order to meet them, you need management permission for that. Next, suppose if management refuses direct communication or meeting, or external legal counsel does not respond, and you are unable to obtain through alternative ways evidence also, then modify the opinion, because there is a limitation in the scope. That's it. That's regarding litigations and claims. Now next one, segment report, segment information. That's the third item in the standard. Segment information. Auditor must obtain evidence whether segment information is as per applicable framework. Yes or no? You need to, what audit process you need to perform? You need to understand testing methods used by the management. You need to perform analytical and other procedures, to know how many to know whether segment information is correct or not. When you are understanding the methods of the management, you need to focus on sales transfers, budget comparisons, asset allocation, and consistency with the prior periods. So this is something that you need to understand. When you need to focus on when you're understanding methods. This itself has been asked as one. In Jan 25 or somewhere, this was asked as a 4 marks question. Next, and by the way, remember, we don't give any separate opinion on segment information. We just want to know whether segment information is presented as per applicable financial reporting framework or not. That's it. Then finally, come back to the first one. Okay. Now, with regard to inventory, what is the objective? You need to get evidence about existence and condition. You want to get evidence about existence and condition of the inventory. For that, you need to attend physical inventory counting. For getting evidence on existence, attend physical inventory counting. Yes or no? So what is that? Auditor attends to evaluate management instructions. What instructions management gave, what procedures management gave. He will observe how they are counting. He will also inspect the inventory, and he will also do test count. Then he will do a final verification of records. So he will attend physical inventory counting, check what they are doing, and finally he will review the records also. Suppose next. And when you are attending in physical inventory counting, what it involves? You do check in, you inspect inventory to know its condition, to know its existence. You observe how management count procedures are implemented. You obtain evidence on reliability of management procedures. What nature of procedure? What is the nature of procedure? By the way, you are attending inventory counting, right? What is that? Is it a control? Is it a test of controls? Or is it a Test of details. What exactly this is? Depends upon the auditor's risk assessment. This may be test of details or this may be test of control. Attendance at physical inventory counting can be a compliance procedure or it can be a substantive procedure. Next, there are certain matters which are relevant when you are attending, like nature of inventory. What is the nature of inventory? Work in progress completion stage, how much? Risk is how much? Internal controls are how? Adequate instructions provided or not, check out. When they are counting, timing, are they using perpetual systems or not? Inventory, where it is located, what is the materiality and risk to determine whether attendance is necessary or not, and is there any experts requirement? These are the matters that you need to consider. This itself can be asked as a 4 marks question, and it was asked many times. Clear? Next, suppose if inventory counting is performed other than balance sheet date, other than date of financial statements, okay. If inventory is counted other than financial, you need to perform additional work. Above, no, you attend inventory, right? You observe management count procedure, you do inspection of inventory, you do test counting, everything common. In addition to that, you need to verify adjustments to perpetual inventory records. You check reliability of the records. You will investigate difference between physical count and perpetual records. Ultimately, the objective is to ensure recording of inventory changes between balance sheet date and count date. So you are attending on a different date for counting. Yes or no? Between balance sheet and count date, whether transactions are correctly recorded or not, you need to check it. Next, suppose you are unable to attend inventory counting due to unforeseen circumstances. Try attending on alternative date. Perform procedures on intervening transactions. You planned on so and so date, but somehow it was cancelled. Then you go for another date, and then whatever the date you planned and the later date, what are all differences happen, sales, purchases, you try to get evidence for that. Next, suppose physical counting impracticable. Perform alternative ways to know existence and condition of inventory. If alternatives are not there, modify the opinion. Yes or no? By the way, just because it is inconvenient to go there, or time is not there for you, or going there and all is a costly affair, if at all you think like that, that is not a valid reason to omit inventory attendance. The matter of time, cost, difficulty in itself is not a valid basis for the auditor to omit an audit procedure or to be satisfied with an evidence that is less than persuasive. Like this we have seen one sentence. So no. Now, alternative procedures means what? Inspect documentation of subsequent sale. If at all from the godown subsequent sale is happened, inventory moved out. That means in the godown inventory is there, right? So that's it. Next, suppose modify the opinion if there is no alternatives. Yes or no? What is the audit procedure if inventory is in the control of the third party? Inventory held by third party. Get sufficient appropriate evidence regarding existence and condition. For that, what you need to do? 2 procedures. 1, get confirmation. Request confirmation from third party regarding quantity and condition. Or perform other procedures. If at all third party confirmation you don't want to believe, or you want extra evidence, then you inspect documentation when the inventory went there. You request confirmation from other parties, other auditors, attend or arrange another auditor, get a service auditor report on the third party internal control. For this I told you Amazon example, Amazon warehouse example, service auditor, SOC audit, 402 CA final we have. In CA final we have a standard called 402 3402. There we will understand. Next, that's it. 501 standard is over. 7.5 minutes. Easy. Yes. Now let's continue SA 505 external confirmation. What is external confirmation? External confirmation means it's a direct written evidence obtained from third party by the auditor. Yes or no? Now, this external confirmation is of 2 types, positive confirmation request and negative confirmation request. Positive means what? The third party responds directly to auditor whether he agree or disagree, or he will provide the information requested by the auditor for sure. Negative means what? He will respond only if they disagree with the information which we already provided. Non-response. Sometimes they will fail to respond fully to a positive request, or some request is undelivered. Getting a non-response means what? Request is undelivered. Yes or no? A returned undelivered request, or failure to respond fully to a positive confirmation request. Remember, the non-response is only in the context of PCR. For NCA, there is no concept of non-response. Yes or no? Next, exception. There is a word called exception. It is difference between entity information, or that is what we requested. Whatever is there in the entity record, that only we requested third party, and the conforming party information. So whenever there is an exception, you need to analyze for impact on the population. Yes or no? Next, what is the external confirmation procedure? First, determine information to confirm. Which information? External confirmation is generally used for account balances, elements, terms, contracts, transactions, or for getting to have an idea about absence of certain conditions. Yes or no? Now, then you select the party. choose a party who is knowledgeable about the information. Then design the request. When you are designing, no, you need to keep in mind certain factors, assertions that you are asking, RMM, layout, past experience, communication method, management authorization, confirming party ability. All this you need to consider when you are designing, because design impact response rate, okay, properly, and moreover it must be properly addressed and include a written address also. Next, sending the request. Send the request including follow-up request if at all require. For higher reliability, use always positive confirmation request where the third party has to fill, though response rate is lower sometimes here. Next, suppose if management is refusing the auditor to allow external confirmation, first inquire reason, understand the management's reasons for refusal, and ask and seek evidence to validate them, and assess impact on risk of MMS, modify the nature, timing, and try to perform alternative procedures. Suppose performing alternative, like obtain evidences through alternative. For example, for receivables, I am not able to contact the debtor, I will see subsequent whether we received or not. Shipping bills and all I will see. Suppose if refusal is unreasonable, management explanation you felt unreasonable, that is invalid, or alternative is not possible, I will communicate with top management and see whether there is any fraud risk factor or not. Ultimately, if at all I am unable to get an evidence, I will modify the audit report as per 705. Next, negative confirmation request as an audit procedure. Can I use a negative confirmation request? It provides less persuasive evidence, remember that. And what are the conditions for using NCR? Here, earlier we gave the same statement. We gave the same statement in the heading. In the printed book, you will find the heading. Here I have changed it. They are nothing but conditions. Of course, below the same point is already there. Below already it is there. Negative confirmation, can I use it as a substantive procedure? Yes, you can use if at all the following conditions are met. 1. Low risk of material misstatement and controls are effective, and the items is small, homogeneous, very low exception rate, no indication recipients will disregard. Nothing but recipient pakka will reply me. If at all something is wrong, he will pakka reply me. He will not disregard my request. If all these conditions are satisfied, then you can use NCR as a sole substantive audit procedure. Understood? Now, suppose you auditor used an NCR and he didn't get any response. How should it be interpreted? Non-response does not explicitly confirm receipt or accuracy. He didn't respond. That doesn't mean he agreed. Yes or no? So, provide significantly less persuasive evidence than positive. Recipients, they will be less likely to respond if information is in their favor. Therefore, making NCR less effective for detecting overstatements. Are you clear? That's it. Over. 505 is over. Finally, one more small topic. Finally, once you perform external confirmation, you will get evidence, right? Yes or no? You will get confirmation, right? I mean, what is the result of external confirmation process? Under 505, what result you might get? Auditor must evaluate result of auditor must evaluate if confirmation result provide relevant evidence or not. Now you will get 4 categories of results. What result? The third party will agree with you, or you may get a response which is not reliable, or you didn't get any response, or you got a response where the third party disagreed with you. Exception or no? Now conclusion. This evaluation combined with other audit procedures, it will help you to determine whether sufficient appropriate evidence is obtained or whether additional procedures you need to perform. 505 is over. Easy. I think everything we covered neatly. Even explanation also I gave. Just 5 minutes. Over. Next. 510. Initial audit engagement and opening balances. The standard specifically focuses in the context of initial audit engagement, you must obtain opening balances. Why? Initial audit engagement is an engagement where prior period financials are not at all audited and you were appointed as an auditor for the first time now, or you previously some other auditor was there and now you were appointed replacing him. So in all these cases, opening balances you didn't audit. So that's why you need to obtain sufficient appropriate evidence regarding true and fairness of the opening balances. Now what is an opening balance? It's an account balance. It's an account balance, which is there at the starting of the period and reflect prior period transactions, events and policies. And it also includes disclosures in the prior period. Now, who is the predecessor auditor? He is an auditor from different firm who audited prior period financial statements and now replaced by you. Next. What is the objective of this standard? You need to obtain sufficient appropriate evidence that opening balances do not contain material misstatement affecting the current period, and you also want to get an evidence that accounting policies are consistently applied and any changes they are properly accounted and disclosed. What is the audit procedure for opening balances? Very simple. Verify prior period closing balances. Are they correctly brought forwarded? And they reflect accounting policies. Perform procedures like review prior period financials, evaluate current evidence for relevance, specific opening balance procedures like trial balance comparison with balance sheet, audited balance sheet. Next, suppose no, if misstatements is identified in opening balances, perform additional procedure to know what is its impact and communicate the findings to management and those charged with governance accordingly. Next, now what is the nature and extent of audit procedure for opening? This I will come back to it later. What auditor conclusion regarding accounting policies, what you will report? If accounting policies are not consistently applied or changes are not properly accounted and disclosed, then you will give qualified or adverse opinion. Opening, suppose if there is a material misstatement in opening balance which is affecting current period and is not properly rectified now, then qualified or adverse. Suppose you are unable to obtain evidence on opening balances, then you will give a qualified or disclaimer. Yes or no? Next, what is the audit procedures for opening balances? Nature and extent of procedures. What is? It depends upon accounting policy, nature and risk, significance, and predecessor auditor's modified opinion. These factors influence me to what extent the procedures, to what extent I perform opening balance related audit procedures. Next, reliance on predecessor. If prior period financials are audited by predecessor, review their audited financials and supporting documents for evidence on opening balance. You can absolutely rely that. You don't have to question it. And usually we rely upon prior period closing balance unless in current period some other amounts were revealed. Suppose opening debtors 1 crore, current year 50 lakhs only settled, account is closed. Okay, 50 lakhs right, or they wrote off discount or something they wrote off. So immediately I'll get a doubt on opening balance. Next, for current assets and liabilities, evidence is often obtained during current period. With respect to current assets and current liabilities, for opening balances, current year settlement would have happened, no? That itself is an evidence. Like for accounts receivable and payable, no? Actual collection you can check, actual payment you can check. Yes or no? It will provide a stronger evidence. Assertions, no? Valuation, it will give a stronger evidence. Assertions covered. Provide stronger evidence for existence, rights, valuation, all that. Next, inventories. Observe, count, and reconcile to opening. You go surprise check. Check physically how many were there and reconcile it to opening. You will understand last year closing balance correct or not. Yes or no? Value opening inventory. Then you will understand automatically whether inventory valuation in the opening balance is correct or not. Next, for non-current, evidence is obtained by examining records, confirmations, and other procedures. For current assets and liabilities only. For current assets and liabilities, no? For current assets and liabilities, no? Actual collection, all that you can easily cover existence, rights and valuation, rights and obligations and valuation easily for account receivable and payable. You can easily check in the current period. Yes or no? With regard to opening balances. That's it. Completed. 510. Easy. All of you. Then 550. If this is also completed, this chapter is completed. Yes or no? 520, 530 is already covered. Next, 550. Related parties. So who is a related party? Who is a related party? Related party means as per applicable framework you take. In accounting standard we have, in days we have. So take the definition as per accounting standard. Suppose if accounting standard is silent, if financial reporting framework is silent, who is a related party? Related party means the one who is controlling over the reporting entity. We are the auditors of reporting entity. The entity which is controlling or influencing the reporting entity, or another entity where our reporting entity is controlling or influencing, or another entity and our entity both are under common control. All are related parties. However, remember, state controlled entities, they are not related parties. State control means what? Government owned companies. Just because in all government companies common owner is there, we are not related parties to each other unless we engage in transactions and resource sharing. Next. What do you mean by control? Control means power to govern. Significant influence is participate. Governing is different, participating is different. And now indicators. How do I know whether there is a control or influence? Equity ownership, financial interest will be there, key management roles will be there, close family connections will be there, key business relationships with the management. These all indicates some control or influence might be there. There will be some related parties who have a dominant influence. Note that related parties may exert dominant influence, heightening the fraud risk. Next, sometimes special purpose entities may be related parties, regardless of equity. They may not have ownership, but still they might be controlling. They might be related parties. Next, now in related parties, you first have to verify nature of related party relationships and transaction. Most of the related party relationships and transactions occurs in normal terms, not necessarily posing higher risk. Just like unrelated parties, how I do business, with related parties also I do the business. There won't be any risk difference. The nature of RPRT can inherently increase, material misstatement risks. In some cases, high risk will be there. Complexity. If the transactions or relationship is complex, information system is failing to capture related party relationships and transactions. These are all risky areas. Or transactions may deviate from normal market terms, in the sense transactions are not happening at arm's length price. In all these cases, we consider that related party relationship is high risk. Generally, they may have same risk like unrelated party, but in these cases, related party risk will be high. This itself can be asked as a 4 marks question. Next. So, auditor has to understand entities related party relationships. How you will understand? Inquire. Auditor will inquire. Identify related parties. Are there any changes from last year? What types of relationships between the entity and related parties? Who are the related parties? What relations? Subsidiary, associate, a director interested company? What exactly? And see whether any transactions have happened. What is the type of transaction? What is the purpose of the transaction? Next, risk assessment. Understand controls to identify, account for, and disclose. Did the company implement any policy to identify related parties and record the transactions? All that. And see authorization controls. Who is authorizing related party transactions? Companies Access 177, audit committee has to authorize. And see, is there any controls for transactions which are outside normal terms? Special transactions. Is there any special authorization procedure for that? Check out. So this is risk assessment procedure related to related party. Next, smaller entities. Control environment in smaller entities is different. Yes or no? Governance may lack outside members. Means only single person will be their owner, or 2 or 3 will be there. Owner manager himself might handle governance, and typically less formal control, no documented processes. Documented process and all will be missing. And the owner himself mitigate the entire risk, or he himself increase the risk because single person is handling. So auditor's approach: inquire management, observe management oversight, inspect documentation to understand related party relations and transaction in case of smaller entities. Then finally, how do you verify related parties are existing? How do you verify the transactions are there? You will verify the following records or documents. Examples: income tax returns, information supplied to regulatory, shareholders registers, entity investment records, agreements with key management, specific invoices, life insurance policies, to know nominees who are there, internal auditors report, documents filed with the regulator, significant contracts renegotiated or negotiated during the year. All these documents will give you hints about related party relationships and transactions. That's it. 550 is over. Clear, all of you? That's it. Next 530, 520. With that, this chapter will be over. Clear? Yeah. Now let's do a quick revision of audit sampling standard 530. This particular revision you need to watch only after you finish the actual lectures of the sampling, or at least revision marathon, if at all I uploaded on the YouTube. To best of my knowledge, on 530 I didn't upload any revision marathon, but my old previous marathons were there on 530. So even if you watch that, you will be able to decode this. Okay. Now, so audit sampling, the structure of the entire standard from the GOAT notes is maintained here in the chart notes also. So introduction to the sampling, first one. Earlier, we used to check all the transaction which is economically wasteful. Now, routine checking, that's called actually routine checking. Routine checking means what? Extensive vouching of all the entries without considering the concept of materiality. Whereas as the time passed by, there is a change from routine checking to checking of internal controls, checking of principles, checking of processes. Effective internal controls have reduced frauds and errors. In many companies, controls are implemented so strongly where the frauds and errors have been reduced. Therefore, auditor has to now decide extent of checking determined by auditor's judgment. Yes or no? So remember, ultimately the auditor's objective is to give opinion on the financial statements. And remember, auditors, is it compulsory for us to use sampling? No. Is it compulsory for us to apply sampling technique? No. But practically we have a limitation. We don't have an option. Yes or no? So, and whenever you are applying sampling, you should rely upon recognized sampling techniques like stratified sampling, simple random sampling, all that. Statistical sampling is scientific, reliable, and allows a fair opinion without checking all the. This is introduction to. In exam, they might ask you, write about introduction to sampling. Then next, what is the objective of auditor? What is the objective of auditor? What is the objective of auditor? The objective of auditor is what? First of all, audit sampling means what? Meaning applying audit procedures to less than 100% of the items. 100% of the items is called as population. Less than that, if you're applying audit, then that is called audit sampling. What is the objective as per this standard? Ultimately, to obtain reasonable basis. See, you are verifying sample in order to draw reasonable conclusions on population. So SA 530 applies whenever audit sampling is used for audit procedures. So sampling approaches, we have two approaches. One is statistical and non-statistical. So what are the key elements in entire SA 530? What SA 530 is addressing? What SA 530 is covering? It talks about designing and selecting sample. It talks about performing test of controls and test of details using sampling techniques. It talks about evaluating sampling results. Yes or no? At the end of the last video in the sampling topic, we clearly discussed this entire chapter structure. Next. Now, what do you mean by population? And what are the characteristics of the population? Population meaning, okay, fine. Population characteristics directly. Population means all items in the, all sampling units put together, we simply call it as population. Now you look at here. Meaning, population must be relevant to specific objective. By the way, characteristics are three. Appropriate. Population must be appropriate. Population must be complete. Population must be reliable. Appropriate means what? It must be specific to the audit objective. Like appropriate population, relevant to population, nothing but if I want to check existence, actual transactions recorded. If I want to check completeness, supporting records. Remember that example? Purpose. Procedures applied on sample. Example, testing, 1 minute. What is this? Yeah, testing accounts receivable. Actually, this is a shortcut of the example. Testing accounts receivable overstatement, or you can say testing sales overstatement. Here instead of AR, you can also use the word sales. If you want to check sales overstatement, use actual receivables testing, listing, actual sales recorded. Suppose you want to test understatement, you need to verify not recorded one, but you need to verify supporting items like payments, stock registers, like that. Yes or no? Completeness. You must include all items throughout the entire period, throughout the entire audit period, for which year, whatever the year we're performing the audit, all the transactions must be included. Only then you need to select sample from. Yes or no? Then reliability. Population must be sufficiently complete and accurate. Auditor has to perform certain procedures to ensure reliability. Whether the population is reliable or not, first I will have to perform controls, evaluation, all that. Then auditor must obtain evidence about accuracy and source. How do you know whether this is accurate? What is the source? Then if population is not reliable, sample will not be relevant for audit objective. Sampling unit. Individual items in population is called as sampling unit. Audit processes will be applied on selected sampling units with conclusions projected to entire population. Sample conclusions is equal to population conclusion. Whatever conclusion we get on sample, the same conclusion we take on the population. Suppose if sample conclusion, and if at all I check entire population separately once again and gets a different conclusion, then the sample is not representative. This is called sampling risk. Yes or no? Then for trade receivables, sampling units can be customer balances, sales invoices, all that. Next, approaches. Types of sampling. There are two approaches, statistical and non-statistical. Auditor decided which approach to follow. And remember, sample size is not a differentiating factor between these approaches. Statistical, random selection, probability theory, we measure sampling risk reliably, we employ mathematical or statistical methods. Non-statistical, which does not have the features of statistical sampling. Then ultimately, whether you follow statistical or non-statistical, all that is unnecessary. Your sample must be representing all the characteristics of the population where the sample risk will be low. Yes or no? So representative sample should be mirroring the population. Sample should closely mirror the population, represent the population. Sample size must be sufficient so that you will get a meaningful result. So sampling process, we perform on test of control, we verify test of details. Why are we verifying controls? To find deviations in control so that our risk assessment will change. Okay, why do we perform test of details? To find misstatements. Yes or no? Able to recollect? Next. Now, difference between statistical and non-statistical, it will be similar, which we already saw just now. So there won't be much difference even if you read also. Now, how sampling is different from traditional methods? From traditional methods, auditor will get a better satisfaction. Auditors can gain sufficient assurance with less checking using sampling, as even 100% checking cannot give you absolute satisfaction. Randomly chosen samples reflect all the population features. Sample reliability depends on effectiveness of control. Test of control, sampling assess control effectiveness. Strong controls permit smaller samples. Sampling is an estimation process with obviously some errors. Yes or no? Acceptable error tolerance is based on auditor's judgment. Tolerable error, nothing but. Factors for extent of checking on a sampling plan. What factors? Size of the organization, internal control state, books and records, tolerable error, desired confidence. Easy. Next, advantages of a statistical sampling. What are the advantages? Not proportion to the sample population size. Sample size need not increase in proportion to the increase in population. Sample size is objectively we select the sample. With a minimum sample size, we can calculate risk. We can calculate with precision. Estimates probable difference. Reduces clerical processing. No sampling, low non-sampling errors. Scientific and reliable. Any 3 or 4 points you can write in exam. Then when not to use sampling, 100% accuracy required for you because of legal requirement or regular requirement, whatever reason, then you can't use sampling. Technical knowledge gap, nothing but you don't know how to use a sampling. Insufficient sampling sampling skills. Better alternatives. There are more efficient ways to do. Suppose their small population size is very small, 100% verification gives you more clarity, then go with that method. Requirements as to sample design, sample size and sample selection. Sample design, consider the audit purpose, existence, completeness, valuation of what exactly you are checking, and population characteristic, heterogeneous or homogeneous. Sample size must be sufficient to reduce sampling risk to an acceptable level. Sample selection, ensure that every item in the population has a chance of selection. See, it may be equal chance, it may be unequal chance, doesn't matter, but everything should have a chance of selection. Then only that selection method is proper. Next, factors while choosing sample design. Purpose of audit. Yes or no? Purpose of audit. I think here just a minute. Yeah, I think both are right. Purpose of audit procedure, here you can simply strike off this, not required. Okay, you can strike off that, you can just keep this first point. Purpose of audit, nature of evidence you want, and what constitute misstatement you should first define, and test of controls and test of details. SS expected rate of deviation to determine sample size. Evaluate expected misstatement level, all that. Factors that we will use while using sample design. Here no, better refer GOAT notes once, because this even if you read short notes material, you may not get sometimes the clarity. So better read GOAT notes material. Okay, next, stratification, dividing the population into discrete. Discrete means nothing but different strata, different subgroups. Stratification improves audit efficiency. Objective, samples from all population segments. Monetary value, often uses monetary values for test of details. Stratum specific projection, obviously in a stratification, we project to stratum, then all the stratums we total, that is what combining all the stratums projection, correct? Next, value weighted selection. Monetary amounts, sample design prioritizes monetary amount, sample size, sample selection, everything is expressed in monetary terms. In case of test of details, individual monetary units will be there, right? They are nothing but monetary units, value weighted selection. In a value weighted selection, the focus is on larger values. Larger value items will have a greater chance of selection. Even if it is higher chance of selection, the sample size will be smaller. And it is best to use it with random selection. Most efficient with random selection. You can also use with systematic sampling also. Stratification, you can value weighted selection, you can apply even in interval sampling, block sampling also, but it is best with random sampling. That's why monetary unit, stratified random sampling. Next, sample size and factors affecting them. Sample size, auditor decided sample size to reduce sampling risk. Lower the risk, larger the size. So sample size is decided by formulas, scientific formulas and professional judgment. Factors for test of control, more assurance, higher expected rate of deviation, higher desired assurance the auditor want. These are various factors. Yes or no? Expected rate of deviation, auditor's understanding of the business, personal changes, prior audit results, all that, remember. Next, factors that will decrease the sample size. Here no, factors that increase the sample size. What factors decrease? You have higher tolerable rate of deviation, you can decrease the sample size. Population size on sample size decision has a minimum impact. Yes or no? For smaller population, sampling is not efficient. Next, then Then we have factors. Yeah, factors for test of details. See, test of details objective is to detect MMS. Factors increase sample size, higher risk of MMS, higher expected misstatement, higher desired assurance than that tolerable misstatement is not exceeded by actual misstatement. Not exceeded by actual misstatement. That's actual complete sentence. Clear? And what factors will decrease? Greater reliance on other substantive. Suppose if you're relying more on other substantive, automatically test of detail sample size will decrease. Higher tolerable misstatement, sample size will decrease. Stratifying population with wide range of, like if you're stratifying with wide characteristics the population, you can reduce the methods of sample. Simple random sampling, equal chance for every unit, uses random numbers to avoid bias, ideal for homogeneous population. Stratified, divides heterogeneous population into homogeneous strata, subpopulation, samples drawn from each stratum. Auditor determines the number of stratas. Example, different percentages for, varying balances range up to 5 lakhs, up to 10 lakhs. How much percentage you should select? Yes or no? Yeah. Systematic, sampling interval based on population size. Starting point will be random. Must avoid patterns aligning with some set of transactions, remember. And caution, risk of unrepresentative sample if interval is matching with some hidden pattern. That's a risk here. Next, monetary, value-weighted selection where evaluation is completely based on monetary amounts. Haphazard sample, no structured approach. And auditor will be avoiding bias, by the way. But this is not statistically superior. All units will have a chance of selection. Whereas in simple random sampling, equal chance of selection will be there. Yes or no? Next, block sampling. Selecting continuous items, adjacent blocks. Limited coverage of diverse transactions. Simple, economical, but prone to bias. Example, taking a block of invoices. Easy. Next, sampling risk. Meaning, when auditor's conclusion from a sample differs from what would be found if entire population were tested. If at all entire population is tested, what we will be finding that may not be matching with the sample related conclusion. Then that risk is called as what? Sampling risk. In case of test of control, over reliance, under reliance. Yes or no? Over reliance means what? Controls are not effective, but you are treating it as effective. Audit risk increases. Under reliance means what? Controls are effective, but you are treating them as not effective. Because of it, audit efficiency affects. In case of test of details, incorrect acceptance. Incorrect acceptance means what? Concluding that there are no mistakes when they actually exist in the population. Incorrect rejection. Concluding that there are a lot of mistakes and rejecting population that it is wrong, when in fact there are no material misstatements. Non-sampling risk. Risk that auditor reach erroneous conclusions for any reason other than sampling risk. Non-sampling risk cannot be measured mathematically. Examples, use of inappropriate audit, misinterpretation of audit evidence. Causes of non-sampling risk, human mistakes, misinterpreting results, relying on erroneous information. Finally, you need to perform procedures on sample. Apply appropriate procedure to each item selected. If a procedure is not applicable, perform it on a replacement. If replacement is not feasible, apply an alternative procedure. If procedures cannot be applied, treat the item as deviation in case of test of control, treat the item as misstatement in case of test of details. Next, nature and cause of deviation. Generally misstatements and deviation reasons, they will be common across various deviations, various mistakes. Generally in various transactions, a deviation is common, misstatement is common. Individually, most of the mistakes are related to each other. Evaluate nature and cause of the misstatement. If at all there is any anomaly, you need to have high degree of certainty that it is non-representative of population. So additional procedures are important. Anomaly is equal to misstatement or deviation demonstrably not representative of population. Next, in charts, no. Generally, personally, I don't recommend charts concept itself, but just for getting an overview. That's it. This is not at all, I personally tell everybody, this is only for an overview, not for depending on the exam purpose. This is just for overview, so that okay, fine. Like instead of reading from goat notes, some 7-8 pages, here it in 3-4 pages, you can revise it. You will get a bird's eye view. So just for a quick recap of headings, side headings, brief matter. But for descriptive purpose, you read only that. Good notes, always. Projection. Auditor project misstatement to population for a broad view of the scale. Remember, projection may not determine exact amount for recording in books of accounts. Correct? Exclusion. Anomalies will be excluded from projection. Effect of uncorrected misstatement is considered along with non-anomalous misstatement. Non-anomalous means nothing but projected. Yes or no? Next. For test of control, uncorrected misstatements has to be projected. Yes or no? For test of test of details. For test of controls, no projection is needed because sample rate of deviation itself is population rate of deviation. Evaluation of sampling results. Auditor evaluates whether sample provided reasonable basis or not. High sample deviation increases material misstatements. High sample misstatement indicate material misstatement. Best evaluation is what? Projected plus anomalous. Both you need to consider and then evaluate. Correct? Anomalous misstatements are non-repetitive but included in aggregate calculation for total misstatement purpose. When projected misstatement plus anomalous is crossing tolerable, we assume that sample is inadequate. Remember, I told you this is written on a precautionary method. When projected misstatement is more than auditor expectation, then also unacceptable sampling risk is there. We assume that sampling is wrong. We increase the sample and we will once again do this. Conclusion: the closer the projected plus anomalous to the tolerate, the more likely actual misstatement is more than tolerable level. If sampling has not provided adequate basis, this is what if management will argue, then I will ask management to investigate and I will do extra procedures. I will test alternative controls. I will modify my substantive. And there are certain precautions which I should take when I am performing test checking. What precautions I should check? Study accounting system, internal control system, identify areas which are not suitable for sampling, plan and explain methods to the staff. I determine adequate sample size, select them without any bias, analyze the errors correctly. Analyzing means what? Nothing but anomaly, non-anomaly, all that. Yes or no? Stratify the transactions and balances appropriately so that you will get the representative sample. Able to understand. But remember, you will get maximum out of the chart book only when you understand the subject thoroughly. Otherwise, without understanding the words, without understanding it, there is no point of reading this. Are you clear? Now here, I think we found out one mistake in the chart notes where factors. Yes or no? Here, side headings were right. This matter was not given correctly. Correct? This I think was copy pasted. This one. Okay. These 2 points, please replace it. Even in the physical chart copy, also please ignore this. You can just use headings. That's enough. Clear? That's it. So refer GOAT notes. Confident? Actually, why these mistakes happens is, we do develop entire this in Canva. What happens is multiple team members will be working. Sometimes no. For example, when we are working, somebody else also would have opened the same topic. When we saved it here, they would also saved some settings there in different file. This got missed, that got saved. When they bring it for verification, getting it, or when I am verifying, I'll verify based on my system. When they verify, I will tell them, okay, approve it. Then they will take that and they will give me entire PDF just for my review. Since I reviewed already, I approve it. Getting the point? I'll review. Of course, I'll review because I reviewed here. Once again, the same I'm reviewing with PDF. Getting it? I review it. So that is the reason. The sync mistake is actually a syncing mistake. But if a chat book has to come this beautifully, we don't have another option. Only Canva we need to use. Canva or some other software only we need to use. You understood why this is actually a synchronization mistake. Synchronization. We would have actually updated this. So at 4 or 5 places this mistake happened. This entire book. But next edition, what we will do, whatever we did proofreading on the screen, off the screen we should take a print and then read once again. So proofreading will be done 4 or 5 times at least. In spite of it, you see this very minor, no, we can't notice that in this much volume of syllabus. Okay, at 4 or 5 places only this mistake happened, but at least, and one more thing, when we are reading normally proofreading, we will not get it because the intensity of reading is different. But when I'm taking a class, that intensity level is different. I can easily figure out a mistake in a class. Rather, if I'm sitting this book, if you give me this book, see, is there any mistake? Is there? I can't find out easily because that intensity won't be there. Fine, clear all of you? But you see how cleverly this represented entire matter, no? Same wordings we try to maintain at 2 or 3 places only the wordings might be little different in the chart notes, but 99% we try to maintain it. That's it. So with this, essay 530 is completely done. Clear, confident? Totally we hardly covered 4.5 hours including this chart discussion. So next we'll start 520 standard. 520 will be little easy only compared to 530. It's quite easy. Yeah. Yes. Let's begin SA 520 analytical procedure chart revision. And as a prerequisite for every topic, I will give an intro like this. You have to first watch my previous marathons on 520, get some understanding on 520, or if at all you already watched my UO batch, then you can listen this particular chart revision, because in chart revision it's all about a quick revision. It quickly revise. So you don't expect too much of explanation from the chart revision. Okay? It is like brushing up of all the concepts briefly. Next, analytical procedure, meaning and objective. So what is the meaning of analytical procedure? You evaluate, just a minute. So you evaluate financial information by analyzing relationships between financial and non-financial data. That's the meaning, correct? Then what is the objective? To obviously get the evidence and use substantive analytical to form overall conclusions at the end of the audit. Okay, whether financial statements are consistent with auditor's understanding of the entity, to know that analytical procedures are performed. Now, in analytical, we analyze the data between financial and non-financial, right? And what do we find? We find fluctuations or inconsistent. That what we need to do? Investigate. When do we do investigation? When the difference is more than acceptable difference, correct? What is acceptable difference? We already discussed. Once again, we'll get it later. Next, examples, it's okay, not required. Then, analytical procedure will have two types of analysis. One, comparisons. Another type of analysis is consideration of relationships. Comparisons, three types: comparison with prior period, comparison with anticipated results like budgets and forecast, comparison with industry information, and trying to find out inconsistencies, differences, fluctuations, variations. Next, relationships, predictable pattern, like compare relationship within financial elements which are expected to follow predictable pattern. Sales we can predict, purchases we can predict. If both can be predicted, closing stock can be predicted. Yes or no? Some expenses, repairs and maintenance we can predict. Some expenses like advertisement research we can't predict. Okay, then financial and non-financial. In analytical, we use relationship between financial and non-financial. For example, there is an increase in number of employees, there must be increase in sales. If that is not happened, we will investigate the fluctuation. So analytical procedures use comparisons. Analytical procedures use relationships between financial and non-financial data. Next, purpose. We use comparisons. Ultimately, we compare or we study relationships, yes or no, to check what? Whether account balance is looking reasonable or not. Yes or no? So because of this comparisons and relationship study, we will identify unusual transaction, unusual mistakes, unusual manipulations, all that. Correct? Suppose unusual transactions you found. What is unusual transaction? Events, amounts, ratios, trends, whatever that will signal some risk of MS. So analytical procedure benefits the auditor to identify unusual items. Analytical procedures will benefit the auditor to identify risky areas. So in this way, analytical procedure will be useful to the auditor. Next, various examples, any 4 or 5 examples you have to study. I already told in the GoTo notes that particular EVO session also. Next, timing. When should we perform? We can perform it in planning, testing, and completion. But most importantly, analytical is performed in planning stage. During the planning phase, it will help the auditor to identify potential mistakes. Benefits. This, it will help you to decide nature, timing, extent of further audit procedure. Means analytical procedure will help you to plan your audit. Yes or no? And analytical procedure at the time of planning uses both financial data and non-financial. Correct? Now, what is substantive analytical procedure? First of all, substantive procedures includes two: substantive analytical procedure, test of details. Both are part of substantive procedures. Substantive analytical is applied when the auditor judges it can reduce the risk to acceptable level. If auditor feels that analytical procedure will reduce the auditor, he will use it. Inquiries. So what auditor will do? Before substantive analytical procedure is performed, first auditor will inquire about the data regarding its reliability and availability. Once data is given, auditor will perform analytical, then he will get some result. That result he will investigate, yes or no. And sometimes auditor will also use entities analytical procedure data also. And so that is used. Management data he will use when it is reliable, yes or no. Next, what are the factors for substantive analytical? Remember, in ICA book this was used as audit, substantive audit, but actually it's wrong. It's actually substantive analytical. Can I use substantive analytical procedure or not? It is determined by various factors. One, first to know data availability. First, data should be available. 2, data must be disaggregated. 3. Account type. Substantive analytical is useful for more of income statement items, not for balance sheet items. And not only that, source of the data, yes or no, and a significant class of transactions where judgment is involved, it is less suitable. Those transactions which are routine, which are predictable, good for substantive analytical procedure. Correct? Predictability. Effective, analytical procedure is effective where relationships are predictable. Analytical procedures are best when for checking completion valuation, less for rights and obligation, existence and all. And if risk is high, use test of details. SAP alone may not be. See how best it is, like the goat notes, whatever is there, we are able to figure out all the keywords, yes or no. But if you want to understand better the chart notes, you need to read from goat notes. Next, what are the techniques of substantive? Trend analysis, ratio analysis, reasonableness test, structural modeling. Trend analysis, we compare current balances with prior period to spot unusual changes, unusual trends. Check if figures align with known trends, whether figures are matching with trend, known trend or not. Ratio analysis, we study relationship between various account balances, transactions. Correct? We detect mismatches by comparing ratios across time. Reasonableness test, no, predominantly use non-financial data to know whether an account balance is logical or not, reasonable or not. Helpful for accrual of income statement, whatever. Anywhere you can use this reasonableness test. Next, structural modeling, it's a statistical tool where they predict account balances. Easy or not? Any three you need to write in exam. Can we use analytical procedure as a sole substantive procedure? It depends upon suitability, it depends upon reliability of the data, it depends upon accuracy of the expectation, it also depends upon acceptable difference. Now, auditor must assess if analytical procedure is appropriate for a particular session based on risk of MS and test of details. Yes or no? Data must be evaluated for source, comparability, relevance, controls. Auditor then develop the expected value. See, for this, we have J, K, L, M. These are the points which are talking in depth about these four. So this is typically a consolidation of all the four subsequent points. The subsequent points we'll see. Suitability of a particular analytical procedure for a given assertion. SAP works best for large volumes of data, correct? Which can be predicted over time. Yes, analytical procedures we can apply on an assumption that relationships will exist among various data and depends on effectiveness of detecting whether a particular analytical procedure is suitable or not. It depends upon how effective it is in detecting material misstatement. SAP, substantive analytical procedure, is it suitable? It depends upon its ability to find mistakes. Predictive, even a simple model can be effective sometimes. And remember, analytical procedure offer different levels of assurance and factors influencing suitability, nature of assertion, risk of MMS. Sometimes SAP analytical procedure is stronger when you are using with test of details for certain assertions. For same assertions, test of details. SAP plus TOD for same assertion, that will give you a stronger result, that will give you more clarity. Able to recollect? Next, factors determining reliability of data. What are the factors? Source. Source is more reliable when it is coming from independent source. Comparability, data must fit the entity's context. Like for example, broad data, industry data may not be suitable for entities specialized in specialized products. Reliability, more reliable if expected outcome. Like for example, if budgets are for expected outcomes, budgets are really seriously taken, then only that is more relevant data. Controls over preparation of data. You need to test how well controls work, and you should also test controls over non-financial data. So if controls are effectively working, then the result of analytical procedure will be more effective. Then auditor has to evaluate whether expectation is sufficiently precise. Precision improves when expected results are predictable. Like expected results must be predictable, only then the accuracy will be there. SAP analytical is more effective when applied to disaggregated data rather than consolidated data. And design of SAP depends upon availability and reliability of financial data and non-financial data. Amount of difference that is acceptable. What do you mean by amount of difference that is acceptable? The difference between recorded amount and expected value. Expected value means what? Result of analytical procedure. What is the result of analytical procedure? Some expected value you develop. That value you compare with recorded amount. If there is a difference, up to a certain level we can accept it without any further investigation. And that level is called as acceptable difference. Yes or no? It is influenced. The acceptable difference is influenced by materiality, level of assurance, risk of MMS. Higher the risk, more evidence is required. Therefore, lower acceptable difference without investigation. If high risk is there, difference, acceptable difference size will decrease. As risk increases, acceptable difference decreases. That's what actually I told you to slightly rectify. That one letter, if you rectify, that will be enough. Goat notes, I told you, yes or no? That's it. To ensure sufficient, appropriate audit evidence. Then, finally, if at all auditor identify fluctuation, relationships differ significantly from expected value, where the fluctuation is more than acceptable difference, what auditor first will investigate management. We will ask them why there is a fluctuation. We will see the response given by them. If response given by them is not adequate, auditor will perform additional procedure to detect any material misstatement. Finally, overall conclusion at the end of the audit. What? To corroborate conclusions from audit of financial components. See, I will do overall conclusions to support. Okay, whatever my understanding of the entity and its environment, analytical procedure will corroborate me, support me, helps in forming reasonable conclusions, may uncover. Because of this overall conclusion at the end of the audit, you may discover unrecognized risk earlier, yes or no. If at all you identify any unusual items at the end of the audit, you have to revise the risk assessment, you have to modify further audit procedure, again you redo it. That's it. Analytical procedure is done. It took hardly 11 minutes. The original chapter we discussed 1 or 40 minutes close. Original, the standard. Understood? Able to recollect, no? But you read once again, goat notes, thoroughly revise, then come back and see. It will be like a quick recap. This is only for mind mapping. Like in exam, if a particular question comes, at least if you get a diagram, that keywords, you can write at least something without missing any points. Just for retention purpose only, this one. That's it. Minimum retention purpose. Clear? Yes, let's begin the discussion of bank audit. Again, bank audit is again covered in the main revision already with all proper explanation. Okay, here I will be covering in a quickest way. Now, so what are the peculiarities in banks? You know, what are the main features in bank? Huge volume of transaction, wide geographical spread, and 1 minute. So wide geographical spread, so many products and services, and they use extensive technology and of course regulatory vigilance. Correct? There are many types of banks. The popular banks that we see in our day-to-day life is commercial banks, and there are regional rural banks, there are cooperative banks and payments banks, and development banks and small finance banks. And what are the functions of RBI? You know, RBI is the central bank and regulates the entire banking industry, supervises the Indian financial system, and formulates monetary and credit policies for the banks. And they issues the currency and regulate the currency circulation. And they act as a banker to the government. You know, banks need license from RBI in order to open any branch or close any branch, and all the operations are conducted at branches. And branch banking operations, no, they will be done at branches only. Head offices and all will be for main books of accounts, corporate affairs, all that. Then there are many acts like RBI Act, Banking Regulation Act, Companies Act, and PMLA, Prevention of Money Laundering, Information Technology Act. There are so many. Surface, there is an act called Securitization, Asset Reconstruction, Finance Asset Act. Like there are so many acts. Next, understanding of the banking, understanding of bank accounting system. There are voluminous transactions. So banks have to continuously improve the internal control, and banks, you know, based on computerization, they were classified into non-computerized bank, partially computerized banks, or fully computerized banks. Yes or no? And most of the banks will have core banking system which will give interconnectivity. So auditor has to ensure whether RBI norms are incorporated in core banking system. Auditor should exercise professional skepticism. What is the difference between computerized bank and non-computerized? Computerized banks means anywhere, anytime transaction, and shortest processing time lead to higher productivity. Non-computerized, where processes are mostly manual, limited to working hours, and have longer processing times. Yes or no? And remember, the statutory auditors have to give audit report, right? In addition to the audit report, the statutory auditors have to give some additional reports also. What are the additional reports? Many times this question also came in exam. Report on IFC. The statutory auditors have to give a report on internal financial controls. He has to give a long form audit report. He has to give a compliance on SLR. He has to give a report on treasury operations. He has to give a report on IRAC norms, income recognition asset classification norms. He has to give a report on adverse credit deposit ratio. He has to give a report on Ghosh and Jilani committees compliances. Examples of various reports. Okay, not all points covered, only few points are covered from the goat notes, which is sufficient from exam point of view. Next, and remember, when you're planning an audit for the bank, there are some points you should consider. This many students ignore. This itself directly can come as a 3 marks question. While planning the audit of a bank, there are some points you should consider. First, consider nature and level of operations of the bank. What are the adverse features of this bank? Compliance level by the bank, how much? And risk from internal control weaknesses or what? These points you should consider while planning the audit of a bank. Next, control environment in a bank. Like in a bank, control environment looks like this. Segregation of duties will be there, transaction approval will be there, regular reconciliation of balances will be there, setting limits will be there, how much cash bank has to maintain maximum, and reporting and approval for exceptions will be there, physical security and contingency planning. These are all various control activities that will take place in a bank. And auditor will have few questions: who performs the control, what evidence is to be generated, how frequently a control is performed, where evidence is stored, why the control is performed, how it is performed, exceptions, all that. So this itself, they may ask you a 4 marks question. Write about control environment in a bank. They can ask us 4 marks question. Now, procedure for conducting audit of a bank. First, engagement team discussion will happen. This itself was tested many times for 4 marks. So first, team discusses bank and its environment, including control. What is the purpose of this discussion? To identify potential for misstatement. What matters they will discuss mainly in this discussion, engagement team discussion? What they will discuss? They will discuss likely errors. They will discuss what errors they identified in past. They discuss fraud methods, how banks will execute, and the fact that every one of them has to maintain professional skepticism and response to various risks like engagement, pervasive and specific risks. What is the advantage of this discussion? It will help in assessing fraud risk. It will help in delegation of work. It will help in deciding whether an expert assistance is required or not, specialist is needed or not. Yes or no? Then understand the bank and its environment. Understand the entity, internal control, all that. You should understand risk management process of the bank. You should understand what control activities are implemented. You should understand monitoring activities and see whether updated models are they using, and see whether banks are maintaining reliable financial information system that provide latest information in a consistent manner. And you need to evaluate risk management process, governance bodies, whether risks are identified, are they measured properly, are they monitored. First understand the entity, identify the risk, then they will design and implement a control, and they will monitor whether the control is proper or not, and the entire data is maintained through information systems. These are actually 5 components of internal control. This discussion once again we will get in internal control topic in risk assessment chapter. Next, what are the initial considerations by statutory auditor? First, he should communicate with previous auditor before accepting the appointment. Then he will perform procedures under 220 regarding accepting the client relationship. Then he will give a declaration of indebtedness that now his credit facilities have not become NPA. And then he will issue an engagement letter as per 210, and he should not accept any internal assignments, prohibited services. Then establish the engagement team depending upon the bank size and complexity involved. Next, and other steps as a whole: developing the plan, determining materiality, considering going concern, maintaining skepticism, and auditor should also see whether bank has implemented a stress testing framework. And Basel III, banks must follow Basel III framework. Apart from this, auditor will also use other reports. Remember, in the above we saw auditor gives some other reports, that is giving reports. Here using reports. This itself was came for one time 4 marks. Auditor will be discussing with so many people. Apart from that, he will be relying upon so many reports. What are those reports? 4 marks question it came in one of the exam. Like what auditors rely upon? Auditors review previous audit reports. They will review internal inspection reports. Statutory auditors will review RBI reports. Statutory auditors will review concurrent audit report. They verify security verification report, manager charge report, handing over report. Actually this is continuation. Actually, managers change handing over report. Whenever there is a manager is changing, handover reports will be there to the new manager. So these are various reports which statutory auditors will review along with discussions with management, inquiries with management, all that. Understood? All of you? Next, appointment and reporting by auditors of a bank. So appointment, provisions for appointment. So eligibility, qualifications, disqualifications, they are same like Companies Act, correct? Who will appoint? Authority. Read last to first, I said very specifically. Last to first means what? From 4th point. For RRBs, Board of Directors will appoint with central government approval. For State Bank of India, C&AG will apply in consultation with central government. For nationalized banks, Board of Directors only will appoint with RBI approval. Whereas for remaining all other banking companies, other than the following three, shareholders will appoint at AGM with RBI approval. Able to understand? Next, remuneration. Same under 142 of the Companies Act, how it is fixed? The same way it will be fixed. But for nationalized banks, SBI, RRB, it is fixed by RBI in consultation with central government. What are the powers of the auditor? Same powers like Companies Act, access to books, records, documents, all that. Yes or no? Reporting. The statutory auditor has to give a report. He has to give a report to central government in case of all nationalized banks, where the report, what he will tell, he will talk about true and fairness of the financials. He will confirm regarding satisfactory of information explanation he received from the bank management. He ensure transactions are within the powers and adequacy of the branch returns. Next, format. The report must be in accordance with what is the format of audit report? As per SA 700 series only. Unaudited branches disclosure is required. What is required for unaudited branches? Not only number, you should also quantify how much percentage of deposits, how much percentage of advances, how much percentage of interest income, how much percentage of interest expenditure. That quantification is also required. Yes or no? And report must comply with 143, and CARO is not applicable for a bank. Apart from this, the statutory auditor will also give some other report called long form audit report. Auditors of public, private, foreign banks must submit LFAR by 30th June of every year, reporting to RBI. Auditor must also report fraudulent activities or suspicious transactions to RBI and bank's head. Focus is on evaluation of system, and auditor has a duty to report on fraud under 143 subsection 12 in addition to RBI reporting. Easy. The entire intro and normal introduction to the banks is completed. Now we will be discussing advances of a bank. Advances is a major item. Yes or no? Advances are major asset, and this is the only income source. This is the main income source for a bank. Yes or no? And loans or credits with repayment. These are loans will these are the loans or credits where repayment will be there. Auditor needs in-depth knowledge of various regulations. Now what you need to examine? There are advances are broadly classified into large advances and others. Large advances we verify 100% examination. Other advances are sampled. What is a large advance? Year-end balance is more than 10 crore. It's a large advance. Or is it at least 10%, whichever is less? So if an advance is at least 10% of the total branch outstanding, if a particular customer loan is 10% of the total loans outstanding as on 31st March, if it is 10%, it's a large advance. That it is not, it is not 10%, sir, but it is more than 10 crore, then also it is a large advance. Are you clear? Getting it? See, it is like 10% is the minimum criteria. That's it. Are you getting it? So 10% or 10 crore, whichever is lower. That's it. Next, again, advances are two types. Funded advances, where actual loan will be given to the customer, he can withdraw something. Non-funded, like LOC, guarantees, all that. Remember in CARO 2020 applicability, we saw funded and non-funded, both we should take for calculating sanctioned limit. Yes or no? Next, advances comprise term loans, cash credits, OD, demand loan, all that. How that will be disclosed in balance sheet? They will be classified like bills purchased and discounted, cash credit and OD, term loans. Further categorized by secured by tangible, covered by guarantee, unsecured. Also based on geography, in India, outside India. Based on sector, priority or publica. Entire disclosure requirement is given, you see, in the simplest way. Next, classification advances based on. Banks must classify advances priority like agriculture, MSME, education, housing. They are priority. And RBI has set some lending targets to priority sector. Next, classification of advances. Based on security, advances are classified into securities are classified into primary security, collateral security. Primary security means what? Principal security. Collateral means what? Additional security. Examples of various securities: gold, goods, immovable property, shares and security, insurance policies, etc. Next, how do we create a security in a bank? Mortgage, registered deed or equitable mortgage. Pledge, delivery of goods as security. Hypothecation, ownership and possession remain with the borrower. Borrower has to submit a periodical statements like stock and all for computing drawing power. Assignment, it's a transfer of rights. Suppose insurance policy, I want to give a security to a bank, I will assign it to the bank. Assignment we call it as. So no, set off. A customer will be having a loan account and he'll have a deposit account. He has money in his deposit account and we gave a loan also. If at all he is not repaying the loan, we'll set off. Yes or no? And lien is typically not a security, basically not a type of a security. Next, how to do audit of advances and prudential norms. In order to first understand prudential norms, first you need to understand NPA norm. Yes or no? NPA means what? An asset which stops generating income. Yes or no? That's a NPA. Criteria is what? When a term loan becomes NPA, if interest or principal is overdue for more than 90 days. Suppose if due date crossed, 90 days also crossed, then it's NPA. In case of an OD and cash credit, for overdraft and cash credit, if the account is out of order, then it's NPA. For a term loan, more than 90 days. For cash credit and OD, out of order is an NPA criteria. And bills purchased and discounted, bill is overdue for more than 90 days. Now you see, for OD and cash credit, out of order is the criteria for NPA, right? What do you mean by out of order? What do you mean by out of order? Very simple. The outstanding amount exceeds sanction limit or drawing power. Then it's out of order. Or no credits for 90 days means the customer withdraw OD. We are debiting interest every month, but customer did not pay any single rupee for 90 days. Or he paid insufficient credits. He paid money, but it is insufficient to cover the total amount we need to receive from him in terms of interest. In all these three cases, very simple, it is crossing drawing power. Are you getting it? Or the interest that we charge, he is not paying for more than 90 days. Then also it is called as what? Out of order. A cash credit and OD account, if it is out of order, we will straight away treat it as NPA. Overdue means what? Simple. An amount not paid on due date is called as overdue. Easy. All of you. Next. And then we have some classification here. The same GOAT notes one we have kept here. So substandard asset. An asset which is classified as NPA for up to 12 months. Beyond 12 months, it comes under doubtful category up to 1 year. Then after 1 to 3 years, it comes under doubtful category 2. After 3 years, it will come under doubtful category 3. If it is a doubtful asset, secured portion, these are the security. Unsecured portion, this much provision you need to create. And loss asset, bank has to decide whether it's a loss asset or not. They need to write off. Yes or no? 100%. Clear? Next. Then we have some special NPA norms. General NPA norms is what? 90 days criteria, out of order, that logic. Now there are some special NPA norms, like accounts regularized near balance sheet date. Like this actually became NPA during the year, but by the time balance sheet date comes, it became normal. You need to handle it carefully. If at all the account is inherently weak, you need to straight away tell the bank to classify that as NPA. Auditor checks sample transaction before and after year end. Suppose if there is a credit reversed after year end, like customer paid money and again took back the money, like that, if some entry is there, if at all I feel that this is a fraudulent transaction, I will still classify that as NPA. Next, government guaranteed advances. Government guaranteed advances are two types: central government guaranteed, state government guaranteed. Central government guaranteed advances are always standard, even if the customer is not repaying the loan. Okay, provided guarantee is not yet cancelled. However, income recognition purpose, it is NPA. Interest and all we don't recognize. The moment it crosses 90 days, interest recognition we will stop. But do we create provision on the outstanding amount? No. Whereas state government guaranteed advance, it is classified as NPA if overdue is for more than 90 days, and it will be classified as NPA for asset classification purpose as well as income recognition purpose, and provisioning will be there. So no provisioning relaxation, which means provisioning will be there. That is government guaranteed advances. Then advances under consortium. Consortium means what? Loans by 2+ banks, 2 or more than 2 banks. Yes or no? Lead bank will have higher share. So asset classification in each bank will be based on record of recovery by each bank. Suppose if funds are remitted to lead bank but not transferred to other banks, the account is treated as NPA in the other banks. So members must ensure recovery, all that. Lead bank will compute and allocate drawing power about the drawing power between the member banks. Consortium. See how all the points covered? Yes or no? Next. Accounts with erosion in security. Erosion means diminution in the security value. Now classification. If realizable value of security, if the realizable customer already gave a security, right now its market value is less than 10% of outstanding loan, then the straight away classify it as a loss asset and give 100% provision or write off. Suppose market value right now is less than 50% of the market value previously done. Market value, if realizable value of security is less than 50% of the assessed value previously, actually, okay, previously compared to last time, right now if the valuation was less than 50%, then since it is showing substantial decline, so immediately classify it as doubtful. From doubtful it might go to loss asset also. Are you getting it? So this is NPA norm for assets loans where there is an erosion in the value of the security. Here customer might be paying regularly, it doesn't matter. Next, advances against term deposit, NSE, KVP, IVP. Yes or no? That's not an NPA if adequate margin is available. Interest can be recognized on accrual basis only until adequate margin is available. Correct? Now agriculture advances, that I will come back to later. Advances given to staff. Part of advances given to staff as a banker. Okay, as a banker I gave to my employee. Okay, I mean, he's just, we are employer-employee, but when I gave a loan, housing loan, he's my customer only. So that we will be showing under advances portfolio. Classification of NPA if installment is overdue for more than 90 days. Salary advances we will show it under others. Sometimes no, since we both are employee, we will have some repayment structure differently. First, whatever you pay, we will allocate it for principal. Then whatever amount you are getting, interest amount we will allocate. If that is the case, interest is overdue after 90 days, you don't have to classify it as an NPA. Are you clear? Next, agriculture advances. Agriculture advances are divided based on the crop season, crop type, long duration crop, short duration crop. For short duration crop, if an installment is overdue for more than 2 crop seasons, that's an NPA. For long duration crop, if installment is overdue for more than 1 crop season, then it's an NPA. What is a crop season? State level bankers committee will decide. Special NPA norms is also over. Are you clear? Now let's understand computation of drawing power. Okay, how to compute drawing power? Drawing power is the limit where firm can withdraw from working capital limit. Drawing power is a limit where a firm can withdraw how much. Customer, how much can he withdraw? That's a drawing power. Sanction limit means what? It's a total risk a bank can take. DP is calculated based on primary security minus margin. Sanction limit is maximum exposure. Sanction limit is based on repayment capacity. Next, rules for DP. Accounts always must stay within drawing power and sanction limit. Irregular accounts where there is an exceeded has to be reported to head office. Drawings must be covered by current assets. DP must be calculated after covering current assets. DP calculated must be from current stock statement, and the stock statement should not be older than 3 months. Older stock statements may make the account irregular. DP computation shall follow guidelines. Special focus on sundry creditors and in DP calculation. Remember, in bank audit revision, I already explained how to calculate DP. The main revision, how drawing power is calculated. In the recent May 25 also, a straight arithmetical question, 5 marks question is came, computation question is came. Now what are the auditor's concerns when he is reviewing advances? You should review stock statements returns, compare with the audited accounts and investigate. And stock audit, this itself can be asked as a separate question. When a stock audit will be required in case of a bank where funded exposure is crossing 5 crores, then auditor can recommend, then a stock audit is compulsory. In some other cases also, auditors can recommend for stock audit. Then in case of consortium lending, stock audits will be obtained from lead bank. And review, when you are reviewing stock audit report, what is the primary focus? You will review on security valuation and DP calculation. On a stock audit report, what is the main primary objective? For valuation of the security and drawing power calculation. These are the objectives of reviewing stock audit. Next, audit of advances. Audit of advances. So what is the audit of advances? Objective of advance. Ensure outstanding advances are accurate and represent amount to due. Objective of audit, okay. Verify supporting documents are there. Ensure there are no unrecorded advances. Ensure valuation and recoverability. Ensure advances are disclosed, classified and described. Verify provisions are made as per RBI norms. Now in advances you need to verify internal controls, compliance. Sometimes in exam only this they will ask. Okay. Now auditor review controls covering credit worthiness, documentation execution, end use of funds, margin of safety maintenance, creation of security. DP, you need to update registers. Accounts must stay within sanction limit. Irregular accounts has to be reported. Regular review of accounts. All these points you need to verify. Controls verification. Substantive, you should verify all large advances. Problem accounts. Problem accounts means what? SMA 0, SMA 1, SMA 2. They should be examined in detail. Special focus on advances sanctioned during the year are commented by RBI or Internal Audit Department. Substantive procedures. Substantive procedures. This is extent, this is substantive. Obtain evidence by verifying recorded loan amount, check the loan documentation, review operations in the ledger account. Ensure valuation and enforceability, check compliance with RBI norms, perform analytical procedure. Then audit of incomes. Banks will have broadly 2 types of income, interest income and other income. Interest income on advances, nothing but loans. Investments with RBI in bank balances, other income, commission income, loan processing fee, all these examples. Yes or no? Audit of income. Ultimate objective is to ensure that income is a valid transaction, pertains to the period and is not unrecorded, means not omitted, and it should be recorded at appropriate amount. Banks will follow accrual basis for all material incomes. What is a material income? An income which is more than 1% of total income when the income is calculated on gross basis, or if an income is calculated on net basis, if it is exceeding more than 1% of net profit, then that income also shall be calculated on, that income also should be recognized on accrual basis. Income below this threshold can be recognized by the bank on cash basis, but 99% all the banks follow accrual basis only. Next, Income recognized on accrual basis unless collection is uncertain. No income is recognized on NPA until realized. Previously accrued interest is reversed or provided for. Unrealized interest is recorded in a memorandum account. Advances against specific securities. Interest recorded on due date if adequate margin exists. Bills purchased. Discount for outstanding bills apportioned. Unexpired discount is other liabilities. Bills for collection. See, actually bills purchased, discount will be recognized in proportionate. In this year how much, that year how much. Unexpired discount will be shown under other liabilities. Interest on rediscounted bills will be not netted off from this discount. So when I discount from some customers' bills, no, that income is different, and I will rediscount bills with others. That expense is different. We should not net off each other. Next, bills per collection. Customer account will be credited only after actual collection. Commission will be recognized only after actual collection. Renegotiation related fees, commission, they will be recognized on accrual basis over extended credit period on a pro rata basis. Now, recoveries in NPA. Bank has to follow a uniform policy for recoveries. Interest realized on NPS can be taken to income. Ensure that interest are not from the fresh loan. Other income. That's a normal, nothing, no big deal. Reversal of income. This itself can be asked many. This is asked many times. Reversal. Generally, accrued interest on NPA must be reversed or provided for if at all not realized. Applies to government guaranteed advance also on income concept. So no. Fees and commission. Fees is to accrue and must also be reversed if at all already recognized on accrual basis and not yet collected. Next, wrongly recognized income, reverse. Okay. Next, auditor. You need to inquire large unexplained debits in the interest account and check action on borrower discrepancies. Income on leased asset. Same, income on leased assets also, if at all unrealized, it must be reversed. Takeout finance. What is takeout finance? It's a loan replacement. Initial loan will be taken from somebody else and now we are takeovering that loan. Next, used in property development projects. If classified as NPA, income is recognized only when realized. Expenses, interest expenditure, operating expenses, all that. Audit of interest expenditure is most important here. Obtain quarterly analysis of deposits and compute weighted average interest rate. Compare the actual amount with previous years. Obtain general ledger breakup and perform test check interest calculation. This itself can be asked. Write about test checking interest calculation. See that interest is calculated on all deposits up to balance sheet date. See that rates are complying with RBI. See that savings interest follows rules. Verify interest rate changes during the year. Ensure interest is accrued on entire borrowing. Recompute interest on interest accrual considering various other parameters. Then audit of operating expenses. Evaluate who approved it. See the expense trend. Perform analytical procedure. Verify supporting documents. Then provisions. Provisions, especially provision is most important. IRAC norms. Understand bank provisioning process for standard assets and NPS. Verify loan classification on a sample basis. Reconcile classification with general ledger. Also verify tax provision. Review any other provision. Check compliance with RBI requirements and circulars regarding provision percentages, all that. Next. And what is the form and content of the financial statements? Banks will follow as per Banking Regulation Act. Yes or no? Preparation of financials. It must be as per third schedule to the Banking Regulation Act. Form A balance sheet, Form B is P&L. MCQs relevant. And banks will comply with accounting standards only. Ind AS is not yet applicable to banks. They will follow normal accounting standards only. Ind AS standards is not yet applicable. Easy. That's it. Bank audit is over. 25 minutes, 26 minutes approximately. Effectively done. Yes or no? That's it. Yes. Let's continue the discussion. Chapter number 8, Audit Strategy and Planning. Actually, documentation chapter is the smallest chapter where 4 to 5 marks weightage is there. This is the next shortest chapter. This chapter size is in the GOAT notes itself is some 8-9 pages hardly. Here it is just 5 pages. The weightage is 12 marks. The problem is chapter is so complex. With respect to this, directly I have a 12 hours revision marathon, which I already showed at the introduction. The introduction of the chart notes revision, I already showed you. There is a 12 hours, 11.5 hours marathon. Inside that audit strategy topic, I explained for 1 hour almost. Strategy revision. Okay, that you watch and then here you come up for just a revision. Here, many students study this chapter multiple times, but they can't score in exam. The only reason because of confusing points. It's not complicated content, but in the exam they will ask planning benefits. Our students will write strategy benefits. Sometimes they will ask program benefits. Our student will write planning benefits. In exam they will ask what are the points to be considered while developing planning. What are the points to be considered while planning the audit? Our students will write factors for strategy. So this is where the main problem in this chapter. Understood? Fine. Now, so I will briefly revise, but if you want to get a command, please watch, please read from the GOAT notes revision. So what is audit strategy and plan? Or you see chapter name audit strategy and planning. The name itself I explained for 3-4 minutes in the GOAT notes revision. So planning, strategy is different. Planning includes plan development and program development. Okay. Now, so benefits of planning. Why you should plan? It is essential for effective and timely execution and ensures compliance, ensures compliances and enhances engagement quality. Okay. Focus on important areas. Because of planning, what happens? You focus on important areas, you will identify and resolve the problems, you organize and manage resources and all for efficiency, you will select the right team members, it will facilitate proper direction, it will facilitate coordination between components, experts, other auditors, all that. What is the impact? Because of proper planning, you can reduce the audit risk to a low level, where inappropriate opinion chances minimizes. The entire standard is planning an audit of financial statements. The standard heading itself is planning. Technically speaking, planning includes everything. Strategy, plan, program. Remember, plan is different, planning is different. Planning is a broader word. Audit plan is a very narrow term. So strategy, plan, program. All these three are part of planning. Now, what do you mean by planning? Elements of planning, first of all. There are two planning activities. Planning activities are two. One is strategy, another one plan development. So planning is a broader term that itself, this itself is a proof. Audit planning is a wider term. Now it includes establishing overall audit strategy and it includes developing an audit plan. Now this is planning activity. Elements of planning are again two. Preliminary engagement activity, that is one of the element of planning. Another element of planning is planning activities. Okay. Now preliminary engagement activity, performing procedures regarding acceptance and continuation of client relationship as per 220, compliance with ethical requirements, establishing terms of engagement as per 210. These are preliminary engagement activities. Understood? Next, now planning, no, it is not a one-time process, it is a continuous process. What is the nature of planning? Planning is what? It's not a one-time process, it's not a discrete phase, it's a continuous and repetitive process. Planning starts after completion of last year audit and continues until the completion of the current period audit. Plan has to be reviewed periodically for identification of new areas. Then what you will consider in planning? You need to understand legal and regulatory framework, you need to apply analytical procedure, you need to decide materiality, you need to assess whether expert assistance is required, you perform risk assessment to identify and assess risk of MMS so that you can plan properly. Considerations in planning. Next, when you are planning the audit, no, you will be taking help of so many people. One, engagement team members help you will take, because engagement partner, key team members, everyone must be presented so that planning will be enhanced, efficiency will be enhanced, because you will understand their experience, you will understand insights, and accordingly work allocation will be very, very proper. Not only that, you will also discuss with management. You may discuss planning elements for facilitating proper engagement, proper audit. Crucial, do not compromise audit effectiveness. By the way, when you're discussing with management, no matters some are which are sensitive, don't discuss, like surprise checks and all, don't discuss. Whether you are discussing with team members, whether you are discussing with management, ultimate responsibility for planning is engagement partner only. The auditor is ultimately responsible for overall audit strategy, audit plan development. You may discuss planning element with management, but effectiveness should not be compromised. Clear? Next. Now, what are preliminary engagement activities? I already told. Acceptance and continuation of client relationship, relevant ethical requirements, establishing terms of engagement, all the three are preliminary engagement activities only. Now, acceptance and continuation of client relationship, what points? You will obtain information regarding client before accepting. What information? You will check integrity, you will check your competence of the team, you will check implications from previous years. In case of initial auditor, initial engagement, audit engagement, you communicate with predecessor auditor also. That's how you understand whether a client is proper or not, so that you will give acceptance. Then ethical requirements, continuously evaluate compliance, especially independence. Engagement partner has to be alert for all non-compliances. Engagement partner shall take appropriate action for non-compliance, and engagement partner has to conclude on independence, obtain information on threats, evaluate breaches on firm policy, take action to eliminate the threat. If at all it is not yet resolved, report to the firm top management properly. This is regarding engagement partner's conclusion on independence. What are the conclusions engagement partner has to take regarding compliance with independence? These conclusions he need to take. Next, establishing terms. Send the engagement letter. Ensure that the client is not on confusion regarding terms. Yes or no? Then now one of the planning. Now we understood what is the importance of planning as a whole. Now one of the activity in planning is what? Strategy. Another activity is what? Audit plan. Now let us understand now what is a strategy. What is strategy? Strategy sets a scope of the audit, timing of the audit, direction, and it will help you to develop a detailed audit plan. Now what are the points? Strategy will help you in the following ways. It will help you to what resources to deploy. It will help you to allocating resources. It will help you when to deploy. It will help you management. Yes or no? Resources, what resources to deploy, how to deploy, when to deploy, management overall, like experienced team member for high risk areas, assisting staff to areas, extent of other auditors work, budget allocation, all that, timing, interima, key cutoff dates, are managing, scheduling the meetings, determining review methods, engagement quality control reviews, all this you can manage because of the overall audit strategy. Now when you're establishing this strategy, you need to consider so many things. What are you need to consider? Totally 5 things you need to consider. One is characteristics of engagement, you need to understand. Then reporting objectives, you need to get to know. Significant factors in directing engagement team efforts, where your team efforts has to be directed. And preliminary engagement activity result you need to consider. Nature, timing, extent of resources required also you should consider. After considering these 5 factors, you will establish a overall audit strategy. In the recent Jan 25 exam, this question has been asked. Changes in financial reporting, changes in legal environment, this point is tested. Telecom related one question came in Jan 25, compulsory question, first question to best of my knowledge. This change in legal environment, this is the basis for that question, one of the question. Okay, so you will direct your team efforts towards what? You will identify MCOT, nothing but material class of transaction, or SCOT, significant class of transaction, account balances and disclosure. Identify material class of transaction, okay, like transaction volume, significant industry development, changes in financial reporting framework, changes in legal environment. If at all any of these incident happens, you will direct your team efforts to them. Understood? Next, consider reporting objectives. Remember, reporting objective is different from reporting requirement. Reporting objectives, so entities reporting timetable, organizing meetings for discussions with management, discussing timing of reports, communicating audit status, team communication, review, nature, timing. Then characteristics of the engagement, what framework is applicable for the company, what is the nature of business, what is the industry specific requirements, any of the prior audit evidence, can we use it or not. Then use past audit knowledge, past internal control results, emphasis on professional skepticism. Nature, assign experienced team for high risk areas, budget the resources, devote more time to high risky areas. These are the factors you need to consider while establishing overall audit strategy. Every of this point is tested in exam. In this chapter, every corner is tested in exam. Understood? So because 12 marks, every time 3 questions will come. Small chapter, obviously every part of the question, every part of this chapter is tested. Next, developing an audit plan. Audit plan, what you will address in audit plan, you will address all the strategy points. Audit plan is essential for proper conduct of the audit. As per 300, audit plan should include nature, timing, extent of planned risk assessment, nature, timing, extent of planned further audit, nature, timing, extent of other audit, and you should plan for type, timing, scope of the procedure, including workload, allocation of extent of sampling, how much samples to check, all that. Then detail, it is more detailed than strategy. It focuses on specific procedure per team. Planning of audit, it's a continuous. By the way, planning is also, audit plan development is also continuous. Yes or no? Planning of audit. So risk assessment process will be planned and executed at early stages, whereas further audit procedures planning, they will be coming as audit progresses. So if further audit procedures execution may begin while planning continues for other areas. For some procedures, we start details, test of controls, all that. For some other areas, we will still be planning. So planning and all is not a one-time process, it's a continuous process. Yes or no? For some areas we will plan at the beginning and start doing it. For some areas we don't even plan at all. Next, what is the relationship between overall audit strategy and plan? Strategy is a broad approach, plan addresses specific matters. Yes or no? Strategy determines scope, timing, direction. Plan, how the strategy has to be implemented. Plan is more detailed than strategy. Planning is a procedure which is ongoing throughout the audit. Strategy establishes first, then plan will be developed. They need not be separate processes. They both are one and same. I told you, in reality, in the main revision I told, in reality both are one and same. Yes or no? Interrelated changes. Changes in one affects the automatically other. Now, changes to audit plan. Yes, auditor shall update and change the strategy and plan as and when necessary. Why you will change? Unexpected events, changes in condition, new information you got. So it ensures that plan is effective. Plan must be dynamic and flexible. Detailed checking of evidence, all that. Example, just an example they gave. Clear? Next, planning, supervising, review of work of the engagement team. You need to plan, supervision and review also. See, as a partner, I should review my team members' work, right? When should I review? That also I should plan, so that review will not be missed. Auditor shall plan nature, timing, extent of direction, supervision and review. So how to direct the team, how to supervise the team, how to review, that also I should plan. Why you need to, what are the factors that will influence the extent of direction, extent of review, extent of supervision, size and complexity, specific areas, assessed risk, capability and competence of the team members. Next, finally, you need to document the overall audit strategy and plan. Yes or no? This was asked in, I guess in CA final. Yeah, I think in CA final only it was, no, CA intro only, Jan 25, this is also asked, documentation related one. So what is the purpose of documentation? It's a record of key planning decision. It facilitates communication among the team members. It records nature, timing of risk assessment and further audit procedure. It helps, it helps us in review or approval of procedures before performance. What you need to document? Strategy, plan, significant changes. Whenever there are any significant changes, that reasons also you should explain why changes were made, and see that final strategy and plan is adopted and shows what is the appropriate response to the change, why we changed and what is the reason. That reasons and all we will be documenting. Next, audit program. Audit program is nothing but a detailed plan of verification procedures applied to financial statements and accounts to gather information. It provides instructions on techniques, and can we have a one audit program for every entity? Not one fits all. Okay, no one audit program fits for all. It depends upon nature, size, composition, internal controls, nature of audit services. All these influence program making. Yes or no? So you need to have a tailored program. So prevents time wastage, addresses special issues, ensures alignment with specific engagement objectives. And we should also tell our assistants to keep an open mind. Yes or no? Updation. Auditor frames program based on business, all that. Correct? Program provides minimum essential work only. Alterations has to be made based on the work experience gained. For relevant situations, you need to add. For any missing items or for unnecessary works, you need to delete. For that, you need to tell your assistants to keep an open mind, maintain open mind, note and report any matters which they got to know to the seniors and partners. So periodic review of the program. The program must undergo regular review. What is client business policy changes, making our program outdated. Obsolete program is called negligent work and legal consequences. So review of program and client operations to identify inadequacies and redundancies. Content beyond the tasks. Adherence must strictly adhere until officially updated by principal. So, and by the way, program is too rigid. So it is not true. If periodic reviews are done, program will be dynamic. Keeping it updated ensures its flexibility and relevance. Now, points to be kept in mind while constructing the program. You first have to keep in mind plan. Starts after last year audit. Review and modify based on control. Rely whether the controls are efficient or not. You may have option not to rely if other audit evidence is available. Consider procedure, consider timings, client assistance, all that. Some procedures might have to be done at fixed time only, so you need to keep that. For example, inventory physical counting you must do on 31st March only. Program key points. It should always be within the scope of the audit. It must be writing. Identify best evidence for a given assertion. Include only relevant steps so that particular assertion is tested properly. Specify objectives. Anticipate errors at beginning itself. Coordinate procedures for related items. Ultimately, the audit program is designed to provide audit evidence. Yes or no? Evidence determination is the auditor's primary task. It requires expert knowledge. Procedures depend upon prior knowledge. Audit evidence types, what are they? Documentary, statements, auditor calculations, internal controls, all this. Next, specific example. For cash, best evidence is physical count. For investments, best evidence is bank certificate. For book dates, best evidence is invoices, statements, confirmations. So assign weight. Which evidence is more useful? Assign weight. Use multiple procedures for reliability. Yes or no? not limit broader evidence, identify all normally existing evidence for all transactions. What types of evidence is available for a particular transaction, identify and try to gather all types of evidences. Now advantages, it guides the assistant with instruction, it will give you total perspective for major audits, it helps in selecting staff with proper capabilities, it reduces omissions. So no, it it assigns responsibility, it helps in tracking as audit progresses, it will help for future years, and it's an evidence for it's an evidence to prove that audit is properly planned in case auditor was charged with negligence, all that. Disadvantages, assistants may feel work mechanical because whatever is there in the program they just have to check that, they don't have to use any new point. Assistants feel it is rigid, outdated programs may be disadvantageous. Changes in staff or internal controls needs program to be updated. Inefficient articles, no, they might easily escape saying that point is not covered in program, so I didn't verify, and it kills initiation among the enterprises. So that's why you need to take certain precautions. What precautions? Ensure that your articles understand objectives and prevent blind following. Foster an environment of concerns and observation, create an environment where they can easily share their issues. Encourage objectivity, assistants has to verify the program unbiasedly, report any significant matters if they come across. That's it. Audit strategy planning program is completed, just 17 minutes. Actually in the main revision I took it for more than 45 minutes to 1 hour, little more detailed explanation again. Clear all of you? In the class it is almost 4 hours in depth, like you will not have even 1% confusion also. Clear? That's it. Yes, let's begin the revision of risk assessment and internal control topic. Now see, in this chapter there are multiple topics. First we need to understand what is risk assessment, then we have materiality concept, then we have understanding of the entity and its environment, what does it mean, then we have IFC concept, automated environment, then we have 330, response to assessed risk, that topic is there. Like there are multiple topics involved in this particular chapter, multiple topics are involved. So big chapter, I generally recommend to keep this as part of last priority topics. Even in my 3/4 strategy, risk assessment, internal control, I will suggest to ignore technically. The weightage of this chapter is 10 to 12 marks. The only reason why you have to watch a class is for MCQ purpose. If at all an MCQ comes, for that reason this chapter is relevant. For descriptive point of view, ignore this because this is the lengthiest chapter. The entire audit CA Inter, this is risky. The name itself is risk. This is very risky chapter because many questions will be confusing, especially internal control and 330 response to assessed risk inside the test of control topic. The control topic is bit advanced. So now first let me discuss about what is audit risk. So risk of expressing inappropriate opinion is called as audit risk. Risk of expressing inappropriate opinion, that too when if the financial statements are materially misstated. Like in a place where modified opinion is required, the auditor is giving unmodified opinion, that is audit risk. And what is not an audit risk? For example, you are expressing modified opinion when financials are not misstated, or business risk like litigations and all. This is not audit risk. And what is the consequence of audit risk? Reputational damage, regulatory action, legal action, all that. So what is the objective ultimately in our audit? You have to reduce the audit risk to a great extent as much as possible. Now, what are the components of audit risk? Why audit risk arises? First one, risk of MMS. Because the financial statements are prone to material misstatement. So that risk is called risk of MMS. And that particular risk, again, risk of MMS has multiple components again. Risk of MMS consists of inherent risk and control risk. All these risks, and you are not able to detect it. Financial statements are materially misstated and you are unable to detect them. Mistakes are there and you didn't discover. Naturally you think that they are true and fair, so you give an unqualified opinion which leads to audit risk. Are you clear? So audit risk exists because of two reasons. One is risk of MMS and detection risk. So misstatements examples are what? Charging capital to revenue, incorrect disclosures, inappropriate accounting policies, errors in accounting estimate, booking fake expenses, overstated receivables, all that. Now again, the risk of MMS is at two levels: financial statement level, assertion level. Most of the risks that we find in our audits is assertion level risk, specific transaction level risks. Valuation might be wrong, measurement might be wrong, completeness, purchases may not be completely accounted. These kinds of risks only we will find. Financial statement level means pervasive risks. If top management is not honest, that's a pervasive level risks. If whenever there is a financial statement level risk, pervasive risk, we do not accept the audit itself. We do not accept audit. After accepting audit, we got to know pervasive level risk, will withdraw. Next. And what are the components of risk of MMS? Inherent risk and control risk. Both are components of risk of MMS, and these are the risks which are there because of the entity. These are entity risk. Whether you do audit or not, these risks will be there. Next, what is inherent risk? Susceptibility of a particular accession to material before implementing internal control. Generally, what can go wrong in a particular area? That is inherent risk. Now, companies know, most of the companies know, they first identify risk. They only design control and implement to mitigate the risk. So, before implementing the control, what can go wrong? That is inherent risk. Next, they exist before controls, higher for complex calculations. What factors will influence? External factors, entity specific factors, anything will be there. Next, assessment. You know, this inherent risk is different for every transaction classes. You know, this is what test of control, this is drives design of controls and performance of test of controls and substantive procedure. And complex accounting standard, misinterpretation, high failure rate, all these are examples of inherent risk. Next, there is another risk called control risk. Control risk means what? It is a risk that a material misstatement is not prevented, detected, corrected by internal control. You know, control inefficiency. Control is there but not working effectively. It is not able. It is unable to prevent, unable to detect, unable to correct. That is called control risk. Higher control risk means weak internal control system. When control risk is very high, means controls are very weak. Auditor may not believe on the control, he will do more of substantive procedures. Next, for example, cash or checkbook control not followed, expired fire extinguishers, petty cash breaches, all that, inadequate reconciliations, all these are control weaknesses. Detection risk. What is detection? It is risk that your audit procedures will not detect material misstatement. What are the components of detection risk? Why detection risk is there? Because of sampling risk and because of non-sampling risk. Both are the reasons. Yes or no? Sampling risk. Sampling risk means what? Sample conclusions are different from population conclusions if at all population is tested. Non-sampling risk means what? Here you are taking a wrong conclusion but not because of sample. For example, you are applying wrong judgment, wrong procedure, or you are doing some errors. Yes or no? Human error. All these are non-sampling risks. Next. So this is a risk which is in the control of the auditor. Only component of audit risk which auditor can control is detection risk. Reducing detection risk means your audit risk will be reduced. So how to reduce detection risk? Scope of checks must be increased. Larger sample size, competent team members, experienced team members you need to put. Then automatically detection risk will decrease. Correct? Next. Now, assessment of risk is ultimately a matter of professional judgment. Correctly? Audit risk is a function of RMM and DR. Assessment is based on audit procedures, involves professional judgment, and you can't measure risk precisely. Yes or no? You can only judge it. So, distinguishing, exercised by auditor with training. How do you judge whether a risk is high or low? All that judgment of the auditor based on experience, training, knowledge, all that. Next. And combined assessment of risk of material misstatement. Auditor will assess inherent risk and control risk together. Generally, we assess combinedly. We don't do separate risk assessment. Even risk control matrix, if you see, inherent risk and control what is implemented by the company. Accordingly, we decide whether a risk is there or not as a whole. You know, then yes, generally don't refer separately both of them. You see, entire all the standards on auditing, we only talk about risk of MMS. We don't talk inherent risk and control risk together. Most of the standards, all the standards do not refer control risk, inherent risk separately. Both of it together, risk of MMS only we call it as. Next, expression of risk. It can be quantitative or it can be non-quantitative, qualitative also. Risk can be expressed in both the terms. Next, what is the relationship between components of risk? Inverse relationship. RMM and detection risk is inverse. When the risk of MMS is high, detection risk naturally becomes low. Higher MMR requires more in-depth audit. Automatically detection will decrease. While low RMM allows less extensive though high detection risk. That's it. Identify and assessing risk. It's okay, not required. This is no problem. Next. Now, what do you mean by risk assessment procedure? Risk assessment procedure is nothing but an audit procedure where your objective is to understand the entity and its environment, including internal control. Why are you understanding the entity and its environment and internal control in order to identify and assess risk of material misstatement? You know, by the way, risk assessment alone does not provide sufficient appropriate audit evidence. You need to perform further audit procedures. Risk assessment will give an idea to plan, nature, timing, extent of further audit procedure. So, assess whether the risks are pervasive or not. So, it is all about what can go wrong at a certain level. Next. Now, whenever you find a risk, consider its likelihood and potential magnitude. If the likelihood is so high, potential magnitude is so high, then we call it a significant risk. Next, use of information. Information serves as evidence for assessing risk, gaining audit evidence, understanding control. So you need information for risk assessment, gaining and understanding, control, evaluation, everything. Now, what is risk assessment procedure? Exactly what you perform. You inquire, you perform analytical, you observe and inspect. There are 3 ways in which risk assessment will be performed. Inquiry, analytical procedure, observation and inspection. Inquiries, to identify risk. To whom you will inquire. Governance, regarding financial preparation, evaluation. Internal audit, regarding internal control and how management responded to them. Employees, regarding accounting policy appropriateness for complex transaction. Legal counsel for litigations, compliance, fraud, so all that. Marketing and sales people for knowing strategies. Risk management function for understanding operational, regulatory. IT people for system challenges and failures and risks. We do also perform analytical procedure as a part of risk assessment. So purpose, identify unusual transaction, unusual trends. Yes or no? Identify unusual ratios. We perform ratio analysis, trend analysis, reasonable analysis, structural modeling, various tools. Observation, to understand the entity, observe the operations, inspect the documents, review management reports, observe client premises. What do you mean by significant risk? Significant risks are those inherent risks with high likelihood, high magnitude. I told already. High likelihood and high magnitude of a particular risk is called as significant risks. Fraud risk and related party transactions are always considered as significant risk areas by default. Now there are various other factors. How do I know whether a risk is a significant risk? Is it a fraud risk? Are there any significant changes in economic, regulatory, legal? Are there any complex transaction? Is it a significant related party transaction? What is the degree of subjectivity? Is it a non-routine or unusual transaction? If so, this will be categorized as significant risk. So what is a non-routine transaction? Unusual transaction because of the size or nature, which will happen infrequently. What are judgmental matters? Accounting estimate with significant measurement uncertainty. Next. And we all know risk of MMS is greater for non-routine transaction. Yes, higher management intervention will be there. Non-routine transaction means unnecessary management intervention. Normally they won't intervene in all transactions. For some transaction, management high intervention. So that's a non-routine. Increased error risk due to manual data handling. In an automated environment, if data is processed manually, that's an exceptional transaction, unusual transaction. Complex calculations. Non-routine transaction can make it hard for an entity to put controls. Controls will be there for all routine known transactions. For non-routine transactions, there won't be any internal controls also. So, risk of MMS is greater for non-routine transactions because of the following reasons. Risk of MMS is greater for judgmental matters also. Why? Different interpretation of accounting principles, subject to judgments, assumptions about future events. Ultimately, you should document the risks. What you need to document? Engagement team discussion, decisions reached, recording key elements of entity understanding, environment and internal control, documenting identified and assessed risk at both the levels like financial statement level and assertion level, and develop a risks and control matrix, RCM we call, risk control matrix. That's about risk assessment topic. Okay, all of you? Then we have something called materiality, SA 320, materiality in planning and performance of an audit. What is materiality? What is, first of all, definition of material? Financial statements must disclose all items, important items. Material means that something which influence user decision. Materiality is not just size. Even small items and serious issues also sometimes become material if it is a fraud. There are some quantitative indications also. For example, Schedule 3 says income or expenditure which is more than 1% of revenue or 1 lakh, whichever is higher, that is material. Shareholders more than 5%, they are material. So the standard that is addressing about materiality is 320, and also 450 also talks about materiality related discussion to some extent. So materiality is defined sometimes in financial reporting framework. often discussed in financial statements. Characteristics of material likely to influence users. Judgments are based on size, nature, or both. Based on common user needs, we decide materiality. Suppose if financial reporting framework is silent, above characteristics will be giving you a reference. Auditors can use the above characteristics as a reference to decide materiality. And when you're doing audit, as an auditor, you should take some assumptions about the users. What assumptions you should take? You assume that they know reasonable knowledge of business. You assume that they know the concept of materiality. You assume that they understand estimates, judgments, future considerations. You assume that users will take an economic decision based on the financial statements. These are the assumptions that we take based on users. This was asked in CA final once for 4 marks. Be careful. In inter also it can be asked. In one of the MTP it was asked. Next. Now, what is performance materiality? Performance materiality is an amount set by the auditor at a lower amount, correct? Lower than overall materiality, below overall materiality, for reducing the chance of undetected, uncorrected, exceeding overall materiality. Performance materiality can also be for specific class of transaction account balances and disclosures. Yes or no? Understood? Specific performance materiality, we call it as. And how do I determine materiality? You can use benchmarks. Okay. So, auditor's professional judgment, apply a percentage to the chosen benchmark. Factors influencing benchmark: financial statement elements, user focus areas, entity nature and context, ownership and financing, benchmark volatility. Examples and selection of benchmark. Examples: these can be various benchmarks: PBT, revenue, gross profit, all that. Selection of benchmark: you can select it from current period, or you can select it from prior period, you can select from budgets, or and one more thing, if at all PBT is more volatile, then use normalized PBT. Based on past average PBT you can use. Current year PBT, if you think last year PBT, current year PBT is too different. If at all a particular benchmark is highly volatile, use some other benchmark. Revenue you use. If revenue is also volatile, use some other benchmark. Capital, share capital, net worth. Finally, auditor will apply professional judgment and determine a percentage on a chosen benchmark. Typically, percentage on PBT is higher than percentage on turnover. Generally, when you're deciding materiality, percentage applied on PBT is higher percentage, because profit is lower amount will be bigger, but turnover will be bigger amount, so percentage will be smaller. In our EVO class, I clearly explained about this materiality discussion. So in depth I discussed triviality level, performance level. I linked it with tolerable misstatement, all that I discussed so extensively. Here I'm just doing quick revision. Sometimes we decide materiality for a particular class of transaction separately. When auditor feels misstatements below overall materiality can influence users' decisions at some areas, for those specific areas, we can decide materiality level separately. Generally in this company, on any particular item, if at all 10 lakhs and above mistake is there, it's a material misstatement. But for statutory duties verification, statutory due verification, 1 lakh is enough. I may decide like that. For TDS verification, GST verification, Provident Fund verification, 1 lakh itself is material for me. Now, so sometimes misstatements below overall materiality can influence user decision. Here, for statutory compliances, the lawmakers and all, they may not tolerate up to 10 lakhs variation. Up to 1 lakh they may tolerate. So what are the factors that influence the auditor's need to decide a separate materiality level for a separate class of transaction? Legal and regulatory impact, industry specific key disclosures, focus on specific business aspects. Suppose user had a particular retention on so and so. For example, newly acquired business is there. Recently we acquired one business and everybody is eyeing on that. So for that business, even a small error also we won't tolerate. So their materiality level can be lower or higher, we don't know. Able to understand. Finally, sometimes the materiality has to be revised because of new circumstances, because of new information, where actual results were different from anticipated results, or high risk estimates, or you got a better understanding of the client. Suppose that's it. And documenting the materiality, you need to document overall materiality, you need to document specific materiality, you need to document performance materiality, you need to document any revisions made to the above, including reasons thereof. Understood? Then, and materiality and audit risks are throughout the audit. Yes, materiality is applied in planning and performing the audit and evaluating misstatements and also forming the opinion. Materiality is used throughout the audit. And materiality and audit risk, they are used throughout the audit, at the time of risk assessment, at the time of performing audit, at the time of evaluating opinions. Next, Understanding the entity and its environment. What do you mean by understanding the entity? There are 5 things you need to understand: industry, regulatory, external factor, nature of the entity, how they are following accounting policies, what strategies and business risks that their ideas are, measurement and review of financial performance. Now, industry, regulatory and other external factors. Industry conditions, regulatory conditions, external conditions. Understanding the entity means its industry, its regulatory and external functions, like what is the competition, technology, risks from nature and various issues, regulatory actions, environmental issues, economic conditions, interest, inflation and financing, all that. And nature of entity, who are the key customers, debt structure, accounting principles, all that. Selection and application, evaluate, are the policies appropriate, are they comply with applicable standards, are they matching with industry standards. Objectives, understand to identify risk of MMS. Business risks, no, it's a broader term than risk of MMS. So understanding business risk, you might understand risk of MMS. So suppose if the company might have lack of expertise, new product might be launched, demand mismatch, all this, like how companies assessing business risks, what are the strategies that you need to understand. And look at key performance indicator, financial statement analysis and external reports. So measurement and review of historical financial performance means key performance indicators you check, financial statements, budgets, variances, external reports like credit rating, all this also you check. By understanding all these things, you understand about the entity and its environment. And remember, understanding is not a one-time process, it is a continuous process. Why you need to understand? For planning better, to identify special areas, to get a basic knowledge about the client business. So understanding, wow, importance, identify and assessing risk, setting materiality, assessing accounting policies appropriateness, identifying special audit areas like related party, going concern, all that, establishing expectations and assessing audit evidence. So for all these purposes, I need to understand. Understanding is a continuous process. Internal control. What is internal control? Internal control is a process designed and implemented by governance or management or personnel. Purpose: to get a reasonable assurance on reliability of financial reporting, efficiency and effectiveness of operations, asset safeguarding, law and regulation compliance. Then benefits: it will help you to identify potential misstatement, identify RMM factors, and it will help you to design further audit procedure. Correct? There are inherent limitations like human judgment, lack of understanding. The person implementing the control may not understand the true purpose. Collusion, management judgments might be wrong. Smaller entities, segregation of duty won't be there, impractical. Owner managed, he will have better oversight, but easy to override also at the same time. Better override, owner can oversight better. Manager can do frauds easily. Auditor's role: consider all these factors when you are assessing internal controls in a smaller entity. Then internal control components, 5 components: control environment, risk assessment, information system, control activities and monitoring. Control environment means governance, management functions, attitudes and actions. Control environment sets the tone of the organization. And elements, there are totally 7 elements. What are they? Integrity and ethical values, commitment to competence, participation by top management, management philosophy, organization structure, assignment of authority, human resource policies, HR policies. I discussed in depth of all this in EVO. It's on EVO batch. So TCGG, how they are valuing, TCGG values that leads to internal control effectiveness. How these values will be communicated via policies, code of ethics and management actions. Participation, competence. Management has to ensure requisite skill or knowledge for jobs. Participation, TCGG has to participate independently from management. Their experience, stature and scrutiny. Appropriate actions, interaction with auditors. Approach to business risk taking, financial reporting, information processing. Structure, what is the framework for planning, executing? Include key authorities and responsibility. How authority has been assigned, how hierarchies are established. HR, related to recruitment, training, evaluation, promotion and compensation. Recruitment focuses on qualification, training focuses on roles and responsibilities. And control environment, can it deter the fraud? Absolutely no. Control environment reduce risk of material misstatement, may lower risk of the fraud, but it is not an absolute deterrence to fraud. Weaknesses in internal control effectiveness. If at all control environment have deficiencies, it will indirectly weaken the internal control system. So control environment role, it does not directly prevent or detect, but it influences auditors' evaluation of other controls. Next, another component is risk assessment process. What is risk assessment? Understand entities process. Understand entities process, how entities identifying the risk. How it, it will help the auditor to identify risk of MMS. Auditor assess entities process for identifying risk, evaluating significant risk, determining likelihood of risk, deciding what actions to take. Then information system, identify significant transaction, how the transaction flow is happening in the company, understand what records they are maintaining, how significant events are captured, what is the financial reporting process, understand controls over journal entries. This is information system. Then monitoring, control activities. Control activities are nothing but policies and procedures. These are nothing but IT or manual system which are implemented at various levels of the organization. Auditor will focus only those activities related to transaction, whether a control activity relevant or not. CA, here in this context, CA means control activity, nothing but. Significant risk exists, consider relevant based on auditor's professional judgment. Monitoring, it's a process to assess effectiveness of control for timely assessment and remediation. Correct? Types of monitoring, ongoing. For example, in a bank, concurrent audit is an ongoing activity. Separate evaluation, RBI inspection, banks inspection department, internal audit, all that. Sometimes in control activities, sometimes for monitoring, we may use external information like customer complaints, regulatory comments, all that. Now, what do you mean by controls relevant to audit? Auditor understand internal controls relevant to audit. Mostly related to financial reporting, but many controls related to financial reporting, but they may not all be relevant for auditor. So whether a particular control is relevant or not, auditor has to judge. What are the controls not relevant to audit? Some operational controls. Next, what factors will influence? Materiality, entity size and operation, diversity and complexity, circumstances and applicable IC component, how far control is preventing, detecting and correcting material misstatement, like that. And nature of organization and ownership. So these are the factors that will influence relevance of a control. Now there will be some controls over completeness and accuracy of information. It is relevant if auditor uses information for further audit procedure. Example it's okay, not required. Operational compliance control. There will be some other controls which are relevant if data is used for audit purposes. Example, for purchases, we use purchase order control for accuracy and completeness checking. Then there will be controls over safeguarding of asset. Safeguarding of assets, it may be for financial reporting objective or it may be for operational objective. Financial reporting objective, auditor focuses on controls relevant to financial reliability. Usually operational objectives may not be relevant to auditor. Next, examples of safeguarding of control, asset tagging, all that. Next, nature and extent of understanding of the control. Auditor has to assess whether a control can effectively prevent, detect and correct material misstatement. If a control is implemented, it shows that control is existing and entity is using it. First, evaluate the design. Yes or no? Improper design leads to significant deficiency. Next, risk assessment. Enquire entities personnel, observe specific control application, inspect documents, trace transactions. All this you need to do to understand the relevant control. Remember, understanding is not enough for getting operating effectiveness. Idea about operating. So in order to understand operating effectiveness, you need to evaluate the control. You need to test the control. Now there are many benefits because of evaluation. What are the benefits? Determine system adequacy, whether internal control system is adequate or not, you will understand. It verifies internal audit department effectiveness. It ensures assets are safeguarded or not. It shows whether reports are reliable or not. It identifies, determines suitable techniques to be applied, highlights weak areas and provides suggestions for improvement. Next, and remember, you can develop an audit program only after satisfactory understanding of internal control. Only after understanding you can develop an audit program. You must confirm internal control actually operating or not before you develop. So for that, understand, assimilate means get an understanding of controls and implications. So proper IC understanding is important in order to apply proper audit procedures in areas. Significance of test checking. IC, internal control existence and operation, influence test checking plan. Weak internal control, it will add more audit procedures or alter the audit procedures. Because of this, you will extend more tests. You will perform extra tests for getting ultimate satisfaction. Next, there are many methods of evaluation of internal control. Auditor, to understand internal control, he will review manuals, organization chart, flow charts, all that. So understand information collection, processing, controls. Auditor has to ask right questions and document whatever he has asked orally. Then methods, narrative, it's a detailed system description. It is suitable for small companies where there is no formal system, harder to comprehend, harder to identify weaknesses. It is harder to update changes. Checklist. Checklist is nothing but instructions or questions where the answer will be yes or no, not applicable. Flowchart is a graphical representation of internal control system. It gives you a concise view, less narrative, shows transaction flows, easy identification of ID refers to identification of improvement areas. Internal control questionnaire. It's a comprehensive questions on internal control regarding existence, operation, and efficiency. Less likely to overlook significant because of ICQ. All significant controls we for sure control. There is a less chance of oversight. It reviewed in sections or interim, and annually it must be once has to be done. Yes is a satisfactory answer, no is a weakness. Generally it's issued to the client for completion, then auditor reviews and then give recommendations. Almost every point is covered in the GOAT notes. But in order to understand chart notes thoroughly, you need to understand GOAT notes thoroughly. That's it. That's how it is more useful. Or somebody has to watch the chart revision. That's it. There's only two ways you can understand these chart notes better. Examples of ICQs, internal control, purchases, creditors, inventory, fixed assets. So how a questionnaire will be there? Why test of controls are performed, what it includes. After understanding internal control, test of controls ensure IC system is an actual operation or not. How do you know whether a system is actually working? Test it. You can cover multiple years, but once in 3 years you must do comprehensive testing. This is a COSO requirement. COSO, I told in the class also, a committee of sponsoring organization. Test of control goals, provide evidence for system design, provides evidence for effectiveness. Whether accounting system, internal control system design is proper. Whether are they working effectively. Test of control components includes control environment test. Understanding controls and also provide effectiveness evidence. When you are understanding the control, it also gives you evidence about effectiveness. Then test of controls includes inspection, inquiries and observation, reperformance and testing the actual control. Suppose when you are testing control, you may identify deviation, inquire the deviation and see the amend your control risk assessment because originally you thought control is working, now it is deviated. Adjust substantive procedures accordingly. Next, automated environment. Automated environment is a business setting where processes, operations, everything is done through computer. Key features: reduced manual intervention, system driven, faster operation, accurate data, large volume capability, integration, reduced human errors, access to latest information, strong connectivity. And ERP systems increases complexity. Off the shelf software indicates less automation. Understanding and documenting automated environment. Auditor has to understand IT environment. What are the department dependencies, all that. And he need to document understanding. What he need to document, what information system is the company is using, what is the purpose, where it is used, where it is, what is the architecture, which version, system interfaces, is it in-house developed or packaged, what are the outsourced IT activities, who are the key persons, chief information officer, chief information security officer, system administrators. Next, what are the risks arising from use of IT system? Inaccurate processing, unauthorized access, back-end changes, excessive access, inadequate segregation of duties, unauthorized systems or program changes, poor change management and data loss. These are the because of the risk, and these are the various types of IT risks. Because of this, what happened? Reporting, controls. Audit, if at all there are high IT risk, auditor will not rely upon automated controls. Because he will not rely on automated, increase testing on substantive. Sometimes it may also lead to modified opinion. For example, IFC. If IFC is having more risks and IFC is not effective, auditor may give a modified opinion on 143 subsection 3 clause number I. Next, what are the types of controls in automated environment? 3 types: general IT controls, application controls, IT dependent controls. What are general IT controls? These are the policies and procedures supporting application controls, and these apply across environments. It ensures information integrity and data security. General IT controls, there are 4 types: data center network operation control, program change control, access security control, system development and maintenance control. Ensuring production system meet financial reporting objective. It's a data center and network control. Ensure that modified system meet financial reporting. Modified system means program change. Production system means main data center. Ensure authenticated authorized access. Who will have authorization to access to data? So that's an authorization control. Access security control. System is developed and implemented to meet financial reporting. See that system is developed properly, implemented properly. That's a system development and maintenance control. See that production system meet financial reporting target. Whatever system is implemented, nothing but network operations and data center. That's the main control. Characteristics. General IT controls mitigate IT risks across multiple systems. These are pervasive controls. These are also called as indirect controls. These are also called as ELCs, entity level controls. Next, application controls. These are automated controls or manual controls at a business process level. Billing controls, purchase controls, sales controls, all this. Ensure data completeness and accuracy. These are embedded in the system itself. IT dependent. IT dependent means what? They're basically manual control, but are using IT. Manual controls relying on IT system. Effectiveness depends on source data reliability. Require general IT controls to be effective. That's it. It's actually interrelation. Here heading is not application control, interrelation. What is interrelation? General IT controls support application controls for complete accurate information processing. If general IT controls, if they are effective, then there is a chance that application controls will also be effective. What are the testing methods used in automated environment? Inquiry, observation, inspection, reperformance. This is the order. Inquiry is most efficient. Reperformance is least efficient. But reperformance is most effective. Inquiry is least effective. These are the testing methods used in automated environment. So which method auditor has to use? It's a matter of professional judgment of the auditor. Yes or no? Application depends on risk assessment, control environment, desired level of assurance, all that. If auditor wants greatest assurance whether a control is working effectively, then he will do reperformance. Key points. Auditor understand end-to-end transaction processing. He will inspect configuration. He will verify system logs. He will check the manuals, and he will do negative testing to know whether a control is working effectively or not. And what are characteristics of manual and automated elements of internal control? Both manual and automated elements in internal control affect transaction initiation, recording, processing. Manual controls like approvals, reviews, reconciliations, and follow-ups, they operate independently and they use IT information. Automated controls, they are electronic records for transactions, all that. What is impact of manual element in automated environment? Manual controls are useful for unusual transaction, hard to define scenarios, and changing circumstances. Limitation, manual control, no, there is a possibility of bypass, there is a possibility of error, there is a possibility of inconsistency. It is unsuitable for high volume of transaction or recurring transaction where automation is what? Best. Audit approach in automated environment. Do risk assessment, understand and evaluate, test operating effectiveness, and finally report. Then data analytics in audit. Data analytics means what? Processes, tools, techniques to extract meaningful information from the data. How do you extract? Using the CAT tools. These are the tools used for data analytics. Tools used for data analytics are called as CAT tools. Data analytics means what? To get a meaningful information, we use some tools and get a meaningful information and analyze the data. What is the use of data analytics? You can do completeness check for audit sampling purpose, recomputation purpose, mathematical reperformance, journal entry analysis as per SA 240, fraud risk, and fraud investigations. In all these cases, data analytics will be useful. Then digital audit. Entities adopt digitization to evolve into new business models. Auditor integrate digital technology throughout the audit process. In CA final, we have a full-fledged chapter on this. One big chapter on this. 5 marks weightage only on that chapter. Artificial intelligence, data analytics, and some other technologies used to understand process, enhance audit quality. It enables better risk identification. Finally, you need to assess and report findings in IT environment. Assess or report IT environment or control findings, exceptions to management and top management. Use professional judgment. Assess findings quantitatively, qualitatively. Are there weakness in IT controls? Impact on overall audit is what? Report deficiencies to management. Communicate significant deficiencies to top management. That's it. What do you mean by deficiency? If a control is not designed or implemented to prevent or correct. If a control is ineffective, that's a deficiency. Control is missing, that is also deficiency. Anyhow, in 265 regarding this, we discussed in depth. Then IFC, internal financial controls. What is the objective of IFC? Same control objective, safeguarding of assets, prevention and detection of fraud, legal compliances, maintaining reliable financial statements, accounting records, timely reliable financial reporting. Same objectives. Efficiency and effectiveness of operations, that alone will not be there in IFC. Responsibility. Management is primarily responsible for maintaining IFC. Auditor will evaluate its operating effectiveness. And under Companies Act, IFC was given under various sections. Listed companies, director responsibility statement must explain whether IFC is implemented. Is it operating effectively? They need to talk. Auditor report. Auditor has to tell whether IFC is in place and is operating effectively. By the way, IFC reporting is not applicable for 1% company, small company and private company if turnover is less than 50 crore and borrowings are less than 25 crore. I already covered this in audit reporting chapter also. Section 177, audit committee has to evaluate IFC, evaluate risk management system. And under 149, independent director has to ensure financial information and they need to ensure robust financial controls and risk management. What is difference between IFC and IFCOFR? IFC talks about policies and procedure. IFCOFR is all about reporting on the adequacy and operating effectiveness. What is the difference between internal financial controls and internal financial controls over financial reporting? The difference is IFC means policies. IFC over FR means it's about reporting on existence, adequacy, operating effectiveness of the controls. Next, 330 auditors response to assessed risk. In 315 you do risk assessment and you will assess it. 330 talks about further audit procedures. Further audit procedures means what? Performing test of controls. Factors influencing extent of test. What I tell you is, in this test of controls, you know, this point you remember, specific inquiries when deviations are detected. When deviations are detected, no, what you need to do? Assess whether test of control provides sufficient basis, determine additional test needed, address RMM with substantive procedure and substantive. Substantive procedures are performed for all class of transactions, all material classes of transaction balances and disclosure regardless of risk. The objective is to detect material misstatement. You know, substantive procedures are two types: test of detail, substantive analytical. To what extent? Sometimes you will do substantive analytical alone is sufficient. Test of details, if supported by control testing, combine analytical plus test of details is a best combination. If at all unsatisfactory control test results, increase the substantive testing. Consider sample size or altered methods when designing test of details. That's it. Remaining are not that important in 330. Technically 330 I tell better to leave. Okay. Sometimes question might come, but bit tough to comprehend it. Almost 40 minutes we spent on chart revision for risk assessment and internal control. A very brief revision only I did. So because in EVO batch we discussed in depth. Clear? Yes, let's begin the chart revision of different types of entities. So in this, first we will discuss about cooperative societies. First we will discuss about cooperative societies, which is most important. Audit of cooperative societies. Cooperative societies are broadly two types: normal cooperative societies and multi-state cooperative societies. For multi-state cooperative societies, Multi-State Cooperative Societies Act 2002 is applicable. For normal societies, Cooperative Societies Act 1912 is applicable. This is the last topic. Cooperative societies audit is the last topic in different types of entities. Fine. Now, so what is the role of the auditor in cooperative societies? This itself can be asked as a 3 marks question. He can guide, he can do system installation, he can do internal audit, he will provide management accounting services, he will give taxation services and guidance on accounting practices. Guide means nothing but guidance on accounting practices, all that. And next, audit of cooperative society. Registrar or authorized person must audit at least once a year. Registrar will directly audit or any other person authorized by the registrar. Scope, he will examine overdue dates, assets, liabilities, all that. What and all he will examine, we have at last. Okay. Next, the auditor or registrar has rights. Registrar or authorized person has the following rights: access to books, accounts, right to require information from auditor, all that. Who will be appointing the auditor? Registrar will appoint, and registrar is the person appointed under the act. Next, then we have some discussion on multi-state cooperative society. What is a multi-state cooperative society? If a society whose objects extends beyond a single state, then it is called as a multi-state cooperative society. And remember, a multi-state society funds cannot be used for political purposes. Next, books of accounts. They must maintain books of accounts for money received and expended, assets and liabilities, sales and purchases, cost in case of manufacturing societies, cost records. Next, qualifications and disqualifications. Qualifications, only chartered accountant can be appointed. For a normal society, no. The auditor can be a diploma holder who has a diploma in cooperative accounts. He can be auditor for a normal society. But for multi-state society, just like a Companies Act, chartered accountant in practice. Disqualification, body corporate, officer or employee, member of the society, or employee of officer or employee, or a person who is indebted or guaranteed or security has given for an amount exceeding 1000 rupees, he is also disqualified. Next, and if at all after appointment auditor became disqualified, he is deemed to be vacated the office. What is the tenure of first auditor? Till first AGM conclusion. First of all, Appointment. First auditor will be directly appointed by board of directors within 1 month from the date of registration, or general meeting if board of directors fails. Subsequent auditor, members at each AGM they will appoint, yes or no. The tenure will be till first AGM. Subsequent auditors appointment will be valid up to the next AGM. Next, powers of the auditor. Right of access, right to access to books, documents, voucher, inquiry and information of the officers, employees of the society. Duties. First and foremost, he has to give a report. Second point, you see, he has a duty to report on accounts, examine whether balance sheet, P&L give true and fair view. Then he has a duty to make inquiries. 4 inquiries. Inquiry into loans and advances, whether security is there or not, terms are not prejudicial. This is something like 143 subsection 1, 6 inquiries are there, right? Here only 4 inquiries were there. Okay, so whether book entries are they not prejudicial, personal expenses, ensure that they are not charged to P&L. If any shares are allotted for cash, whether cash is received or not. If not, balance sheet position is correct or not. Then duty to state certain matters. This is like a checklist item. Okay, state whether necessary information obtained, say whether proper books are kept, say branch reports are received or not, say whether financial statements are matching with books, state, and for any negative comments, you need to give reasons. Next, and there is a concept called special audit in multi-state cooperative society. When special audit can be audited, if society affairs are not conducted as per cooperative principles or prudent practices, or society's affairs are likely causing injury, or society's solvency is in danger. In all these 3 circumstances, special audit can be ordered, provided central government or state government should hold more than 51% of the paid up share capital of that society, which means it's a government owned cooperative society. Only for them special audit can be ordered by central government. Now, who will appoint special auditor? Central government will appoint. Powers of the auditor will be same as normal auditor, yes or no? And government will take action within 4 months of the submission of the report. If no action is taken, they just send the report to the society, yes or no? Expenses determined by government, paid by the society. If at all society is not paying, it is recovered as an arrears of revenue. Easy. Then apart from that, government has a power to inquiry or power to inspect society affairs. Okay, when the affairs can be inspected, who will apply eligibility? Eligibility nothing but application by. Application will be by whom? Either creditor, or 1/3 of the board of directors, or 1/5 of the total members. Any of them can apply for inquiry or inspection. Then application will be to central registrar. Inquiry by whom? Either registrar himself or the authorized person. Correct? Notice, you must give 15 days prior notice before you initiate inquiry or inspection. Then powers, access books, documents, properties. He may call general meeting also with a 7 days notice, can call meeting, yes or no, and can issue summons, examine under oath. Next, report. Central registrar communicates the report within 3 months to the society and the applicant. See how crisply it came? Every point is covered. Next, then there are some special features in audit of cooperative society, and special features. One of the important thing is overdue debts. Society debts will be classified into 2 types: 6 months to 5 years and more than 5 years. Overdue debts. Comparison to the total working capital. How much is the total overdue debt divided by total working capital and compared to the previous year. You need to assess whether they are good or bad and see that adequate provision is maintained. And overdue interest accumulated on overdue debt, nothing but those debts which are overdue. On that, whatever interest is there, this is nothing but interest on NPA in the context of bank. So that is overdue interest. Overdue interest will not be recognized on accrual basis, yes or no? It is excluded from interest recognition. It is directly credited to overdue interest reserve. In case of bank, no, interest on NPA is recognized in memorandum account. Here it is credited to interest credit reserve. And then finally it will be transferred to P&L only after realization. Correct? Next, bad debts. Auditor authorization is required in some state tax like Maharashtra, like that. Otherwise, managing committee authorization is required. Next, valuation of assets and liabilities is a normal one. It's a normal one. No specific point for the society. Adherence to cooperative principle. This is something specific. Auditor has to check functioning of the society aligning with the objectives and for the benefit of the members or not. Ensure propriety principles, economy maintained or not, no wastage, no direct purchase. And society has to purchase directly from suppliers by eliminating middlemen, all that. Next, an auditor must verify non-compliances with the act and rules thereunder. An auditor has to give a special report to the registrar. This itself can be asked as a 3 marks question, most observation. So auditor has to give a special report where he will report irregularities, he will report like a personal profiteering by the managing committee, fraud management, fraud, mismanagement, reckless advances. All these cases auditor has to give a special report to the registrar. Next, The auditor has to verify members register also personally in some cases, especially rural areas. Yes or no? Next, audit classification. Auditor will assign a class based on registrar's criteria. Management can appeal to the registrar for the class awarded by the auditor. And remember, before you give a final audit report, you must discuss draft audit report with the committee before finalization. Finally, the last one, special issues in cooperative society. What are the special issues? Special issues in cooperative means normal society. Qualification, CA can do audit, or a diploma holder or experienced person as per state act can do the audit. Yes or no? Appointment, auditor is appointed by registrar. He will act on behalf of registrar. He will report both to the registrar and society. Fees will be decided as per the scale, statutory law. Next, state government prescribed books of accounts, subsidiary books, all that for all large societies. Next, restrictions on shareholding. Maximum a person can have 20% of the total shares, or maximum face value 1000 rupees. Only whichever is lower. Next, restriction on loans. Only to members a society can give loans unless registrar approves. Next, restriction on borrowing. Society can accept loan from any members provided bylaws permit it. Next, investment. Society, they have many options, like they can invest in another corporate society, or they can invest in banks, or they can invest as per Indian Trust Act, or they can invest in shares and securities of limited liability societies, not companies, remember. Okay, central government or state government permitted areas, these and there and all society can invest their surplus money. Appropriations of profit. Society must transfer a prescribed percentage to reserve fund before distributing dividend. The transfer to reserve fund must be before dividend. And contribution to charitable purpose. Maximum 10% of the net profit after transferring to reserve fund. Profit calculate after transfer to reserve fund. After transferring to reserve fund, calculate the profit. On that maximum 10% only they can contribute to charitable, that too with registrar sanction. Next, and how reserve fund can be used. Reserve fund can be used for working capital purpose, investments purpose, public purposes. I mean for promoting objectives of the society, for that any of these purposes. And society can also contribute to education fund, and contribution to education fund is treated as a charge on P&L. MCQ, correct or incorrect based MCQ, for that important. And other appropriation, so transfer to other reserves, dividend after general body approval. GB refers to general body, nothing but managing committee approval. Accounting entries after general body approval. Auditor must spot contradictions between statutory provisions and accounting principles. That's it. Corporate societies concept is completed. Are you clear? Yes, all of you? Yes, that's it. Just a minute. Now let's continue discussion on government audit. Just now we completed societies audit. Now government audit. So government audit, background of government audit. What is it? Dates back to organized governments, evolved with political, social, economic purpose. What is the purpose of government audit? It ensures executive accountability for public revenue expenditure. Parliament or state legislatures, they will control spending via demand for grants. Expenditures required approval by parliament or legislatures. Funds will be from Consolidated Fund of India, all that. Article 266 talks about Consolidated Fund of India, where the fund includes all collections from taxes, loans and loan repayments. Yes or no? Then, and even in this government audit, we incorporate standard auditing practices, new audit concepts and all were evolved. That's it. Then, meaning and objective of government audit. Definition. There is a definition on the UN handbook. It's an objective, systematic, professional, independent examination of public entities' financial, administrative and other operations, which is conducted after execution. Yes or no? It involves reporting findings, conclusions, recommendations and expressing professional opinion on financial statements. Objectives: ensuring public accounting of government funds, appraisal of government policies. It's a base for corrective actions by supervisory officials. So administrative accountability, ensures accountability. The government audit is administrative accountability indirectly. It ensures accountability, but it is not an investing agency to identify all irregularities. It combines accountability to the legislature with aiding administration. In India, this entire audit is conducted by Supreme Audit Institution called C&AG and through a department called IAAD. C&AG verify compliance with constitution, laws, rules and orders. Next, legal framework around C&AG. So what is the C&AG legal framework? It is he is appointed by president, removable only like a Supreme Court judge, like proven misbehavior, incapacity, 2/3 majority in the both houses, then only he can be removed. Salary determined by parliament and cannot be varied to disadvantage after appointment. Administrative powers are always with president. Constitutional 149, duties and powers Define duties and powers of C&AG. 150. Form of accounts prescribed by President for central and state government establishment. 151. Reports submitted to President. So no, 151 says audited accounts and reports has to be submitted to President in case of central government companies, governor in case of state government companies. Correct? Then tenure. Fixed tenure. Just like a Supreme Court judge. Next. Duties of C&AG. Compiling and submitting the accounts. Providing information and assistance to the government. General provisions relating to audit. He will do audit of receipts and expenditure. He will audit grants of loan. He will audit receipts. He will audit stores. He will only audit government companies. This is the role of C&AG. Now each of this is given as a separate discussion below. Next, what are the powers of C&AG? He can inspect accounts under what are all government officers. He can inspect accounts. He can access documents, books. He can put questions and observations. And he can dispense with detailed check and apply limited check. That is his choice. C&AG can go for detailed checking, or he can dispense with the detailed checking and only do test checking. Next, audit of government expenditure. So audit of government expenditure covers 5 types of 5 principles. 1. Audit against rules, audit of sanctions, audit of provisioning of funds, propriety audit, performance audit. Audit against rules. Here we check whether expenditure is matching with statute, rules, regulations. We will check consistency with laws and regulations. Sanction. Ensure expenditure is covered by proper sanction. Nothing but is the expenditure approved or not. Then ensure fund provision exists and expenditure does not exceed appropriation. Once expenditure is sanctioned, it's like a sanction limit. Then provisioning of funds means like a drawing power. In order to understand in the best way, sanction limit and drawing power is decided based upon the rules. That is nothing but audit of rules and regulations. So audit of rules and regulations means the law under which expenditure is permitted first of all. Then you will sanction. Then you will allocate the funds in a particular bank account. From there only it will be withdrawn and then spent. Then in a government audit, we need to focus on propriety element, ownership, proprietor. Propriety means ownership, propriety element, where the auditor objective is to identify improper expenditure, avoidable expenditure. Even rules are compliant. Like expenditure may be incurred as per the rule, but it is still wasteful. Next, performance audit. In this performance audit, we mainly focus on whether programs and schemes are running economically and are they achieving expected results. Next, propriety audit. Objective, identify improper, avoidable, wasteful expenditure. Here we evaluate reasonableness, faithfulness and economy of the expenditure. Correct? The following are the general principles. It is basically common sense. There is no precise rules, but there are some guiding factors for propriety principles. Is it reasonable? Like a prudent ordinary person, how much he will spend, that much only government official also should think like and should spend like. There should not be any self benefit. Authorities should not sanction for benefit of their own. No partiality. Public money should not be used for any particular purpose, particular section of the or particular community. However, some exceptions were there. If the amount is insignificant, not an issue. It is legally enforceable, no problem. It is as per accepted custom, no problem. Or allowances has to be regulated so that it is not a source of profit to the person who is authorizing it. And the expenditure shall be transparent, shall pass down to the beneficiary. Yes or no? It should only be compensatory in nature and not a profit. Then performance audit. Objective. Performance audit ensures programs and schemes run economically and yield expected results. Objective examination of performance, identify opportunities for economy. Components: efficiency, economy, effectiveness. Efficiency between goods and services produced and resources used, the relationship. Economy, whether the resources, human capital, financial resources, are they acquired economically. Effectiveness, ultimately the program is achieving objectives or not. Procedure, identify the topic, preliminary study, planning, execution and reporting. Remember, we have in CA final something called PSU audit chapter. Their in-depth discussion will be there on performance audit. Okay, next, audit of government receipts. What is the objective of audit of government receipts? Ensure that there is no leakage of revenue due to government, focusing on general, it mainly focus on general revenue collection with the specific checks on how assessment is happening, collection is happening and refunds are happening. What aspects we cover? Assessment and realization. Verify correct revenue assessed and crediting. Rules. Ensure effective systems for collection. Identify irregularities like frauds, double refunds. Implementation. Confirms proper execution. Review. Also no, some income tax department assessment orders will be there. Review assessment orders for effectiveness in tax assessments. Extent of checking determined by C&AG involves test check and sampling mechanism. It includes audits by auditor, supervisor checks and group leader will be oversighting it. And planning and monitoring managed at middle and top audit level, central and local audit conducted at central level and local, the departmental level. Next, audit of stores and inventory. The objective is ensuring that purchases are sanctioned, made economically and according to the rules. This is part of audit of stores, is a part of expenditure audit. Now, what aspects I will cover? Regulations for purchases, custody and management of the stores. See that reasonable pricing, match contract quantity. Economical purchases, identify uneconomical, huge quantity purchased, losses like that. Accuracy, whether receipts, issues, balances are they maintained correctly. Idle or excess inventory. Valuation, physical accounts tally with value. Next, concept of commercial accounts. You know, government entities are multiple types, like the departmental enterprises, like, you know, commercial operations, you know, department regulations, post office, Indian Railways, these are all departments. Statutory corporations like LIC, GIC, government companies like BHEL, HPCL, BPCL, these are all various types of departmental entities. And maintenance of accounts are based on commercial basis for the following types. Departmental entities, no, they are audited just like any other department, government department. Directly C&AG will audit. Statutory corporation, audit nature depends upon the statute. C&AG may conduct financial audit or compile accounts also for them if at all required. Government companies, it is governed by Companies Act. C&AG will conduct supplementary test audit, performance appraisal, issues directions, audit board mechanism for performance reviews. Now, role of C&AG in government, in government companies, they appoint the first auditor and they appoint the subsequent auditor. They direct the auditor on manner of audit. These auditors submit a report of copy to audit report to C&AG. C&AG has a right to conduct supplementary audit within 60 days of receiving the request. The supplementary audit can be performed by the same stat auditor. C&AG comments sent to C&AG, whatever on audit, supplementary audit, no, C&AG will give comments. That comments will also be sent to members and they will be presented at AGM. It is an extension of original audit. C&AG has another power called test audit if necessary, conducted by C&AG directly. Like this, statutory auditor by qualified CS plus supplementary and test audit by C&AG. In this way, there is a 2-layer audit system. Next, you know, C&AG, you know, they will combine government and commercial audit principles and focus on autonomy, accountability, and focus on 3 E's. These are the standards that they will follow when they are doing audit, test audit, performance audit, all this. And finally, reporting procedure under government audit. You know, any audit effectiveness depends upon reporting findings to proper officers. Rights and obligations. C&AG's right is inherent and safeguarded by Constitution. Reports are submitted to President or Governor as per Article 151. And the reports will be published in C&AG site also. In our audit EO class, I showed C&AG site, all that. And factual reporting will be done. Conclusions will be left to the users so that total objectivity is maintained. C&AG reporting is always factual in nature, generally. That's it. So with this, government audit concept is also completed. Exactly 10 minutes it took. Then audit of local bodies. This is also something like government audit only. Okay. Or else I'll do a separate, I'll just save this and then separately do remaining rest all. Yes, let's continue the discussion on different types of entities revision. We already completed societies audit and government audit. Now we are having few other pending topics discussion, which are all quite easy. Now let's begin first the discussion of local body discussion. You know, what is a local body? It's a unit of local self-government. Generally, we find it in urban areas. Okay? But here the context of local body discussion is in all angles, urban, everything. So local self-government, local body is nothing but local self-government, where administration is by some representative body where they have some autonomy, where they raise revenue via local taxation for local services. Typically, municipal corporation, municipal councils, notified area committees, these are all popular local bodies. They do regulation, they do maintenance of the city and all that particular towns and developmental activities. General administrative expenditure, public health and safety expenditure, education and public works. These are the broad expenditures of a particular local body, and their revenue are property taxes, octroi and other taxes, and specially government grants. They get from state government some grants. Sometimes central government also will give a grant to a particular local authority. Next, what is the financial administration of a local body? First, they will have something called budgetary procedure. Okay, so in exam this itself can be asked as a question. Now, budgetary procedure ensures financial accountability and expenditure control. Funds raised or spent as per the rules and authorizations made for that particular local body. Budget determines taxation or expenditure. There is no strict revenue or capital split like in local body expenditure. There is no capital expenditure, revenue expenditure. That kind of split won't be there. Okay, special funds and budgets will be there for various projects. And expenditure, the way expenditure is controlled in local body is different from the state government and central government. External audit by state government is the main instrument. Like how local body expenditure is being controlled by monitoring through the audits by state government. State government directly do the audit. That itself is one of the major control mechanism. And the accounting system is often complicated, inadequate or excessive information, not supportive of management information systems. Like local body accounting system is a bit complex. Next, objectives of local body audit. These are the objectives: fairness of financial statements, assessing financial controls, ensure compliance with requirements, verify value for money, detect errors and frauds. You see, totally 5 objectives were there. And even when you're doing audit of local body, the auditor has to report on the same. The auditor also has to report on the same. Like, what are the auditor's concern? Exam, they'll ask you what auditor has to report on, or what auditor's concerns in case of local body audit. Same, fairness in financial statements, controls, compliances, value for money spent or not, and fraud detection. The same objective, verify value for money, nothing but propriety concept. So the same objectives are the concerns of the auditor. On the same thing only auditor will be reporting. Next, so state government will do control via appointing the auditor. Some large corporations, they appoint the auditor on their own. For example, Mumbai Municipal Corporation, they have their own auditors appointment powers. Then what is the audit program? Audit is a financial control. Internal audit, it is conducted by own staff continuously. External auditors rely on internal audit reports also, and they use it. They conduct a detailed checking if at all internal audit is not existing, and they focus on efficiency, economy and effectiveness, and also proprietary elements. Next, audit program. Okay, audit is being conducted by local fund audit wing or some external auditor who is appointed. Ensure expenditure is conforming to laws. Ensure that it is authorized. Ensure that a proper provisioning happened. Assess performance of the scheme for knowing their results, how they are effective, and economy, how the project has been performed. These are the audit program, and these are the points which are covered in audit program. So this is nothing but local body audit. So we have completed totally 3 parts in this. So one is government audit, society audit, and local body audit. Now audit of NGO. See, NGOs are nothing but what? Mainly these are all non-profit organizations which raise funds from donors, members, contributors for social objective. Legally, NGOs will be incorporated like societies, trusts, Section 8 companies. There will also be some registration requirements under income tax law, Foreign Regulation Act for foreign donations especially, and like religious organization, charitable trusts like CRI, UNICEF, all that. And is NGO registration mandatory? Generally not required. However, if at all that a particular society is having immovable property worth more than 100, this is as per trust act long back, okay, that compulsorily has to register. And Section 8 companies, they all have to maintain on accrual. Others, they can maintain on accrual or cash basis. Next, what are various sources of funds? There are 2 sources, main sources: grants, donation, fundraising, fees, subscription, gifts, all this. Sale of some books, stuff, all that. Social objective. Application: establishment cost, office and administrative expenditure, maintenance expenditure, programs expenditure, and this NGO will give donation to some other NGOs. Charities and donations by the NGO. Then promoters contribution. Promoters contribution is one of the major source of grant for local NGOs. Like capital receipts includes corpus contribution, revolving fund. Okay, like capital fund means this is for a specific purpose. Revolving fund means this can be used for day-to-day running purposes. Donations and grants received to acquire a specific asset, and sometimes NGOs also receive something called non-monetary donation like assets, all that. Audit of NGO. Appointment obviously by the management, but in case of Section 8 company, at AGM members will appoint. Statute requirements: under Companies Act it is compulsory. Okay, under income tax also a society has to, a charitable institute has to get their books of accounts audited to get exemption under income tax. Then audit reports for specific statutes. FCRA mandates specific format of audit report which has to be filed with the ministry within 60 days of financial year close by May 30. And audit planning and consideration: when you're doing audit of local body, what point you should consider while planning the audit? This itself can be asked. Understand the mission and operations of the of the NGO. Look at the statutory updates. Legally review the MOA, AOA, policies and guidelines, accounting systems, materiality, reporting plan, experts, and prior audit reviews, all this you should consider when you are planning the audit of an NGO. Next, audit program of an NGO. See, audit program is different, planning is different. Program means what are all you need to verify. You need to verify all assets, liabilities, income, expenditure are properly, verified or not. They are key checks. Corpus funds, donor letters, investments you see. Earmarked funds, donor and scheme rules you check. Fixed assets, see how when they were acquired, depreciation, title, ownership. Investments, are they maintaining registers and have they been approved or not. Cash in hand, if possible do a physical verification. Bank balance, reconciliation, inventory, program and project expenditure, establishment expenditure. Audit of receipts, verify contributions or grants. Internal controls, membership fee, are they maintaining registers or not. Subscription, registers check and reconcile with the counterfoils. Interest or dividend, look at the investments register and see whether corresponding interest and dividend is recognized correctly or not. Clear? The entire that how big that NGO we simply gave without missing that essence of the understanding. Next, actually I've seen yesterday I've seen certain charts which are circulating, like I just want to go through once. Till now I have not seen. Then I saw the charts, they were completely like misguiding. It's completely missing the matter. Like if you read the chart, there is no purpose. You remember only headings, you don't remember matter. In exam, for matter is what the marks is. Yes or no? For matter, all the key points, everything. Headings, if you write, you won't get marks. First of all, in IC book, headings won't be there. Only we give headings. So in the suggested answer, paper validation, they don't know whether it's a heading or not. I saw I saw some 100 pages chart, 120 pages chart. Everywhere headings are missing. They focus on how to remember mnemonic codes, all that. But it's not possible, right? Like 99% of the students, mnemonic codes won't work. Still, that's a trend. They give some keyword and then mnemonics will be there. Like many feel that if I remember that code, I'll remember the provision. They will remember, but some other abbreviation they'll remember, not the actual one. And they give so much of time to these abbreviations, so much of time, where they forget the main theme of the the concept. They only remember the headings and side headings, and they don't know what to write in the. The only way to write this entire answer properly is multiple revision. 3 revisions, maximum 3 revisions. One time when you're watching the class, that's once, that's first preparation. Watching the class is preparation. Then 3 revisions if at all possible. First one should be extreme qualitative. The first revision takes at least 40 to 50 hours of time. CA inter audit, I'm telling 40 to 50 hours of time. Second and third revision, second revision takes some 25-30 hours. Third revision takes only 10 hours, 10 to 15 hours. Again, day before exam, you revise. And if somebody who followed this particular pattern, they obviously can get exemption. Almost many students with whom I interacted, where they scored exemption 70 plus, 80 plus and all. This is what the formula they followed. You get more command the more you revise. Some students know what they say, they say like, sir, I literally revised audit subject 25 times. Like I'm writing from past 10 items. Every attempt I'll revise 2 to 3 times. So totally 25 times. So how many revisions is not dependent upon from the date when you started studying CA Inter. It depends upon for that attempt how many you did. Because every attempt is a fresh for you. You will forget everything. Maybe you remember little conceptually, but you forget everything. Every attempt is a fresh attempt, according to me. So for that attempt, how much effort you put, that is only decided. It only decides. So 3 revisions you have, preferably, if possible. You need to find time. There is no other option. You have to find time. Next. Then, can I? Yes. Then audit of sole trader. Sole trader means what? First of all, a sole proprietor concern is not required to get their books of accounts audited. But often we go for audit. Why? Because of bank requirements or some other requirements. Appointment. Proprietor himself appoint. And incoming auditor must communicate with previous auditor. Here also, if at all sole proprietor already has a previous auditor, it is better you communicate. Yes or no? It is better you communicate. Next. Scope and conditions determined by proprietor, because what is the terms of engagement are mainly decided by proprietor. Full or partial audit he may do. He will exclude certain points. Responsibility for financial statements also might be given to auditor. But if at all sole proprietor is asking us to prepare financial statements and also do audit, different partners have to do that, just to avoid self-review threat. See, it's a matter of contract. It's not any legal one. It's a non-statutory work, so you can do that. Next. Yes. Contract of appointment. Obviously, the appointment must be in writing, which should define scope, limitations. If not, auditor should send an engagement letter to the client and get a confirmation. And the advantages are something similar to partnership form. Now we will discuss about partnership form, all that. Before partnership, now first I will discuss LLP, which is most important. Okay, LLP. LLPs are governed by LLP Act. You know, they will have a both features of a company and partners. Minimum 2 partners are required, where the minimum 2 partners should be designated partners. And small LLPs, where contribution, capital contribution is not exceeding 25 lakhs aggregate, or turnover is not exceeding 40 lakhs. Yes or no? If any of this is crossing, then that is not a small LLP. See, actually small LLP, the wordings are not there. We gave it as small LLP. Are you getting it? So you know what? The small LLPs, no, they are exempted from audits. If capital contribution is less than 25 lakhs and turnover is also less than or equal to 40 lakhs, then that LLP is exempted from audit. If any of this is breached, then that LLP is liable for audit for that year. Understood? Next, audit requirement. LLPs with turnover or capital contribution exception exempted. Generally, audit is mandatory for LLPs, but exception when turnover is not exceeding 40 lakhs or capital and actually you see here, no, you need to interpret as and nothing but. Okay, and the capital contribution is also less than or equal to 25 lakhs. Getting it? Then audit is not audit is exempted. Partners may voluntarily decide to audit. 1 minute, just let me have. I think both the conditions have to be satisfied. I guess so. It's not just one. I think it's both the conditions have to be satisfied. Just why? Let just 1 minute. We'll cross check. Yes, we'll see here once. The accounts of every LLP shall be audited in accordance with the rules. That is the main provision. Exception provided that an LLP whose turnover does not exceed 40 lakhs or whose contribution does not exceed 25 lakhs shall not be required to get its audited. Indirectly, if both are not satisfied, only audit is mandatory. Audit is mandatory when, for example, audit is mandatory when if turnover is crossing 40 lakhs and contribution is also crossing 25 lakhs, audit is mandatory. Yes or no? If any one of this is not crossing, audit is not mandatory. Indirectly, that's how it is coming meaning. Yes or no? Because they have used the word or. So LLP, it does not, provided that LLP whose turnover does not exceed in any year 40 lakhs. Suppose my LLP turnover is less than 40 lakhs, or my contribution is also less than 25 lakhs. If both of these criteria are satisfied, I don't have to go for audit. Yes or no? If any one of this is exceeding, automatically the exception does not apply. So naturally audit is applicable. So in exception, any one criteria if you satisfy, any one criteria if you fail, automatically audit becomes applicable. So here, though it is or, you need to interpret it as and. That's it. Fine. This is not a big deal basically. Okay. Next, returns to be maintained. What they need to maintain returns? They need to file ROC within 60 days from the end of the financial year, an annual return. And they should also file a statement of accounts and solvency, which is to be submitted 30 days from the end of the 6 months of the period. This is nothing but, suppose if your financial year is 24-25, okay, 6 months means, for 6 months from the end means what? 30th September 2025. From there, 30 days time, nothing but 30th October 2025. Very simple. After March, next October 30. That's the due date. Okay, yes, after March, next 30th October, that's it. Then books of accounts, they must maintain all the records of money received and spent, assets and liabilities, all that. Authority, who will appoint the auditor? DP, designated partner, appoint the auditor. If at all designated partner fails, other designated partner, if at all fails, other partners will appoint. Time limit, first auditor shall be appointed within 1 month of the registration. Subsequent auditor will be appointed 30 days. Subsequent auditor will be appointed 30 days prior. Yes or no? Prior to year end. Nothing but I told you, February end in our class also. Advantages. Refer advantages of partnership form, we'll see there. Above partnership form audit is reporting. Auditor must report on correctness and reliability of record, information and explanation obtained or not from the partners. Are there any restrictions imposed on the auditor? These are the 3 points which specifically the auditor has to report on. Next, auditor's duty, obtain written instructions like through engagement letter, refer to minutes book, refer LLP agreement for understanding business nature, capital how much, interest how much, drawings how much, salaries how much, borrowing powers how much, partner rates how much, settlement methods. Understood? Next, special points in an audit of LLP. Appointment letter must be signed by a normal partnership firm. Appointment letter must be signed by authorized person. You need to read the review to know the policy decisions. Look at any partner interest in some other companies, all that. Partnership deed, see that it is signed by all the partners and review details. And business authorization, ensure activities are aligning with the partnership agreement. Confirm division according to the agreed ratio, whether partners are distributing profit or loss as per agreed ratio. See whether books of accounts are reliable. See whether provisions of tax have been complied. And matters to be considered before audit, same like LLP, these points. Advantages, the partnership audit advantages, LLP audit advantage, sole proprietary audit advantage, partnership, it will help us to settle legal disputes. It is reliable especially for dissolution, retirement and death of the partner, settlements. Audit accounts are trusted by banks for loans. It is useful for negotiation at the time of admission of a new partner. It also, audit helps, it's a safeguard against sleeping partners undue, so that working partners don't take undue advantage of non-working partners, yes or no? Especially for inactive partners, it's a safeguard. That's it. So this is audit of LLP and partnership firm, understood? Then audit of charitable institutions. First, understand how it is constituted, society, a trust, a company. Verify compliance with law. Legacies and donation, verify papers, minute books, all that. Rents, verify amounts due, all that. Then subscriptions, so charitable societies receive subscriptions and donation, check receipt books and what are the controls over unused books. Agree collections with records, acknowledgements will be there, cash books will be there, all that. Examine controls on collections, ascertain changes in subscription amounts. Like general, this charitable institute will run certain services like yoga classes, like that. So for that people will subscribe. So there will be a changes in subscription amount, changes, all that. That's what. Next, investment income, ideal money they will be investing. So verify whether dividend or interest with counterfolios. Look at investment schedules, physically inspect securities, investigate non-income generating items. Check dividend receipt for, is it ex dividend or cum dividend, depending upon that. Special features, vouch gross receipt expenses, verify ticket proceeds. See whether any tax refund is there. Expenditure, grant payments, ensure for charitable purpose or within the objective, verify no trustee, director or member is benefited from the grants given by the institution to somebody else. Verify securities or inventories through inspection, physical verification. Check cash and bank balances. Confirm funds for special purposes are utilized appropriately. Then audit of education institutions. In this, the most important thing is directly audit of fees received from the student. Only this one. You don't have to touch any other one because remaining all are same. Remaining all are same. Expenditure part we will see, and audit of fees received from students. How to audit fees received? Verify students' fee register with class register. Match receipts with cash book. Confirm that all the fees collected from student is accounted for. Check fee carry forward. Sometimes students will pay fees for 2-3 years together. The arrears are written off. Check admission fees credited to capital fund. Confirm authorized free studentships or concession. Ensure internal checks for demand. Verify fines levied. Check hostel dues recovery. Report old heavy arrears and ensure that caution money shown as liabilities. Easy. Next, expenditure. Verify all expenditure is sanctioned properly by a proper committee or not. Check establishment expenses. Verify salary increases, are they sanctioned and documented any decisions. Ensure proper authorization for bills and all. Then patients, hospital audit of patients, register of patients. Verify with bills. Check bills with attendance. Ensure all patients are billed properly. Yes or no? See the cash collections with receipts, bills, counterfoils. And here there are no other. Internal check. Review checks for stores, medicine, linen, instrument. Ensure that all these purchases and issues are authorized. Rest all other points are common everywhere. Audit of a club. Club, no, they will have entrance fee. Verify receipts with applications, counterfoils. Vouch with counterfoil subscriptions. Register of members will be there. Reconcile total due and how much is collected and how much is outstanding. Suppose if any arrears are there, confirm whether they can be carried forwarded. Verify current arrears and advances. Check register of members for arithmetical accuracy. Irrecoverable member dues. Identify arrears. Confirm recovery effort. Report irrecoverable amount through audit report. And see how much they are charging for foodstuff, drink and services to the members. And for non-members, we generally charge higher amount. Yes or no? Member account. Trace debits from subsidiary registers to confirm amounts are recoverable. Generally, whenever we serve any food to the member in a club, we will debit to his account. Means club has to receive it. Next. Margins. Vouch purchase of food drink items, test sales price for normal gross profit, physically verify unsold stores and all that. Management powers, examine secretary financial powers, report excess if at all, report to the committee if any excess power utilization is there, fraud or any error is there. Then audit of cinema, audit of receipts from show collections, only this part is important. Verify that entrance to the cinema hall is only through printed tickets. See the tickets are serially numbered. See that they are bounded into books. Different series were there for different shows in class. Advance bookings and all, you need to pay special attention. Proper ticket of inventory, proper inventory of ticket booklets maintained or not, olden as this is. Okay. Audit computerized ticketing system for reliability. If at all the cinema theater is issuing through computers, see the system reliability. Ensure proper show statements and cash is tallied. Vouch cash book with statements. See that the cash is deposited in the bank on the next day. Ensure free passes are authorized or not. See how much entertainment tax paid and how much is the amount collected. Both are percentage apply on the amount collected and see entertainment tax paid correctly or not. That's it. Then expenditure, especially in this, examine unadjusted advances to distributors. So movie theater, when they take a film, they pay advance and then get the film rights. Okay, and once film is over, they will get back some advance, some portion of advance. Okay, next, vouch film hire payments with the distributors. Confirm depreciation on machinery and furniture is higher than usual rates. So no. Then verify advertisement, repairs and maintenance expenditure. Verify electricity and see is there, calculate provision for irrecoverable advances. If the movie fails, distributor sometimes may not refund the excess money which the theater owner deposited. That one. Next, restaurant income, that is one more special income. Yes or no? Verify charges collected, advertisement slides and advertisement. This is advertisement. Restaurant, inquire arrangement for share of restaurant income. Check accounts if restaurant is run by the cinema theater itself. Audit is like similar to audit of clubs where food and beverages is audit is done. Verify other incomes like parking, display windows, all that. That's it. Audit of hire purchase company. Hire purchase means what? Agreement to hire goods with an option to purchase. Possession delivered, payment in installment, ownership pass on final installment. Hirer can terminate anytime before the ownership. Now audit procedure, ensure that the agreement is in writing. Mainly you need to verify agreement details like what is the hire purchase price, what is the cash price, when it will start, what is the installment, so no, how many number of installments, amounts, due date, where is the payee, where is the location of the asset, description of the asset. Then ensure that installments are being recovered regularly. That's it. Next, audit of leasing entities. We know there are multiple types of lease. Finance lease where substantial risk and reward will be transferred. Ownership transfer, purchase option at low price. Lease term covers major part of the life. And present value of payments is approximation of fair, that itself is fair value. It's approximately fair value. Accounting, it is treated like a loan. Asset is on the lessee's balance sheet. Lessee can claim interest and depreciation deduction. Yes or no? Operating, where it does not transfer substantial risks and rewards. So finance lease process, lessee, he will first decide what is the SS. Then lessor orders the asset. Yes, agreement is signed. Lessee pays the rentals or maintains the asset. End of the lease, asset is returned or purchase option will be there or renewal will be there. That is called open-ended lease. Next, auditors, verify object clause of the leasing company. SS, lessee's credit worthiness. Examine lease agreement details like who are the parties, what is the equipment, location where, tenure of the lease, payments, late charges, return clause, subletting is prohibition. Generally in most of the leases, when we lease, subletting is prohibited. Sometimes it is explicitly permitted. Review, review proposal, retain invoice. Review proposal means nothing but lessee will propose the form. Review proposal form we call it as. Review proposal form of the lease proposal form. Check board resolution, confirm insurance copies. Next, audit of hotels. In audit of hotels, room sales and collections. Verify room charges with the guest register. Reconcile sales with the bills. Verify crediting customer bills correctly. Ensure timely payment or billing. Verify restaurant bills. Compare occupancy rates. Analytical procedure. This is nothing but analytical procedure. Check compliance with statutory or foreign exchange regulations. Next, internal control. Ensure proper control is there on cash receipts or disbursements, purchases or stocking, customer billing, recording or custody of edibles. And sometimes they will get income from travel agents. Ensure it is recovered. Verify commission payments. Inventory. ensure proper documentation or transfer, and ensure that they are in the locked areas. Verify physical, do physical inventory verification, verify control over consumables and assets. Hotels will also have some receipts from function halls. Verify special receipts from auditorium, banquet halls and shops. Then that's it, no special points. Then here there is something called audit of trust and society. This point is irrelevant because trust means you write charitable trust answer. Societies means that answer only, charitable institution answers. Here specifically once again they give which is not relevant. Generally for trust and societies, how to do audit, that's what they covered here. That's it. With this, entire different types of entities is completed. Okay, almost we spent close to 1 hour on this chapter. Yes, let's continue the discussion of the new chapter. Next one, the last one, items of financial statements. Again, this chapter weightage is approximately 12 to 16 marks. Okay, minimum 12, 16 is the maximum weightage. MCQs can come or descriptive, anything can come. Now, in this, the first thing that we need to understand is assertions concept. And the assertions concept we already saw in our audit evidence revision. Concept of assertion, explicit assertion, implied assertions, all that, key assertions, like all that we have understood. The assertions mainly talk about various things like completeness. Completeness assertion means it mainly talks about whether all transaction balances are recorded. Cutoff, whether they are recorded in the correct accounting period. Cutoff is always talks about the right accounting period. Then valuation or measurement. Assets and liabilities and transactions must be properly valued. For assets and liabilities it's a valuation, for transactions it's a measurement. Rights and obligation. Entity owns or controls the asset, and then liability is an obligation for them. And see that financial statements are appropriately presented and disclosing. The auditor has to verify all these assertions which are made by management and has to get has to obtain sufficient appropriate for each assertion in respect of balances, transactions and disclosures. Now generally for income statement, nothing but P&L account related, what assertions we mainly check? We check mainly occurrence, completeness, cutoff and measurement. For P&L items we mainly check this. Occurrence, transactions recognized in financials, are they occurred and relating to entity? Occurrence assertion is mainly for overstatement. Overstatement means what, already recorded item, is it occurred or not? For example, employee benefit expenses incurred during the period for personnel employed by the entity or not, and is it excluding other unauthorized personnel? Is it authorized personnel or not? Is it existing or not? Genuine or not? Occurrence assertion. Sales, whatever the sales you mentioned, are they really dispatched? Are they really ordered? Are they really dispatched? Are they really invoiced? Check out. Then completeness, see that all transactions that should have been recorded are recognized in financial statements. For example, employee benefit expenses has to be accounted for all employees. Completeness assertion is to check understatement. Completeness assertion is to check understatement. See that all genuine sales are recorded. Then cutoff, it is all about correct accounting period. In cutoff, no, it's not about overstatement or understatement. It's about the right accounting period. Yes or no? See that employee benefit expense recorded is only for the current year related. And sales from past or future sales excluded. Only current period sales are included. Accounts has to be properly adjusted for items belonging to the relevant period. Then measurement, this is at what value recording. Measurement talks about the value. Transactions recorded accurately in the financials with a proper documentation and posting. For example, employee benefit expense measured correctly, tax reductions, provident fund deductions, everything is correctly done, and sales reflect correct invoice amount excluding discounts, all that. Next. Same way, balance sheet also has certain captions. In balance sheet, these assertions we mainly focus on. Existence, completeness, cutoff, valuation, rights and obligation, presentation and disclosure. Existence, what we confirm, existence means what? We want to know whether asset is existing, liability is existing or not. For example, inventory, physical verification, we will get existence. Loan, document you verify, loan document. Completeness, see that all balances are recorded without omission. For example, all inventory owned, even if it is held with third party, shall be recorded, and excludes consigned goods. See that our consigned goods which are there in our warehouse, which are not belonging to us, they were excluded. Third party inventories included in inventory counting, all that cut off. And see that transactions are recorded in correct accounting period. Year end inventory excludes next year items but include all current year items regardless of location. For example, we purchased goods on 31st March but not yet received the delivery. Okay, then it must not be recorded in our current year inventory. It should be recorded as amount paid to vendor. as an advance. Next, valuation. Balances has to be valued properly so that misstatements will be avoided to a great extent. Inventory valued at lower of cost or NRV, excluding unrelated cost, abnormal cost, using consistent methods of valuation. Rights. Entity holds legal right to the assets. For example, inventory ownership is verified via invoices, and when you are verifying ownership, no, consigned goods has to be excluded because you are not the owner for that. Next, presentation. See that they are properly classified, described and disclosed as per applicable financial reporting framework. For example, inventory has to be classified into raw material, finished goods and work in progress, and transit details has to be separately disclosed, valuation method has to be separately disclosed, and entire presentation and disclosure is based on applicable financial reporting framework. Clear? See, items of financials, I'm giving little explanation, clear explanation, so that because I have not done a separate revision for the same. Even different types of entities also I give explanation similar. Next, now let us understand each and every item. Balance sheet items. Okay, first let us do a verification of balance sheet items inside the share capital. How do you verify existence of share capital? First, verify authorized capital how much, issued capital how much, paid up how much, compare with the previous year. Get a written representation that there are no changes occurred. If at all there are no changes, suppose last year and current year equity balance remains same, no changes, share capital no change, get a representation that there are no changes, and ensure paid up capital does not exceed authorized capital by reviewing memorandum of association. Next, completeness of equity balances. Like same again here also, completeness. Get a certified resolution for changes in capital. For example, whenever there is a change in capital, no, if at all there is an increase in capital, how much exactly increased, how many shares were issued. Okay, check compliance with Companies Act provision for fresh issues, whether return of allotment is filed, minimum subscription received or not, bank account maintenance, all that. And see that shares issue, see that company is not issuing shares at discount except for sweat equity shares. And next, verify consideration type. Is it a cash allotment or non-cash shares? Okay, and SEBI compliance, and check filings with MCA. In actual printed book, it accidentally printed as MOA. It's actually MCA. Okay, and confirm stamp duty calculations, all that for share capital increase. Completeness verification. Valuation. Shares issued at premium, the premium amount must be transferred to securities premium, and it has to be used only for few purposes like bonus shares, preliminary expenses, buybacks. Yes or no? Then shares issued at discount, it is prohibited except for sweat equity or debt restructuring. Next, reduction in capital. And see that if there is a reduction in capital, special resolution is passed, AOA authorization, no deposit defaults, only then a reduction of capital is permitted. Correct? Check tribunal orders, filings with ROC, and accounting entries in the books of accounts correct or not. Confirm schedule 3 disclosures on reduction of capital and tribunal conditions satisfied or not. Yes or no? And remember, buyback is different from reduction of capital. Buyback is not different from reduction. Yes or no? And in case of buyback, comply with section relevant provisions of buyback. Next, disclosure. Share capital. For each class of shares, you should disclose authorized issue, subscribe, fully paid up, par value, all that. Rights, preference shares, all that. Shares held by holding subsidiary companies, yes or no, or promoters. Actually, it is more than 5%. No, it's more than 5%. 35. I think it's printed book. It's wrongly given. Sorry, 35. It's more than 5%. And reserved shares. Okay, so yeah, that's it. Next, disclosure of capital. 5 years history you need to disclose. What you need to disclose? Fully paid shares without cash, like bonus shares and buybacks. So what are the shares allotted for non-cash consideration in the past 5 years? Okay, that buyback details in the past 5 years, bonus shares in the past 5 years. These 3 details has to be given every year. Convertible securities, what are they? Unpaid calls are they? Forfeited shares details. Promoter shareholding, details of shares held by promoters, percentage change has to be computed yearly. And unissued proceeds, unused proceeds, if at all you issued capital and raised money, unused, disclose utilization or what you did exactly with the unspent amount. Next, there are some additional regulatory information. This is regarding funding party intermediaries, all that. For example, dates, amounts loaned or invested in intermediaries. Suppose you are a funding party, how much amount you transfer to intermediaries, date, loan, how much. Suppose you acted as intermediary, details of further investments guarantees by intermediaries. Nothing but if at all you are acting as an intermediary and you received some money from funding party, you need to give details of funding party, all that. Compliance declarations under FEMA. Funds received from funding parties. Okay. Actually here, I think okay. We have given separate discussion, so no need to misinterpret here. I think Suppose loans given to intermediaries. Okay, dates, amount loaned or how much is invested in intermediary, and details of further investments or guarantees by intermediary, nothing but beneficiary details. Okay, then if at all you are acting as an intermediary, dates and amount received from funding parties, details of further investments, guarantees on behalf of beneficiaries, okay, and compliance declarations. But for these two, no, I recommend you to read our GOAT notes, which is more clear. Okay, no matter however the shortcut form we give, it won't give a proper meaning. Better you refer GOAT notes. We clearly mention the disclosures. So if at all the company acted as a funding party, what disclosures? If at all the company acted as an intermediary, what disclosures? So no. Next, then audit of reserves and surplus. Audit of reserves and surplus. Reserves are nothing but amounts which are appropriated out of profit, which are not for the purpose of meeting any liability. Yes or no? It includes, reserves. Reserves are for what? For future liabilities, maybe contingencies, commitments, diminution, all that. It is not for present liabilities. It is always for future purpose. Yes or no? Next, purpose of reserves. Internal financing. Yes or no? Revenue reserve. This is available for distribution, like supplementing profits in linears, financing business expansion, working capital strengthening. Capital reserves, they are generally not available for distribution. They are used for limited purposes, like securities premium, capital redemption reserve. These are all examples of capital reserves. Yes or no? Next, revenue reserve, treatment as capital. If revenue profit for asset replacement reserves or for capital purpose, then it is treated as capital reserve. Utilization of capital reserve, writing down fictitious assets or losses, issuing bonuses if at all permitted by articles. Then specific restriction, securities premium and CRR can only be utilized for purposes specified under the Act. Then audit procedure, existence, verify opening balance with the previous year's audited statement, check current year additions and utilizations. Yes or no? Second one, trace surplus or deficit movement in P&L, verify changes in statement of equity, check board approvals if in case dividends are declared. See accounting standard for dividend recognition, verify securities premium transaction and board resolution, ensure section 52 for premium utilization. Classification, disclosure, classify reserves as below: capital reserve, redemption reserve, securities premium, show allocation of surplus, display additions and deductions. Earmarked investments. If at all you keep a reserve and you invested somewhere, though, it will be shown as a fund. Negative P&L will be shown still in the surplus. Negative shown will be netted off in the balance sheet equity side only. Yes or no? Then audit of borrowings. Here only one major mistake happened. Okay, so here this entire segment we gave. Those of you who are getting printed copy, you will be getting a paper also extra. Same 121 page. Okay, here by mistake reserve matter got pasted. One mistake happened. That's because of when we are saving in my system, it got saved. When they open for PDF generating and sending for printing, there it was not saved. We assume that I verified and saved. But there it was not saved. So what happened is they gave that print and we confidently said everything is verified. So that printing mistake happened there. Generally what happens is we copy previous matter into current matter and update the changes here. That we did one system. In another system it was not updated. Okay, we thoroughly read in the system. Since proofreading is done, I gave approval. Then they generated PDF in another system. Okay, you understood a syncing sometimes misplaces. Suppose you can have Google account at multiple places. You update here. In other place you need to refresh first in order to update this. Wherever you log in, for example, then only the change will reflect. So that reason happened. So it is purely a clerical mistake. That's why whenever we have seen all the entire chapters, hardly we noticed any mistake. In 530 sampling, small mistake is there. Okay, factors for sample design, that question there, that particular concept, one mistake is there. Here one more mistake, that's it. And apart from that, there are 3 or 4 places minor mistakes which are clerical in nature. That's not a big deal at all. Okay, so less than 5 mistakes, honestly speaking. Next, borrowings. This is updated PDF, guys. So whoever is having hard copy, kindly use this. Okay, replace this matter. Or we already sent you a page. Whoever have ordered physical copy of chart book, we already sent it. Now, existence. How do you verify borrowings are existing? Look at board meeting minutes. Loan agreements you check. Get balance confirmation. In case of loans, borrowings, lease agreements, they also, high finance lease is shown as borrowing. Look at lease agreements. See the debenture trusted in case of debentures. If any borrowing is repaid, get a discharge certificate and get management representation. Completeness. Get a schedule of all the borrowings. Okay, trace it to general ledgers, subsequent events, review for any unrecorded liabilities, confirmations, get a confirmation from third party, obtain and follow up if at all they are not giving replies. Valuation, see that borrowings, everything is valued properly, interest amortization is correctly done, foreign currency loan, whether accounting standard 11 complied or not, classification has to be based on due dates. Yes or no? Classification, whether a borrowing is a long term or short term, current or non current, it depends upon from balance sheet date. If at all it's repayable within 12 months, it's a short term. No, it has to be shown as a current borrowing. And see compliance with provisions of Companies Act, and see AOA, MOA limits, and also see loan terms and conditions in order to properly value the borrowing. Next, disclosures, long term classification. You need to show them bonds how much, term loans how much, okay, deposits how much. What is this DBL? DPL and RPs. I think there's a shortcut which I used. Just can you see that once in the GOAT notes? Okay, fine. So see the classification. Okay, loans firm. Yeah. What the borrowings has to be given as a classification like this. Okay, how much in the form of bonds, how much in the form of term loans. Deferred payment liabilities. Here here please use it. Deferred payment liabilities. 99% in the chart notes. All the short forms you can understand. We used only at where students can understand. If at all you are unable to understand, just immediately open GOAT notes PDF. You will get it. And loans from related parties. Further, you need to give one more classification: secured how much, unsecured how much. You should also mention repayment terms. You should also mention default related items, and you should also mention redemption. For short term also same disclosures. And current maturities of long term borrowing. Current maturity means what? It's a long term borrowing, but from here it's within next 12 months it is due. So they're all called as current maturities of long term borrowings. It has to be disclosed separately within the current borrowings only. Next, disclose alternative use if at all you are borrowing for any particular purpose and use it for some other purpose. That details you need to give. Then other long-term liabilities, classify. Then apart from that, there is some additional regulatory information. For current assets, if at all any borrowing is there by current asset, you need to show whether quarterly statements filed with banks and financial institutions are matching with books of accounts. If not, reconciliation, and explain why there is a difference. Then, is the company declared as a willful defaulter? If so, date of declaration and details of defaults made. And a person or entity is categorized as willful defaulter by the bank or financial institution as per RBI guidelines. Next, registration of charge or satisfaction. Disclose details and reasons if charges or satisfaction are not registered with ROC within stipulated time. Then utilization of borrowed funds and share premium. Here we have given detailed. I told in equity disclosure, share capital disclosure, funding party, that disclosure. The same disclosure is there even for borrowings also. Because at the end of the day, borrowings, share capital, everything is a funds received by the company. What you are doing with these funds? Suppose the company have given funds to intermediaries. Date and amount of funds given in intermediaries with the details. Date and amount of further investments to ultimate beneficiaries. Like who are the ultimate beneficiaries, when and all they give. Date and amount of guarantees provided to ultimate beneficiaries. Declaration of compliance with FEMA. Suppose if your company acted as a funds received from funding party, you acted as an intermediary. Then details of funding party, details of beneficiaries, guarantees provided to beneficiaries, FEMA compliances. Suppose you are the funding party, then who are intermediaries, who are beneficiaries, and guarantees given and FEMA compliance. If I am the intermediary, who is funding party, who is beneficiary? Understood? Next, borrowings is over. Easy. Then trade receivable, audit of trade receivable. First, you need to test controls related to sales, because receivable is a byproduct of sale. Correct? Now, only bona fide sales must lead to trade receivable. Sale must be made to approved customers only. Sale must be properly recorded. Debtors must be settled by cash or approval. Segregation of duties must be there. Timely collection we need to check. Reminders for overdues. Regular balance review, follow-up system, and adequate provisioning after considering aging analysis. Yes or no? Post-control audit. Audit determines procedures for debtors balance verification, post-test of controls. These are all controls verification. Once controls are verified, then you will go for balance confirmation, direct confirmation, all that. Correct? So what is the audit procedure? Now, existence of trade receivable. First, ensure that there are no duplicate invoices. Okay, they are properly recorded in general ledger. Verify aging report. Check realizations. Investigate long overdue balances. Direct confirmation. For existence, best way is confirm directly with the customer. For significant balances 100%, for others random. Balance sheet date, year end or close to it. and auditor and company has to agree it. Form with the balance or without a balance. Like you will send a form where you will mention the balance, or you don't mention the balance and ask him directly to reply. Again, this format will be PCR and NCR. Anything it can be. Maintain control over request, independent handling of replies. Auditor has to maintain complete control. If at all there is if there are no confirmations, subsequent receipts you check, detailed transaction analysis you check, so that you will understand whether trade receivable is existing or not. Next, analytical. Further, for trade receivables, you can review sales receivable trends for unusual pattern, measure average collection period, calculate debtors turnover ratio, inquire if any changes are there, document the same. What are the analytical procedure for trade receivable? Like this, it can be asked. Remember, every of this, write about direct confirmation, that can be asked. Write about existence, this can be asked. What are the test of controls on trade receivables? They can ask. Anything they can ask in exam. Write about utilization of borrowed funds and securities premium, disclosure requirement as per schedule 3. They may ask you this. Write about disclosure requirement for willful defaulter, 3 marks question they can ask. Any of this they can ask. Write about completeness of borrowings. They may ask. They asked already. Write about valuation of borrowings. Anything they can ask. Getting it, everything. Just because I am highlighting at 1 or 2 places in the revision that this can be asked as a 4 marks question, that doesn't mean they are only important. Everything is important in this chapter. Then completeness. Completeness means talks about what mainly? See that all the debtors are included. All the debtors where dispatch happened, control risk and transferred within 31st March, it has to be recorded, cut off. Last few days invoices you take, see whether the goods are really dispatched or not. If at all goods are dispatched before year end, no, see that it is invoiced and included in debtors. Suppose if goods are dispatched at year end, no, after year end, no, it may be excluded from debtors as on 31st March. It should be recorded after 31st March. Match invoices to shipping. Test aging reports for identifying accuracy, all that. Review credit memos. Credit memos means what? Nothing but generally, if at all sales returns, all that. Okay. Examine bill and hold transactions for legitimacy. Check for unusual trends. Valuation. Review doubtful accounts for allowances, all that. See the method followed for create provision. Is the same method followed in the previous year or not? Get an aging report. Identify debtors under litigation. Evaluate provision requirement. See that provision is made at appropriate rate. See that bad debts written off. No, they are authorized and approved. Prepare schedules of movement of bad debts, all that, and compare it with the previous year. And see the writing of authority. Check who is writing off. Disclosure. Restate foreign currency receivable. Disclose related party transactions. Report 189 transactions in CARO, section 189. Related party transactions, nothing but. Then cash and cash equivalents. How do you verify existence of cash? Physical verification. Perform surprise cash check. Yes or no? Simultaneously verify all cash balances at cashier, petty cashier, impressed balances, everything at a time. Have multiple team members. All of you at a time, you go and verify physically. Ensure cashier signs the cash count with the denomination. Verify authorized and recorded slips for advances. If at all any cash is there, you know, where cashier says advance or some letter of undertaking, see letters for that. Analyze monthly cash trend. Investigate variation. Like in a particular month, why there is unusually high cash or why there is unusually low cash, like that. Next, value completeness. How do you know that all cash and bank balances are accounted correctly? Obtain BRS for all bank accounts. Verify preparations. Verify BRS details. This itself can be asked as a question. On verifying BRS details, what auditor has to pay attention on? Look at bank book match confirmations, checks issued but not presented, checks deposited but not credited, review unrecorded bank charges and credits, get a direct confirmation from the banks, agree book balances to statements. If any discrepancies, get an explanation. For non-replies, do alternative testing, go branch visit, bank visit, you go and get confirmation. Then disclosure. Classify balances with banks, checks on hand, cash on hand, and others. Separately disclose earmarked. Like for example, dividend kept in special bank account. Company control only, but it is for declaration purpose. These are all earmarked balances. State margin money, securities separately. If at all you kept any money in your demat account, margin money, it is there. So that shows separately. Mention repatriation restrictions. Disclose bank deposits with maturity more than 12 months separately. Next. Inventory. Audit of inventory. In inventory audit, no, we apply 501 procedures mostly. First, how do I know existence of inventory? I will see client count planning. I will participate in counting, and I will ensure that consigned goods are segregated because they are not to be considered. I will participate in test count, where I will observe how management is counting. Are they following management guidelines? Supervision, tagging, reconciling test counts with recorded inventory. conduct cutoff testing, exclude third party stock, and investigate physical versus records differences. See that records are maintained perpetual. If at all perpetual, you can count at any date, but if it is periodical inventory, you must count at year end compulsorily. If records are maintained on perpetual basis, you can do inventory counting on any day. If the records are maintained on periodical, you must know exactly how much inventory is there on 31st March. Next, completeness. Inventory, analytical procedures on inventory, only this itself can be asked as a 3 marks question. Compare with the industry budgets or trends, compute inventory turnover, vertical analysis you perform, compare budgets versus actuals, verify non-financial information, weights and all. Match shipping documents and receiving documents, verify arithmetical accuracy. Reconcile physical count with perpetual, reconcile inventory held with third parties, ensure that consigned goods are removed when you are accounting inventory completely. By rights and obligation, vouch purchases and supporting documents like invoices, purchase orders, review consignment or collateral agreements and purchase commitments, check invoices for ownership, get a third party confirmation if the inventory is lying with third party. Next, valuation, verify that proper methods are followed. Raw material, we generally include carriage inward, non-refundable duties. If standard costs are used, I will compare with actual cost. Work in progress, ascertain valuation basis and production stages and overhead allocation and exclude abnormal waste. Finished goods, verify reasonable costs are included, value at NRV. We simply apply AS2 principles here. Next, for obsolete damage or slow moving, no, we examine proper valuation and realizable value. We will also request for aging split. We will compare recorded versus actual. We calculate turnover ratio to identify obsolete item. We verify correct application of cost or NRV. In one of the examiners, this itself was asked as a 4 marks question for obsolete item, damaged item, slow moving goods. You know, what is the procedures auditor has to perform? Because they affect valuation very high. Disclosures, classify raw materials, work in progress, finished goods, stock in trade, stores, loose tools, others. Goods in transit has to be separately shown under each of the above head, and also mention mode of valuation. That's it, easy. Next, property, plant and equipment. You know, in property, plant and equipment, no, only most important, what are the elements of cost? What are the directly attributable cost? Which cost will be excluded from PPE? These 3 points were tested in exams. In audit exam only. What are the element of cost? Purchase price, directly attributable cost to bring the asset, and dismantling or removal or restoration cost. These are the costs which are included in valuation of PPE. Yes or no? Recognition time. Now, what are directly attributable cost? Give an example: employee benefit cost, site preparation cost, delivery cost, test run cost, professional fee. You know, in exam this itself can be asked. And what cost will be excluded from PPE? This also has given. New opening, like, you know, opening ceremony, that is not included. New product or service introduction, new location, administrative, advertisement cost, that and all will not be included in the PPE cost. Next, existence. How do I know whether existing or not? Physical verification, yes or no? Examine, supervision, evidence during the verification, get a PPE physical verification report and perform various procedures. SS tagging with IDs and capture in working papers. Reconcile physically verified PPE with fixed asset register. Verify discrepancies like shortage of assets, non-working assets, and see accounting treatment and management approval. Confirm additions or entity owned. Exclude third-party assets like leased assets, operating lease assets especially. Non-working assets, no, they will be accounted as deletion post-approval and depreciation ceases. This was asked as once MCQ. If an asset is not working, what is the proper option? Which of the following is a proper option? Proper option. It will be deleted from the records after approval. Further, the moment it is deleted from the fixed asset register, depreciation also ceases, stops there. Yes or no? Next, completeness. Both will happen. The moment asset is inactive, both will happen. Next, completeness. Verify PPE schedule movement. Opening balance, additions minus deletions is equal to closing balance. Check arithmetical accuracy. Additions, verify whether the cost is meeting AS10 definition or not. Deletions, understand why they deleted. Is it because of the old machinery, advanced technology, or damaged machinery? Verify management approval for deletion. Check the deletion process. Ensure accurate accounting of deletion for gain or loss. Next, valuation. Verify that depreciation is charged on all items except land. And what is the depreciation method? Is it reflecting the economic pattern expected? See that impairment is properly made. Rights, verify purchase invoice. Yes or no? Buildings, check ownership deeds. insist on verifying original title deeds for removable property. For pledged property, ask banker for giving a confirmation on holding of the title deeds. Review register of charges for charges on PPE. Next, disclosures. Comply with schedule 3, like classify categories, land, building, all the separate disclosures for leased assets, reconciliation of gross and net carrying value with additions, disposals, revaluation adjustments. Disclose reduced or increased figures for the first 5 years. Last 5 years revaluation details has to be given. Next, audit of intangibles, mostly same. Yes or no? Mostly same. So intangible is non-monetary and identifiable item, but no physical substance. This is for sure used for company's purposes, production, supply, sales, administrative, whatever. Examples: scientific, technical know-how, licenses, intellectual property, trademarks, softwares, patents, copyrights, goodwill. Goodwill is what? Acquired goodwill. Generally, internally self-generated goodwill may not be recognized, will not be recognized at all. Recognition, it must meet identifiability and economic benefits must be there. Internally generated goodwill will not recognize. Yes or no? Intangibles, sometimes they will exist on a physical media. For example, software. Cost of physical substance, if it is insignificant, then we will recognize it as intangible only. Yes or no? Some assets have both elements. So auditor has to judge whether it's a tangible or intangible. Software integral to hardware, treated as fixed asset. Software not integral, then treated as intangible. Audit procedures for intangible: confirm active use. For unused, ensure deletion and ceased amortization. Completeness, verify movement, opening, additions, deletions. Ensure AS26 is satisfied. No recognition if it is only in the research phase. Confirm approvals for additions or deletions. Valuation, check amortization, perform impairment assessment, all that. And rights, confirm legal ownership. Test completeness and ownership during verification. Disclosure, classify by category, provide reconciliation of gross carrying and net carrying. Disclose revaluation or write-off figures for the first 5 years. Next, easy. Audit of trade payables and other current liabilities. Trade payables, how do you verify existence? Prevent duplicate invoices. Reconcile accounts payable. AP means here accounts payable. And aging analysis with general ledger. Investigate, reconcile. Do a direct confirmation. Send to big vendors. Confirm at balance sheet date or close to it. You can send it with balance or without balance. Keep selection method confidential until trial balance is shared with you. Control dispatch or receipt of confirmation. Auditor has to control entire, auditor should have control on entire external confirmation process. Reconcile discrepancies. For non-replies, review subsequent payments or vendor invoices. Analyze balances for identifiable transaction. Verify related party payables and authorization for arm's length transaction. Analytical procedure, review trends in purchases or expenses and accounts payable. Inquire about reasons for changes in trends unusually. Review process for identifying or writing back old credit or balances. Valuation, because suppose if some old creditors are written off, okay, like who approved it. Check aging analysis. Ensure write backs are approved. Verify foreign currency liability. Asset management process for identifying unpaid MSME suppliers. Disclosures, specifically for MSME, unpaid interest principal, how much you need to show separately. Interest paid, how much, where MSMED you paid amount beyond appointed day. And accrued or unpaid interest, how much, future interest due, how much. Next, completeness, perform cutoff procedures for year end. Ensure all goods received before year end are booked. Match invoice dates to gate rent record for correct accounting period. Review subsequent expense vouchers. Advances received, verify underlying documentation and perform aging analysis. And other current liabilities, current maturities, interest accrued but not due, interest accrued and due, income received in advance, unpaid dividend. These are all examples of current liability. Application money, pending allotment, money received for securities allocation but pending for refund or allotment. Disclosure terms, shares, premiums, all that. Specify sufficient authorized capital is there. Reasons for delay in allotment. Non-refundable shown under equity. Refundable no shown under current liability. Refundable application money means nothing but excess application money. We will show it under current liability. Non-refundable application money, we will show it under equity. Sampa, share application money pending allotment. That's it. Next, audit of loans and advances. Best one is direct confirmation. Statutory balances, review statutory returns, GST site, all that. Completeness, compare the list with the ledgers. Verify agreements for loans. Confirm security deposits. Review related party loans, authorizations, all that. Valuation, assess doubtful accounts. Consistency, aging analysis, litigations, all that. Review write-offs and provision movements. Restate foreign currency loans and advances given. Disclosures, long term capital advance, related party, other advance. Subclass with secured good, unsecured good or doubtful. Disclose doubtful provisions, allowances. Separate for directors and officer related entities. You need to give a separate disclosure. Then short term is also same. Audit of provisions and contingent liabilities. Provision is a liability where substantial estimation is involved. So a significant estimation is involved. Provision. Provision, present obligation plus probable resource outflow plus reliable estimate. If these three are there, then you can recognize. Example, litigations and warranties. Contingent, possible obligation, present obligation or a present obligation but not recognition due to there is no probability of outflow or measurement cannot be done. In these two cases, we will show it as contingent. Audit procedure, get a list of it and compare with ledgers, inspect agreements. Completeness, see that all the provisions are recognized. Management working basis and all, you check it out for valuation. Disclosure, long term provisions, short term provisions, contingent liabilities, commitments. Contingent liabilities are again multiple types. Claims not acknowledged as debt, guarantees, other contingent liabilities. Capital, commitments like capital contracts, uncalled liability, etc. Next, additional regulatory for Binami properties, details, amount of beneficiaries, balance sheet references and reasons. Balance sheet reference means Binami property and which item in the balance sheet, referencing. And proceedings, what is the status and what is the company view. Binami property is nothing but here whether any proceedings are initiated against the company under Binami law. Then details of that proceedings, amount, who are the beneficiary, balance sheet reference for the asset, proceeding status and company view. Whether the company has entered into any transaction with stock of companies. If so, what is the transaction and how much balance is there? What is the name of the company? What is the nature of transactions? Ratios, current debt equity, yes or no? Debt service coverage ratio, DSCR means return on equity, inventory turnover ratio, trade receivable ratio, net capital turnover ratio, net profit ratio, return on capital employed, return on investment. Explain numerator and denominator. Also explain if there is a change more than 25% compared to previous year. Correct? Next, with this balance sheet items is completed. Are you clear? Just 2 minutes. Yes, let's proceed. P&L items. Audit of sale of products and services. So before we start about audit procedures in sale, there are some important controls related understanding. So first, auditor has to understand sales and collection cycle, like what is the process of sale to payment. What are the key P&L items and high material sales is an important P&L item and which is prone for high risk of MMS. So first understand the entity, what are the products they are dealing, what is the demand they have, what are the major items, are they discontinuing any items, what are the sales terms. Any of this can be asked as a question, this can be asked as a 3 marks question. Then understand management controls on sales, segregation of duties there or not, credit limit checks there or not, authorization of sales orders, issuing invoices, delivery of goods, recognition of sales. Then common controls and testing, what auditor has to check. See pre-numbered invoices there, sales order approval mechanism is there, PO authorization, when a customer places an order we need to authorize it, approve it, and right of approvals. Test controls whether they are strong or not, because strong controls reduce substantive testing, and report deficiencies as per 265 if you identify any deficiencies in internal control. And substantive procedures, what we do, check purchase orders, invoices, customer statements, all that, and ensure that sequence accounted for all, properly it is accounted sequentially correctly. Analytical, look at sales trend analysis, prior period comparison, category wise sales analysis, pulled sales expected value, examine prices, analyze discounts and returns. Procedure for sales occurrence, see that no cancelled invoices are accounted. Test invoices versus sales journal. Customer confirmation, no fictitious customers or sales. Authorized shipments only should be there. Unearned revenue shall not be recognized. Collectability certainty, sales will be recognized only when the collection is certain. Review invoice sequence, see that it is pre-numbered, sequence is correct or not, if any missing item is there, why it is missing. Match sales returns with supporting documents. Completeness, cutoff, see that revenue is in correct period. Date of invoices versus delivery, many companies account books of accounts based on date of invoice, but delivery date might be different, so that is why you need to perform cutoff. Verify post year-end credit notes. For example, 31st March before you sale is there, immediately later on credit note is there, means sale return is there. Verify reasons, it might indicate a fictitious sale. Trace shipping documents to sales journal, check quantities in sales register, reconcile stock or statute records, review GST returns versus revenue, measurement, trace transactions, accuracy, and discounts accounting, understand the gap, like point of sale versus percentage of completion, depending upon the type of the industry, depending upon the type of the product, related party transactions, no, check the collectability, check authorization, see if it is see it is at arm's length, and for export sales follow AS11. Then disclosure, you know, for non-finance companies, no, disclosure is like sale of products and services, grants, donations, okay, and other operating revenue less excise duty. For finance companies, no, interest, other financial services, no, note, revenue must be shown by head, brokerage or discount, related party transactions, all this has to be disclosed separately. Then audit of other income. What is other income? Income which is not core for the business, then that is called as other income, like fixed deposit interest, loan interest, mutual funds returns, all that. Recognition on a proportion basis. Dividends when right to payment is established and probable economic benefit and reliably measurable amount. Then recognition on mutual funds upon title transfer, difference between redemption price and carrying value, that is shown as profit or loss. Audit procedure for other income. Occurrence: get a list of fixed deposits regarding interest, recompute the interest amount, trace it to the bank confirmation, reconcile with income tax form 26As. Dividend: verify right to receive established, look at the company dividend declaration, any documents. Mutual funds: verify title transfer, redemption price, all that. Completeness: ensure that all other income is recorded, there is no understatement or overstatement. Measurement: verify as per accounting standard. Disclosure: interest income, dividend income, net gain or loss on sale, and other non-operating income, net of direct expense. Additional regulatory: suppose, no, in the during the year, no, if any unrecorded income is disclosed in tax assessment, all that, what auditor has to check? Confirm whether that income is recorded in the books in the current year. CARO also we covered this point. Purchases: understand the organization or production purchase process, what products the company is dealing with, you know, vendors, are the domestic or overseas, terms with them, major vendors, credit period, quality checks, purchase terms and conditions. Control points: segregation of duty, competitive quotes we have to invite, purchase committee must be there, authorization is there or not, GRN is there or not, quality checks there or not, vendor invoice approval is there, two-way match or three-way match. Three-way match means purchase invoice, purchase order, GRN, e-way bill or GRN. Two-way match means vendor invoice, purchase order. Testing effectiveness: test effectiveness of controls, if effective, reduce substantive testing. Common internal controls on purchase or what? Competitive quotes, purchase order numbering, PO authorization, GRN generation, quality inspection, two-way, three-way match, invoice authorization. Next, sample testing: random samples you test, GRNs you test, purchase invoice you test, inward gate entry, vendor reconciliation. Substantive: do perform purchase trend analysis, comparisons you do, set purchase expectations, and all this. Analytical procedure. Next, audit procedure. Occurrence: verify fictitious vendors, like see vendor selection process, see whether a vendor is really existing or not, look at their GST address physically present there or not, confirm goods received inward, check quality inspection, ensure invoice is approved, confirm two-way or three-way match. Special considerations: ask always for original invoice, risk or reward transfer, invoices must be in the name of the company, verify input tax booking, also check with GST returns, arm's length price is there or not in related party checkout, capitalization is based on judgment, review journal entries. Cutoff: ensure purchase are in correct period, examine last five inwards, okay, and see when they were actually delivered. Verify goods in transit, get representation. Analytical: consumption analysis, stock composition analysis, compare current year consumption with previous year, ask management for variation. Stock composition: current year how it is composition last year, compare creditor or stock turnover ratios with prior period, reconcile closing stock with opening balances. Purchases of stock in trade, changes in inventory, related party, these are the disclosures. Employee benefit expenses: in this, no, you need to understand entity hiring process, hiring, appraisal, retirement process, test the control. Measurement: verify appropriate measurement. Sample testing: appointment, on a sample, no, for few employees, select test appointment letters, see promotion letters, attendance records, HR policies, employee master. Common controls are what in employee benefit expenses? Generally they will have attendance record, they will have payroll master, payroll processing will be there, authorization will be there, accurate deduction of taxes, PF, all that, accrual of gratuity, everything and all will be separately calculated. Analytical: look at monthly expense reasonability, compare with previous period, set expected value and compare it with industry. Then audit procedure. Occurrence: Understand how attendance is captured. Verify fictitious employees like in-person meeting on a sample basis. Review ID proofs, all that. Completeness. Get a list of employees. New hires. Verify appointment letters. For resigned people, verify full and final settlement is made or not. Check accurate provision for bonus gratuity for ongoing employees. Analytical procedure, or not that. Measurement. Review 12 months salary register. Compile monthly payroll. Verify accuracy of the amount debited to P&L. Analytical. Analyze unit produced per employee. Ask management for variation. Disclosure. Salaries and wages. Contribution to provident and other fund. Expenses for ESOP, staff welfare. Like 4 heads we classify. Employee benefit expenses. That's it. Then audit of depreciation and amortization. Key attributes. They will directly ask you what are the attributes when you are doing audit of depreciation, amortization. Understand the accounting policy. See that the method is applied consistently. See that residual value is considered. See that charges are valid, accurate in correct accounting period. And significant components, they must be depreciated separately because they may have a separate life. Depreciation method, that also you should check. Understand entities process. Review fixed asset register. Capitalizing revenue expenditure is there or not, check out. Expensing expensing only capital items. Fake assets must be identified. Completeness. Identify list of additions and deletions. Intangible assets, are they properly amortized? Depreciation starts only from the ready to use date onwards, not from actually when it is used. Depreciation on revalued amount only. And remember, IT Act depreciation, no, it is not. General IT Act depreciation is different from Companies Act. See whether there is a difference or not. Measurement. Verify rates and calculation. Perform analytical. Depreciation must be always based on useful life. Residual value has to be correctly done and computed prospectively only after useful life changes. If at all there is a useful life change, depreciation is computed prospectively. We don't do retrospective. Other expenses. What other expenses include? Power, fuel, rent, repairs, insurance, all that. See that expense actually occurred or not. See that all are recorded or not. Generally in other expenses, what is the focus point? See that it is pertaining to entity. See that it is revenue in nature, not capital. See there are valid supporting document. See that correctly it is classified. See that it is authorized and it must be related to business. What is the focus point of the auditor when auditing other expenses? Like that they can ask you this itself as a 4 marks question. Then what are the audit procedures? Occurrence, completeness. Insurance. Look at the policy documents. See the validity period. See prepaid and expense based on number of days. Measurement. See that it is measured properly. Rent. Get a month-wise schedule. Rent agreements. Verify 12 months rent. Consider escalation and agreement in the name of the entity. And rent is generally recorded on straight line. Straight line means what? Every month it is same. Legal and professional. Month-wise get a report. Consultant-wise also get a summary. Retainership, if at all company has a monthly paid retainer, then verify 12 months. For non-recurring, verify samples and be caution for disputes. Ensure provision, all that. Travel, repairs, printing, miscellaneous. Select samples and vouch for attributes. Monthly summary for trend analysis. Analytical procedure. Power, fuel and all these expenses. Month-wise schedule. Verify 12 months. Compile units or rate. Analyze monthly trends. See, you see monthly trends point is common. 12 months point is common in many expenses. Correct? Finally, the last one. Analytical. Compare expense per unit in the current year and compare with the last year. Ask management for variation. You need to disclose these other expenses under various parts like this. Additional disclosure. CSR. Corporate social responsibility. How much amount company has to spend, how much they already spent, how much is the year-end shortfall, what is the previous year shortfall, why there is a, what is the reason, and what are the nature of CSR activities, related party transaction and provision movement. Cryptocurrency. What is the profit or loss on these kinds of transaction, how much amount is held at reporting date, how much deposit or advance for trading or investment. Items of financial statements is done. 50 minutes almost. Understood? Briefly we got a good idea, right? This is very good for us to quickly revise multiple times. Items of financial.